growth in earnings per share. That's huge. So seeing a company that is consistently growing earnings on a quarterly basis every single quarter, that's what you want to see. Look, you're in Australia. I'm in the United States. In my country, there's probably 55 to, well, if you add in all the penny stocks, there's thousands, but there's, on just the average U.S. stock market, there's about 5,000 to 6,000 stocks that are traded every single day, just the regular stock exchanges. And if you look at those stocks, many people are willing to trade any of them. I'm real picky about what I want to trade. And I think I always encourage traders to be very picky. And the way that you do that is you look for strong earnings, right? Not every company has strong earnings. So you want to look for companies that have strong earnings, growth, and you also want to look for companies that have strong revenue growth and profit growth, but also return on equity is one of the big factors that I look for. I learned that from Warren Buffett, not personally, but through a book. And Warren Buffett, talks about the importance of return on equity. Also, one of my biggest influences was William O'Neill, who started the paper Investors Business Daily. He's written the book How to Make Money in Stocks. One of his primary criteria for a good growth stock is a return on equity above 15 to 25%, somewhere in there. So I like to screen stocks out for return on equity around 25% if possible. I like to look for earnings per share that's earnings that are accelerating, profit that's accelerating. Those are the main things that I look for, Aaron.
Okay, that's great. So people who are just sort of, or traders who are just sort of new to the market and that sort of thing, what's the easiest way where they can access that sort of information?
Yeah, there's some really great sites for free. Ycharts.com, Y, just the letter Y. It's an unbelievable site for free. They've really been kind of locking a lot of it down lately. But ycharts.com, you can go there and you can graphically see every stock's PE ratio, their revenue growth, their earnings growth, the return on equity. You can just chart it all out, and it's all free. And you can set up a free account there. Another great site to check out for good fundamental growth stocks is Zacks.com. Zacks.com, they actually assign a proprietary ranking to every stock. 1 being strong buy and 5 being strong sell. It's a scale. And I look for number 1, number 2 stocks at Zacks. So when I look at a stock and I'll screen it, I'll typically find a stock that meets my fundamental parameters, and then I'll check and see what's Zacks saying about it, and what kind of ranking does it have in Investors Business Daily. You can find Investors Business Daily online at investors.com. And I look at those free tools, and I just try to find out, what's the overall analyst sentiment on this stock, how's the earnings growth on this stock, what are people saying about it, and so I look for that. Those are really great sites. Ycharts.com, Zacks.com, that's Zacks.com, and investors.com. Those are all some great resources.
Okay, good one. We'll put links to those in the show notes below this episode, and we'll definitely check those out.
Are you ready to get serious about options trading? Then join Tasty Trade. Investopedia's bet is packed with advanced support during trade apply. Options involve thought. If only I had 12,000 US hour so you can go big. The pool offers a free demo limited risk trading.
So talk about trading plans. So what does a trading plan mean to you, and what should entry level traders do to create one?
That's a really good question. Whenever I was younger, my grandfather, who served in the war, the Great War, the World War II, told me that it was important when you walk into a room to know the exit. And I always used to think he was paranoid, but it's a very true statement. You got to know the exit when you walk into someplace, and that applies to trading especially. Most people don't realize that you make money when you buy, not when you sell. That is a point that is so important, I think, for traders to understand. You have to buy right in order to succeed at trading. It's when you buy, when you place that order, that is the moment where you're making money. Because if you buy wrong, you'll know it quickly. If you buy right, you'll also know it quickly. And so it's important, I think, to know your exit. What's your exit strategy? Never walk into a stock and not know what your exit strategy is. A good exit strategy has a dollar amount. So in other words, if I buy a stock at $30, typically my own personal trading philosophy is that I don't want to lose more than 8 to 10% on a stock at any time, under any circumstances. I'm just not willing to. There's very, very few instances where I will. The few instances where I'll take a larger stop loss than 8 to 10% is when I make a pretty big speculative move, say on a little penny stock, and I'm only throwing a small amount of capital into it. Okay, maybe I lose the whole thing. Maybe I'm wrong. But for the majority of my trades, I don't want to lose more than 8 to 10%. And I stick that in my stop loss order immediately after I place the trade. So I think having a system is part of your trading plan. I'm going to buy the stock. Am I going to buy it on a market order, or am I going to buy it on a limit order? And then you decide that. And then once you get in, you place that immediate stop loss order. And then you decide to yourself, how much do I expect to get out of this? Profit potential is an important part of the equation whenever you are placing trades. You should know approximately what you expect to earn from the stock before you buy the stock. You have to know that, because if you don't know that, then you don't know if you're making the best decision, because part of the reason why we trade is we trade for profit. And if I have 4 or 5 different stocks to choose from, I want to choose the one that has the greatest risk-reward ratio. And so I'm looking for the stock that has the best profit potential for the least amount of risk. So you have to know all that before you jump in. If you're just jumping in because you heard it on TV or because you read it in the paper, that's not a good reason. And you may be buying the right stock, but you may be buying it at the wrong time. So the trading plan really is all about making sure that you have a systematized approach to your trading, and you don't buy the wrong stock at the wrong time, or even the right stock at the wrong time.
Yeah, I think you made some really good points there, Jerry. That's awesome. So, I mean, we might have already covered this a little bit, but where do you often see entry-level traders slipping up, and what would you say to them? I mean, I know you deal with quite a lot of entry-level traders through your training and that sort of thing. So, I mean, what sort of issues do they face that come up quite regularly that you see?
I think probably knowing when to sell. I mean, when you get into a stock and it goes up, right? You buy a stock and it goes up, and you're excited, and you've got your stop loss there, and it's up a little bit. I think sometimes new traders, especially, and even those of us who've been trading for a long time, sometimes it's easy, if we don't have a plan, to get confused and get emotional. When the stock goes up 10%, we think to ourselves, oh, this is great. Well, surely it's going to keep going up. And then it goes back down, and you lose all your money, all the gains that you had made. So I think it's important that you don't ever let a gain turn into a loss. You can do that through stop loss orders. But I think that's probably one of the things that discourage a lot of traders, is that they don't know when to sell. They're either too timid or they're too greedy. And it's a hard lesson to learn. It's one of these things that you just have to learn through consistently doing it and using a system. So again, when I enter a stock, I typically have a profit potential that I have in mind, and I have my stop loss. And I know all those things right when I buy the stock, because I immediately place a stop loss order, and then I begin to watch that stock. And if it gets up, let's say that I plan on making 8% from that stock. Well, when it gets up to 8%, I'm moving my stop loss up really tight, because I don't want the market to tank the next day just all of a sudden, and my stock and all my gains that I worked so hard to get, now they're gone. Right now it's back down to zero, and I'm flush again. That's terrible. And so you want to lock in those gains, and that's why you need to know your profit potential. So again, if my profit potential on a stock is 8 to 10%, I expect it to go up by that much, then I want to watch that stock. And when it gets up to that level, I want to choke up that stop loss and keep it real tight. That way, if it does fall back, I still make money. And I would say for most new traders that I encounter, usually figuring out when to sell is usually the hardest thing. And you can overcome that with the system. That's really what you have to have. You have to know what would cause me to sell. What would that be? What are the sell signals? And if you don't have any of those, then you're going to lose money. So you gotta have some sort of warning system built in that you can refer to. That can be a moving average crossover. It could be RSI. Something happening in the RSI. It could be a stochastic move. I mean, there's so many different things that you can look at that will give you an idea that maybe it's time to bail on this stock. You've just got to have that in mind and have that up front so you don't lose money.
Great. So I've heard you saying before, and I quote, trading can be learnt by anyone willing to put in the effort and the time. What is it that you believe stops the majority of traders from making that huge success?
No system. They don't have a system, Aaron. They are attracted by the amount of money that they can make. They're attracted by the lifestyle that trading affords. I mean, I got to admit, trading is nice. I mean, the lifestyle is very, very, very good. When you succeed as a trader, you have the ability to work from anywhere in the world. I tell you, this is a personal story. One of the very first traders that I met, it left this lasting impression on me. In fact, this might be the most motivating thing that drove me to become a trader. He was an older guy. He was probably late 60s, and he was a trader, and he had a yacht. And he lived on his yacht, I mean, most of the time, like 5 or 6 months out of the year. And he had his family, his wife and the grandkids, and they'd all go out sailing on their yacht and stuff and doing things. And he would trade in the first few hours of the morning. And he would close his computer by the end of the day, or by the end of the morning, and he was done. And he would trade like Walmart, he would trade IBM. He had a lot of money, and he would use options and different things. And he would just make, $1,000, $2,000 a day because he had a lot of money. And just, when IBM or Walmart moves 10, 20 cents and you have a lot of money in it, you can make a lot of money. So it was very low risk trading. And I saw what he was doing, and I thought, you've got to be kidding me. This is fantastic, because I was working a slob job, and I was not very happy. And I thought, man, I've got to make my life something like this. Well, trading now with all of the internet and the computers and everything that we have now, you can do this from anywhere. You can do it from a yacht, out in the middle of the ocean. You can do it from your house in your pajamas. I mean, so trading is really, really sweet in that respect. People see that, Aaron, and they get caught up by it. They get caught up by that, and they forget that in order to get there, they have to have a plan, right? They got to have a plan to get there. And so I think many times people are very excited by the dream or by the vision of what life could be as a trader, but they just don't build the bridge to it, and they take set forth the hard work that's required to get there. And again, what that means is when you start losing money in a trade, cutting those losses. And then you're going to buy another stock, and if you start losing money again, you cut the losses. I went through a period where I lost money for about a year. It was the worst time in my trading career. I mean, I could not make money to save my life. It was unbelievable. And of course, this is before I had my system too, but still, I was very frustrated, and I almost threw in the towel. And I think back at that time, oh my gosh, what if I had done that? And that's one of the things I tell new traders is that do not give up. If you really want this, if you really want to succeed, if you really want to have that lifestyle that you have in your mind, you cannot give up. You have to continue. And when you lose money, you've just got to lick your wounds and keep going. But if you stop trading, then it's over. It's over. Now, I will say this. If you don't have a system, that's not my recommendation to you, because you're just going to keep losing money. Here's the thing to remember about Wall Street. The guys who are on Wall Street in New York City, these guys are smarter than you and me and everybody that we know put together, right? And if they're not smarter than us, they're certainly more slippery than us. That's a kosher way to say it. they are. It's a very dirty game, trading. And so they see guys like you and me coming a mile away. When we come in and we type in and we want to order, 100 shares of a particular stock, they know exactly who we are, and they know how to shake us out and take our money. So that's why it's very important for the average trader who's out there to have a system, to not give up, to understand that he has to have some knowledge, that he can't do this without gaining some experience and knowledge. And Aaron, there's a lot of seminars out there. There's a lot of coaching programs out there, and many of them are thousands and thousands and thousands of dollars. I've never done any of those, and I succeeded. I'm not saying that you can't make money using those. I know you can, but I think when I say system, what I mean by that is that read through many different books, read through different trading books, notice what people use for trading strategies, and start using some of them, and find out which one works for you. Really sit down and take the charts that you've traded and draw on them, print them out and draw on them, look at them, become intimately familiar with the tools of your trade, and just realize that it's going to take time. It's going to take time. Unfortunately, there's been a lot of TV infomercials and websites out there that make it sound like, anybody can make $1 million overnight by trading this one little stock that you don't know about, but I do, so give me money and I'll tell you which one it is. It doesn't work that way. It just doesn't work that way, unfortunately. You've got to have a system if you want to do this long term.
Of course, no, that's really well put, Jerry. Now, you touched on a little bit there. I'd sort of like to dive into a little bit more, especially since you went through that year where you lost money consistently. The emotional side of trading. So how do you manage emotions? And what gives you the confidence to keep on executing trades after a losing streak? Even just a few bad trades, it can be hard to sort of push the button and get back in. What gives you the confidence to keep pushing on and know that your system's working? And how do you know when it's broken?
Yeah, it's a great point. I think what gives me the confidence now is not anything having to do with the stock market. From a economic standpoint, I am of the opinion and the persuasion that this market is completely bogus. It's all funny money that's been created here. So I'm not confident in the market itself. What I am confident in are many of the companies that I will invest in. For example, the United States of America is $18 trillion in debt. That's just on, that's the big public debt. If you look at unfunded obligations, they have $127 trillion of debt. They're never going to pay it off, And so in my mind, companies like ExxonMobil or Chevron, these big oil companies, to me, these companies will outlive nations like America. These companies are sitting on huge piles of cash. They don't need America to sell oil. They can sell it to anybody who breathes and who needs it. So to me, I think of these companies and I see how much cash they have, and I realize that by trading these types of companies, as long as I use a system that works, I'm going to make money because those companies will still be around. And because I use stop loss orders, I also know that my losses will be limited, if I do have losses. And, after trading 17 years, I've only been really, stop losses really only not worked for me. Probably I can count on two hands, usually from operator error. But a good stop loss set properly will almost always save your hide, as long as it's not some strange anomaly where the price just gaps down something severe. And besides, if Walmart stock or if BP or if ExxonMobil gaps down, guess what? It comes back. So in many ways, you don't have to lose money unless you just have to have that capital and you have to sell. So those are some of the things I would think of, regarding that.
Okay, awesome. So just one other thing I'd like to touch on, and that's tracking progress and reviewing trades. Is this something you do, or maybe you did it earlier on? And how important is this for newbie traders, or is it a little overrated?
Well, I think I think sometimes it's a little unrealistic to think that you're going to have enough time to do all of that. But I do think that it's very important, and I still do it to this day, as I mentioned, is to always know why you lost money in a trade, or always know why. More importantly, perhaps why you made money. Sometimes when we make money, we'll chalk it up and just consider ourselves great and move on. But we don't stop to really think, now how did that happen, right? How did those stars align? How did I make that money? And because when we lose money, I think we all know we need to figure out how that happened, because we don't want it to happen again. But likewise, when you make money, you want to make sure you understand so you can make that happen again. And so I would say that probably one of the smartest things that people can do, if they're not afraid of charts. And if you're afraid of charts, trading is probably not the best thing for you, because that's really what you're trading. I mean, sure, you can trade on fundamentals, and sure, you can just trade on some of those things. But I think you're really crippled, especially in this market, because, again, it's so manipulated. So you've really got to see the chart. You've got to see what you're buying, and you've got to see where it's at. So I would say that, focusing upon printing out charts, looking at them, maybe you don't have to print them out, but just really pay close attention, draw on the charts, really look at the charts and understand. And I think one of the most important things, the biggest thing that ever happened to me in trading was understanding trends. That was it. All markets, and you know this, Aaron, all markets go up, down, or sideways. I mean, that's really all it is. And so when stocks overall, like when the S&P 500, for example, is in an uptrend, 3 out of 4 stocks are going to follow that trend. If a market is trending down, 3 out of 4 stocks are going to follow that trend. So if you're trying to go long in a market that's going down, you're giving your money away. And if you're trying to short when the market's going up, you're just giving your money away. So you've got to understand trends and ride the trends. And I think understanding how trends operate, being able to draw a simple trend line on a chart, all of those things, they seem simple, but a lot of traders I've met don't know how to do that. So I think those are some really important things. Print out those charts, find out why your trade didn't work by looking at the chart, try to find similarities in your losses and similarities in your gains, and try to learn from them.
Yeah, very well said. Great advice there. So, Jerry, that's sort of bringing us towards the end of the interview. And again, thanks so much for coming on the show and sharing so many incredible insights. So let's go to the closing bell, and we'll hit you with a round of questions we asked all our guests. So the first one would be, what's the best piece of advice you've ever received? Got you thinking?
Wow. Yeah. Best piece of advice I've ever received. Let's see. Well, probably I would say would be to follow the money. If you want to know the truth about anything, you've just got to follow the money. Don't pay attention to what people say. Pay attention to what people do. And when it comes to stocks, it's the same thing. If you want to know what's really happening in a stock, pay attention to what the insiders are doing. Pay attention to what the institutions are doing. Follow the money, and you'll find out what's really happening.
Awesome. What is the number one trading resource you couldn't live without?
I would have to say couldn't live without probably an outside resource that I haven't created for my own self. An outside resource would be probably Investors Business Daily. I read that religiously every day. It's a really good newspaper, and they keep track of what they call the IBD 50, the Investors Business Daily 50. And there's 50 different stocks in there that are the hottest, fastest growing growth stocks. And it's just like it's a great list of stocks to start your trading watch list from. So I start my morning with IBD. I like it. I've been reading it for a long time. It's a great paper.
Great. Name one book you believe is a must read for any trader just starting out.
I would say How to Make Money in Stocks by Will O'Neill. I think I mentioned that earlier, but How to Make Money in Stocks by William J. O'Neill. He puts a ton of charts, historical charts, throughout his book and shows you how to tell a good chart from a bad chart. And I think being able to understand how to, when you can look at a chart and just look at it for 5 seconds and know several things about the company, you're in a very good place. And I think that's where that book can take you. You can read that book and learn how to read charts, and that to me was the big difference that allowed me to make more money. Was understanding how to read charts.
Okay, sure. Knowing everything you do now, what would you have done differently come day one?
I would have been more. Probably, let me think here. That's a really good question, Aaron. Gosh, if I could go back and do something different, I would have certainly been more wise in trying to seek out counsel and trying to seek out a mentor. I really just kind of ran out and did it on my own. I was fortunate in the fact that it turned out well, but a lot of people don't. Most people are casualties. So I would have searched out somebody who could have helped me. I would have turned to somebody, and the people I did know who were trading, they were kind of new like me, so they really didn't have anything to offer me. So I would say finding a mentor, getting a coach, something like that. That's probably what I would have done differently if I could go back.
Great advice, Jerry. All right, so that's brings us towards the end of the interview. So do you want to share with the listeners a little bit about your new trigger trading system, and also share with us where we can find out more about your services and connect with you?
Sure, yeah, absolutely. We started a brand new trading system in May of this year, or earlier, May 2014. And it's called Trigger Trade Pro, and they can find it at triggertradepro.com. They can go to your website and find the link there. But the system, in essence, provides a set of technical indicators that we have finagled, and we have created our own system using proprietary indicators. And when all of the indicators indicate a buy, we buy. And then when all of the indicators indicate a sell, we sell. And it has worked out very well for me over the years. And I was finally, and I'm not a software developer, I had to find people who knew what they were doing, and I had to figure out, and it was a big laborious process, but we finally got it out there now. And we have subscribers all over the country, here in America, 7 countries around the world now. And we put out daily trading ideas. Every single night, we have a nightly trading report that lists usually about 100 to 150 stocks that we're watching for that next day that you can analyze that night before. And all of these stocks are stocks that are triggering within our system. They're getting ready to trigger. So that is at triggertradepro.com. That's where they can go to find out about that. We also have a free trading podcast at triggertradereport.com. They can just go there and download the free podcast. We just do a teaching podcast there for brand new traders.
Great. And you've got, you're on Twitter as well?
Yeah. Twitter.com/FTM Daily is our Twitter handle.
Okay, great. All right. Thanks again, Jerry. And we look forward to catching up with you soon.
It was a great honor. I really appreciate it, Aaron. Thanks a lot.
Thanks a lot, Jerry.
You've come to the end of this episode of Chat with Traders, but don't worry, more great episodes are on the way. To stay updated with each great new episode, be sure to subscribe to the podcast in iTunes, and we'd love it if you leave us a rating and review. We'll see you next time on Chat with Traders.
At tastytrade.com/double. Offer expires May 31st, 2026. Tasty Trade Incorporated is a registered broker-dealer and member of FINRA, NFA, and SIPC.
The biggest secret of the best traders in the world is that they're just like everyone else. However, they've worked hard to learn the markets and discover what works and what doesn't. But how can you hear about these journeys and get in on the strategies and tactics they use? You can do it by listening to Chat with Traders. Here's your host, Aaron Fifield.
Hey, what's up, guys? It's awesome to have you here, and a huge thank you for tuning into the second episode of Chat with Traders. We've got a really cool guest on the show today, and he's here not only to give us plenty of valuable trading insights, but also to share some pointers about what has made him a really successful options trader in today's market. With that being said, today's guest is none other than Kirk Du Plessis. Kirk originally comes from a background of investment banking and working on Wall Street, but a few years back decided to make the switch and begin trading for himself to grow an account of his own. And as many of you may already know, Kirk is the head trader over at optionalpha.com, which originally started out as a blog, but after venturing on his own, has now blown out into a platform where he teaches his method of trading options to thousands of people. Kirk is undoubtedly an authority on the subject of options trading, and that's just one of the reasons why I'm stoked to share this interview with you today. Just before we get into it, I would like to say, if you do enjoy this interview, please take a minute to leave a 5-star review on iTunes. That would be awesome and a massive help that will allow us to reach even more listeners. So I'm your host, Aaron Fifield, and here is our guest for today, Kirk Du Plessis. Enjoy. Hey Kirk, thanks a lot for coming on the show. It's awesome to have you here, and I really appreciate you giving up the time to come on.
Yeah, man. Looking forward to it, Aaron.
Awesome. So let's get started by sharing with us how you got into trading. Where did it all start for you, and what was the initial appeal?
Yeah, I mean, it goes back a couple of years, probably about 8 or 10 years now. And, I think I really got, I've always been in finance and interested in finance, right? Like my family's been in the financial business for a long time. So that's always been an interest of mine. But I think I really got introduced to trading when I was actually working in New York. So I worked on Wall Street for Deutsche Bank, which is a German bank. But I was in the mergers and acquisitions department. And so I was dealing with that and, kind of corporate finance for my degree and everything. But I had an opportunity with them to do a rotation on a derivatives trading desk. So like high yield debt and junk and stuff like that. And that's really where it kind of like piqued my interest in trading. And just kind of from there, it's, kind of taken off as far as, just continuously learn. For me, I mean, probably like you, it's like a never ending, thing. The markets are always changing. There's always new things to learn. So for me, that's always the big appeal, right? Is like, how can I get better and better and better at trading?
Absolutely. No, really good point. So I was listening to one of your podcast episodes earlier on, and you talked about losing a couple $1,000s in your first week after you left Wall Street. So I'm keen to hear, what were some of the things you struggled with early on?
Yeah, man. So when I got home from, and so in between Wall Street and doing, working in M&A, I had a chance actually to work for a regional bank in the U.S. doing research. So I was a REIT analyst. We covered like real estate investment trusts, and we would go meet with the CEOs and CFOs and publish reports and do the whole thing, and then, give price projections on stocks, which are, now totally bogus. Like I look back on that now and I'm like, I can't believe anybody ever read our stuff and like took it seriously, these projections at the same rate, right? So after all that, I told my wife, I said, look, I'm going to come home. I'm going to come home and I'm going to start trading, right? I'm going to do, what I have seen these guys do before in New York. And so I got home the first week and, like a rodeo cowboy, like new guy trading, right? I think I know exactly how the market works. And so I get in there and I make a bunch of trades that I have, no idea what's happening, but it just looks kind of cool to do it. And I end up losing a couple grand. And my wife comes to me and she's like, look, if this is what it's going to be like when you're at home trading, you better rethink your priorities here. So, but I think that really actually was probably one of the best things to happen to me. I know a lot of people go through that same thing, right? Where they go home and, they start trading and they lose and then they get discouraged. And I'm here to tell you that, probably losing some money to begin with is just your form of education, right? It's like paying tuition to the market. So I think what that taught me so many different lessons in that just couple weeks that I was at home starting off. But I think it really laid the foundation for, allowing me to go out and say, hey, what do I really want to do? Like, what does trading really look like? And then kind of from there started my trajectory of, learning how to really make this a successful income producing thing.
Yeah, right. So you took a few decent losses in your first week. How did you push on through that and not get discouraged? Was it you could see the opportunities and potential if you were to continue?
Yeah, I mean, look, I think that I've coached so many people over the last like 7-8 years, across the entire country. I mean, across the entire country. I've coached people in Australia and the UK and Africa and India and all over, right? And I find the same kind of things that people get discouraged about is just trading. They'll make a couple good trades and then they'll make one bad trade, right? And then that one bad trade, it kind of like hangs over them, right? Like it's that one bad trade that went wrong and they're like, man, this never works, right? So I think what I found and where I'm at now with my trading is that it's all about numbers. I mean, and it's got to be about numbers, and you have to approach the market like a mathematician, and that's how it's got to be, right? You can't approach the market with emotional ups and downs, right? I think a stock is going to go higher, or I read this news article. All this stuff means crap, and it doesn't really help you become more successful. So you got to approach it by the numbers and by the probabilities. And I think what I learned kind of in those first months, like really trading by myself and doing this, was that if I'm doing the right activities, like if I know that I'm going to, make the right trade, and that also leads me to believe that I know that over time that trade's going to pay out. It might not pay out the first 2 times, but if I make that same trade and it's a great trade, maybe it pays out 8 out of 10 times, right? And I just don't know when those 8 times are going to come in. I know that, 2 times I'm going to lose, and it might be the first, 2 times I make that trade. But if I'm doing things right, I'm doing the mechanics right, over time, the odds are going to work out in my favor. The probabilities are going to work out in my favor. And that's what I've really found in my trading, is that you've got to do the little things right every day. I mean, you got to be like a robot making the same types of mechanics with your trades, because over time it's going to work out.
Of course, yeah. So just on a side note there, when you left your job working on Wall Street and sort of with these other firms, were you just sort of diving straight into it without any other income? You just sort of started trading, and that was sort of your only form of income at the time?
Yeah, man. So it was an interesting time. So because my family has been in the mortgage business, I was kind of sort of in the mortgage business, helping out with them during that time. So, but now trading is definitely, a full-time income for me. But, I was fortunate enough that I did it at a young enough age with my wife, that we were able to take a little bit of risk, because she did have a more steady job. She's a teacher, still a teacher this day. So she was kind of my rock in that sense, because she was able to, I was able to lean on her a little bit. So I think that, I would be hesitant to tell anyone to just, quit their job and just jump right into it. And frankly, I don't even think you need to do that. It doesn't take that much time commitment that you need to quit your job to do it. Only when the income is more than your job, then, maybe you think about quitting just so that you have extra time, right? But you don't need to focus all your energy on trading and watching every tick of the market. You can do this and do it very, very well while still working your regular job.
Okay, great. Do you feel that having worked on Wall Street and been involved with the markets was an advantage or maybe a disadvantage for you when you made the transition to trading for yourself?
Yeah, I mean, I think the biggest advantage, I think there's drawbacks, and benefits to each, right? I mean, I think the biggest advantage was, I got to see the other side of the Chinese wall, right? I mean, that's like, it's not like the actual Chinese wall, right? Like it's the, what they call like, between private and public, right? So I was on the private side at M&A, so I got to see behind the scenes, really what companies are thinking as they start to go public and as they start to split themselves up and become acquired and make themselves targets. So that was interesting. And then when I worked for the regional bank that I worked for, I was on the public side. So I was on the other side where I was, now I was asking questions to the CFO and to the CEO, like, what do you think projections are going to be? How do you see this business growing? So as far as an understanding of how, most companies run their business and how that works, I got a pretty good understanding of it. How any of that relates to trading is, again, probably useless to most people, because I don't use much of what I learned in that space now in trading. And I would even say that most analysts that are out there now have no idea what it takes to be successful trading, because they are too focused on, earnings and revenue growth and all this stuff, which of course, it has its place in the market. But when it comes to trading options, in my particular case, because I'm an options trader, none of that stuff really means anything. It couldn't be further from, what you should be focusing on.
Okay, sure. Now that's really interesting, Kirk. So if that's not what you should be focusing on, would you mind sort of taking us through a little bit on how you describe your trading style these days?
Yeah. So here's kind of the maybe the 10,000 foot view on my trading. I'm a big proponent of making lots and lots of small trades, and I didn't always start that way. I was more of a proponent of be aggressive in the areas that you need to be aggressive, right? But now I know that over time the probabilities are going to work themselves out in my favor. So I need to act more like a casino, right? I need to limit my investment in every single trade, and I need to make lots and lots of bets all over the place. Now, some people would look at that and say, well, Kirk, why do you do that, right? It's just a lot of little trades, or I don't have the account size to do that. But I always talk to people and I say, well, think about a casino, right? You go into a casino and you say, I want to drop $1 million on one bet. No casino is ever going to let you do that, right? Not one casino in the world is going to let you drop $1 million on one bet. But if you go into that same casino and say, I want to take $1 million and I want to spread it out over 1 million bets of $1, they'd say, sure, all day long, right? Because they know that over time, they're going to get some of your money. But on a one-time roll of the dice, it's too risky, right? And so we need to act more like that. We need to make lots of little bets that are really high probability trades so that over time they all work out in our favor. So that's kind of the basis of how I trade as far as, kind of the 10,000 foot view. And then as we start digging down deeper, I'm definitely an option seller of, premium. I think that our edge in the market is implied volatility. It's been proven time and time again that implied volatility always overstates a move. So if implied volatility is, expecting a 20% move in a stock, time and time again, we'll see that maybe that move is 18% or 16%. So implied volatility always overstates that move. And so as traders, we need to take advantage of that little edge. So we need to be net sellers of options more often than we're buyers, right? Buyers of options are just getting crushed. And they're going to continue to get crushed in the market. But that's where everyone starts, right? Because it's easy to buy options. It's simple to understand. Nobody starts with option selling, which is what they need to start with.
Okay. You mentioned in there some people might think their account size can be a little limiting to take lots of small trades. Is that really the case? And would you suggest this is actually something new traders could do?
Yeah, absolutely. So here's actually a cool thing. So in one of the podcasts that we did, which is show number 6 for our show, we looked at one of the case studies that actually the guys over at Tasty Trade did. And they're doing awesome stuff with a lot of studies, and they've got so much more money than I could ever have to do all this, because they're backed and funded and all that stuff. So they're doing a bunch of studies. But here's the study that I think is absolutely one of the best ones they've done. And they took 2 traders with a $10,000 account, right? And so that's the average trader, right? They got about $10,000 to trade. That's statistically what the average trader has. The first trader, trader A, only invested 5% of his account in every single trade. So he made a high probability trade. He sold an iron condor, but he only invested 5% every month. Okay, so whatever his account balance was, he invested 5%. If his account balance grew, he invested 5%, et cetera, right? Left 95% of the money in cash, didn't even touch it, right? So he's investing, $500 basically, right, of his $10,000 account. Trader B, so the other trader, he invested 50% of his money in every trade. So no matter what his account size grew to or dropped to, he invested 50% of his money in every single trade. Now, at the end of the year, or I think it was actually a 5-year study. Yeah, I think it was actually a 5-year study. So they did 5 years of trading the same high probability trade, iron condor. Now, at the end of the 5 years, both traders had won 75% of the time. They had made winning trades 75% of the time. So naturally, people would say, Well, hey, if they made winning trades 75% of the time, trader B has to be light years ahead of trader A because he was trading more money, right? He won 3 out of 4 times. He was making profitable trades. And what they actually found out is that trader B with the bigger allocation, even though he won the same amount of time, lost half of his money. Trader A made 10%. So it's just phenomenal research that just proves the point that you don't need to either A, invest a lot of your money, or B, you don't even need to start with a lot of your money. You can start with $500 and start trading that way, right? And that's as long as you're diligent about, staying small and not risking too much, you can take $500 and grow that. And I think that's the key takeaway for small traders that are out there is don't be scared to start with $500. You can start there. You're not going to quit your job with $500, right? And you're not going to buy a Porsche or a Ferrari with $500 trading, but you can do it. And that's the takeaway.
Okay, cool. So when you talk about taking a lot of smaller trades, are you suggesting these are spread out across a range of markets or within a niche?
Yeah, so that's a good point. So I think that there's a couple different ways you can look at it, right? Some people would say that you have to be diversified in market. And I think more or less that's true, right? You don't want to trade all oil stocks or all, metals. You don't want to trade all gold and silver. So there's got to be some diversification across market. And that's just, common sense. You can do that kind of looking at things. But I'm more of a proponent of diversification across two different things. One, time. So I want trades that are spread out across, different times. So that means that I might have some trades that are front month options, some trades that are back month options, maybe some trades that are 2 months out or 3 months out. So I've got trades that are working in different times. And then also I want to be diversified across strategy. So I don't want to be a one-trick pony. I want to be able to sell strangles and sell straddles and also do calendars and butterflies, right? So I'm a big proponent. If you could look at my portfolio right now, I've got a pretty even mix of where my trades are strategy-wise and then also time. So I'm also, diversified over time. I think that's more important than actually market because market will end up kind of, neutralizing itself if you trade high probability trades.
Okay, sure. So just again, referring back to your own podcast, you've got an interesting episode about how charts are becoming less of an importance to you. So
yeah,
would you mind shining some light on how you use, a mix of technicals, fundamentals, and news to influence your trading decisions?
Yeah. So technicals used to be a lot more important to me, and I still reference them. So I think there's a place in technicals just because they're a way for people to get engaged, right? I mean, we're visual learners as humans, right? So we visually see something and we see an indicator cross, and now we know, hey, that might be, that's a buy signal, right? We can justify that in our head with the visualness. So technicals are okay, but what I'm getting to with that podcast, I think it was show number 3 or show number 4 in our podcast that we just launched, was that you don't need to know anything about the stock, like price history, technicals, to know if a trade is a high probability trade or low probability trade. And I think in that example, I was using Yahoo and another stock. I believe it was maybe Pandora or something. But basically, the stocks were virtually the same. And one trade, you had 80% chance of success and you were making, let's say, $50. In the other trade, you had an 80% chance of success, but you were making $20, right? And you don't need, we talk about that right now. You don't need to see the charts to know if I've got an 80% chance and I can make $50 versus 80% chance and I can make $20, well, I'm going to take that first trade every day. And so I think the more that people actually get, again, back into the beginning, get back into the numbers and make this mechanical and really learn the probabilities and statistics, the better off you're going to be. And believe me, it's tough. It's hard, right? Everyone wants this to be easy, right? And it's just not easy. That's why everybody can't do it. But if you learn some of the basics, I think you'll be light years ahead of where most traders are when they get started.
Okay, that's really good, Kirk. Before taking a trade, what are you looking for besides the probabilities? What gives you the confidence needed to execute on a trade?
Right. So I think the biggest thing is liquidity. So I'm at the point now where even though I trade small, I want to trade liquid. So I think liquidity is an overlooked thing that people just kind of glance over. They type in a ticker symbol and they see the options are traded, but they don't really look at liquidity because more often than not, liquidity is kind of where you can lose that edge that you gain in volatility. So if there's not a tight market, so the bid ask spread in the options is 30 or 40, or sometimes I've seen them almost $100 wide, you're losing a huge edge. And it doesn't matter how high probability trade you make or what strike you select. If you're in a market that's illiquid, you're going to have a tough time getting in. You're going to lose just on the bid ask spread in and out. And you're going to have a tough time getting out. So even if you have a profitable trade and it's working, you might not even be able to exit that trade for 3 or 4 days. And by that time, the market's turned around. So I think liquidity is a big thing when it comes to that. And then the other question I always ask myself is, do I need this type of a trade in my portfolio? And I was just talking last night to a guy that I do coaching with, and he was saying, well, hey, I want to make this trade in Wells Fargo. And we were looking at his portfolio, and I'm like, okay, well, you're bearish in Wells Fargo. You got 15 bearish trades here, right? You don't need another bearish trade. And he's like, yeah, but it's setting up really good. And I'm like, I don't care how great it's setting up. You don't need another bearish trade. You need to maybe take off a couple bearish trades or maybe get some bullish trades, neutralize, kind of your portfolio and your deltas. And I think that's a question that people don't ask, right? They look at a trade and they're like, man, this is a great setup. But does it fit in the overall picture, right? Do I need this trade or do I don't need this trade? It's just going to, cause me to be more lopsided. So those are the two things I look for, more than the probabilities.
Okay, that's really good. So once you're into a trade, can you give us a bit of an idea on how you might go about managing it?
Yeah, so I think there's obviously, two trades you can manage, right? There's trades that are, kind of self-managed, meaning, the credit spreads, the butterflies, things like that, the debit spreads. They're self-managed because you already have protection for them. So as soon as you enter the trade, you've bought in a put or bought in a call as protection. To me, I firmly believe that you do best by managing those when you place the order. So when you actually get into the trade, you make sure that you're not trading it too large and make sure that's a liquid product, that it fits in the overall portfolio. That's the best management you can do. At that point, you need to let the probabilities work themselves out. And that's why I tell people, this is not a business that you need to be, in a trade and out of a trade in 2 days, right? You can place trades and let them go all the way to expiration. If you do everything right in the beginning, so what? If it becomes a loser, you know that if you make that trade 10 times, 8 times, it's going to be a winner, right? So that's the whole game, is being able to be patient and let it ride. Now, the other types of trades that you have are the undefined risk trades, right? Like your strangles and straddles. When it comes to those trades, you have to be a little bit more aggressive, or not maybe aggressive, but you just have to babysit them a little bit more, right? They're undefined. They carry a lot of margin risk. So with those types of trades, you either need to be a little bit quicker to take profit. So you need to, buy back the spread when it's, has a nice, decent profit already. Don't wait for that full max profit because you might get yourself in trouble. But if a trade goes wrong, then there's a bunch of things you can do. But generally, I'm a big proponent of doing 2 things with trades that go wrong. One is extending my trading timeline. So if I can roll that trade to the next month and keep the same strikes and not pay to roll, well, then that's a winning trade to me because now I've taken a trade that, let's say, is in 30 days, and now I've given it 60 days because I've rolled it to the next contract month. Now I've got the exact same trade with the exact same risk parameter, right? I didn't pay any money to roll it, or I didn't, I got a credit to roll it. I've got the exact same risk, but now I've got 60 days to be right instead of 30 days. So I think rolling is actually underutilized right now in the market. People don't roll their contracts enough, and then they probably roll them wrong, but they need to roll them right. And then the other thing is, if I can take in a credit, that obviously will help, right? Taking in a credit on some of these trades will help widen out my break-even points, especially with your strangles and straddles. The more you can take in a credit, the better off you're going to become because you just bank this huge, huge credit, and that widens out your break-even points on your chart.
Okay, that's great.
Are you ready to get serious about options trading? Then join Tasty Trade, Investopedia's best platform for options trading 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including a $10 cap per leg on options trades, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, and more features to help you trade smarter. Manage your positions with speed and precision using Active Trader Mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Join Tasty Trade today and earn a double commission rebate up to $3,000 total on your stock and ETF option trades for 30 days. Visit tastytrade.com/chat for more info. All applicable regulatory exchange and clearing fees still apply. Options involves risk and are not suitable for all investors. Learn more about Tasty Trade promo terms and conditions at tastytrade.com/double. Offer expires May 31st, 2026. Tasty Trade Incorporated is a registered broker-dealer and member of FINRA, NFA, and SIPC. Ever watched a stock explode and thought, if only I had the capital, or sat on the sidelines because your account balance felt too small to matter? Good news. With Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, and even the newest IPOs, and short anything you like with zero locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. It's a game changer. Create your account and start trading real shares within minutes. No subscriptions, no minimum deposits, just a one-time evaluation fee starting at $47. That's it. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you ever pay a cent. Every decade, the market reinvents itself, from online brokers to commission-free trading. Now, the new era of limited risk trading has begun. Click the link in the description to start trading with Trade the Pool's capital.
So I'd like to just take a bit of a step back. I mean, you're an options guy, you trade options. What would you say attracts you to options over other types of products?
Yeah, and I know you've had other guys on like Tim Sykes and all those guys with, penny stocks and stuff like that. I think for me, it's about leverage, right? I think that options provide a great opportunity for today's retail trader. And I think more people are going to use them in the future as long as they continue to understand them, right? And the market for education and teaching people how to use options is, growing leaps and bounds, as is the option market. But I think what really attracts me to options is the leverage, right? The ability to control a lot of shares with a little bit of upfront capital. And then also the ability to make positions that are creative, right? Like I can take a stock, for example, we made a trade in Qualcomm today because Qualcomm dropped after earnings. But now I can take that scenario, and instead of making a just up or down trade, saying, okay, I think it's going to go higher, or I think it's going to go lower, I can now be a little bit creative with options and say, I don't know if it's going to go up or down, but I think it might stay in this range, right? So like with Qualcomm today, we said, you know what, I don't know if it's going to go up or down, but it might stay in a $6 range over the next month. So that ability to do that in options is, I think, really, really unique. And that's why I love them so much.
Okay, that's cool. So to someone who has little to no knowledge about options but might be interested in trading them, where do you recommend they start? Like, what are some of the things they should begin learning before anything else?
Yeah, so I think people can get overwhelmed, right? There's a lot of information to learn with options. And I tell everybody that I coach, you've got to take it in chunks, right? You've got to learn by focusing on specific areas. So I believe when it comes to options that you should just break down, all the different parameters, or topic areas that you want to learn. So for example, if you want to learn about, bullish strategies, great. Learn about bullish strategies for an entire week, right? Read everything there is to know, or you can find online about bullish option strategies. And if you see something in there and you don't know it, right, don't go look it up later. Just, keep kind of going through and just keep reading and learning about bullish strategies. And then next week, maybe you learn about the deltas, or the gammas or the thetas or the vegas or the Greeks in general, right? So you kind of break it down and you eat it chunk by chunk. And I think that's where people have to start is they get overwhelmed. They think I got to learn this and that strategy and that strategy. No, you've got plenty of time. Believe me, it's taken me a long time to learn it. I'm still learning it too, right? Like I'm never done learning. So you're going to learn forever. So take your time with it and learn in chunks. So that's, I think, the best way to hack through it is learn in chunks.
Yeah, so just breaking it down into small bite-sized pieces and taking it one step at a time. No, that's great.
Right.
So you teach trading to hundreds of students. Where is the one area you see beginner traders getting it wrong? I mean, this might be specific to option traders or just traders in general, but I mean, what stands out to you?
Yeah, I can tell you right now, the number one thing that people get wrong is that they're not persistent and consistent with their trading. And I say both of those things because you not only have to be consistent, right? You've got to do this. If you're going to commit to doing this, don't laissez-faire commit to do it, right? Don't like kind of dilly-dally into this market. If you want to do this, make a commitment to do it and realize that you're going to be doing it for at least the next year to see if it works, right? It's not a 30-day thing. It's not a 60-day thing. It's a year commitment, okay? So you've got to be consistent in doing it every single day. The second thing is you've got to be persistent in how you do it. So the types of trades that you make. So like hopefully I get across to people and what I'm trying to teach people is if you're going to make, if you want to trade, let's say iron condors, then great, trade iron condors, but be persistent in trading iron condors the exact same way every week for an entire year. And that's really hard to do. I mean, look, it's hard to do for me. It's hard to do for you and for everybody else to be that consistent. But that's the type of trading mindset you've got to have starting out in this business to know that it's going to work out. And I'll give you a classic example of why this is so important. If you look at trades that are high probability trades, right, that trades that will win 80 out of 100 times, if you know that distribution is going to be at some point over 100 trades that you make, you're going to win 80, then that should give you some confidence. But what often happens is that traders get started and they lose the first 20 times. And they're like, hey, this stinks, right? Like I'm never winning. But that's where you got to kick in the persistent and consistent because you know and you have the belief that you're making that right trade, that the next 80 trades or so, whatever, over time should be the ones where you make money. But people quit at the 20 trades. So they quit when things go wrong and they don't really believe in what we're trying to teach them, right? Like if they said, Kirk, I believe you that you're going to win 80% of the time. Yeah, well, it might be 200 trades before you see that work out, right? It's not going to take 10 trades. It's going to take a lot. So I think that's the number one thing that traders fall into and really trip up on is just kind of dilly-dallying and getting into this for like 10 days and then they're out. And then they're back in for 10 days and then they're gone for a month, right? You got to be in it or you're not.
Yeah, so consistent and persistent, I think that's awesome.
Yeah.
To be able to ride out potentially 20 losing trades in a row, you're going to need some really good risk management in place. So would you like to share with us any rules you might have around this topic?
Yeah. So and I'm glad you brought that up actually, because here's the thing, right? So if I said, and probably people right now on the podcast are like, Kirk, what the heck are you talking about? 20 losing trades? I could never do that, right? But this is where I go back to saying that you've got to trade small, right? You got to trade smaller positions because if you can't afford to lose on 20 little positions and still have money left over, you need to save more money or make your trade size even smaller. Here's an interesting statistic that I think a lot of people will appreciate, and hopefully it will bring some comfort. If you trade just 5% of your account balance in every trade that you make, right, like we talked about earlier, the probability that you go bankrupt with just 5% in every single trade is 1 in 3.49 billion, right? And you know that I don't have this in front of me right now. Like I know that stat. It's 1 in 3.49 billion. So that means if you're trading with 5% or less per trade, you virtually have the slimmest chance possible of going bankrupt. You got a better chance of getting hit by lightning twice in one day than going bankrupt. Okay, so that means that if you do that, you can trade through 20 losing trades and be persistent and consistent to keep going after that. So my rule of thumb is, and this is just what I use, I know other guys use different things, is my sliding scale is 1% to 5%. So your risk should be on a sliding scale, because sometimes you need to, slide it up, slide it down, should be anywhere between 1 and 5% of your account balance per trade. That means if you got a $10,000 account, 5% would be $500 for that trade.
That's great. I mean, I think statistics really sort of help to put it in perspective.
Yeah.
Especially in that case anyway. Trading can be a game that does play with your emotions a lot. So how do you deal with this side of things, especially after a few losing trades? I mean, we probably touched on this a little bit when we discussed probabilities and proving to yourself that you're going to make money in the long run. But that's easier said than done. So do you have any tips on how traders might be able to handle their emotions better?
Yeah. Yeah, I think it comes down to having some rules in place. So when you get started and you start learning a little bit more and then you start making trades, start writing down some rules for yourself. And rules are going to be different for you than for me. So I don't ever publish rules, so a lot of people will say like, Kirk, well, what are the rules of trading? Like, what do I need to know before I make a trade? Well, that's different for you than for me. But to have some set of rules that you go off of, like, for example, I won't trade a stock that doesn't have 1 million shares traded every day, right? Like that's just a little rule of mine. So it's got to be a liquid stock to begin with, right? I want the stock to be liquid so I know that the options are liquid. So if you have some of those rules in place, I think that keeps you sane because it hopefully will keep you out of bad trades when things go wrong. So when things are going really bad, right, people tend to have, make worse decisions, right? Like in life, when things are going really bad in life, you just keep making bad decisions because you're like, oh, well, things are going bad. But you can't do that in trading, right? So you got to be, consistent. And I think rules are really good to have in place. And I think they need to be a little bit firm. So you need to have some firm rules. Again, treat this thing like a robot, right? You need to make sure that you're entering things mechanically as soon as they meet your criteria. Don't look at the market. Don't read the news. Don't worry about what, XYZ CEO said they are going to do with new product launch. It doesn't mean anything. It's a bunch of crap. Follow your rules, and over time, you'll make decent money doing it.
Yeah, so having a solid set of rules helps to sort of remove some of the emotion from trading. Well, Kirk, this has been awesome having you on here. It's been really great. Man. So I appreciate you coming on. Awesome. We'll just take it to the closing bell, which is just a short, sharp round of questions. So the first one would be, what's the best piece of advice you've ever received?
The best piece of advice I've ever received. I don't know. I don't know. These are like short and quick. This is like the best piece of advice in my life. When it comes to trading, I think the best piece of advice that I've ever received is just somebody telling me earlier in my years, like you have no idea where something is going to go. And I think that sticks with me, right? Like no matter who you are, no matter how much money you have no idea where the market's going to go. So own that, right? Know that you don't know where the market's going to go and don't assume you do. So maybe that's the best piece of advice.
Yeah, that's really good. What is the number one trading resource you couldn't live without today?
I think Thinkorswim, the broker platform, I've been with Thinkorswim since before they've been bought out and all that stuff and went private, public, all that. So they've been a huge part of my success because I think their platform is so powerful. And I've learned so much just being able to navigate and use their platform that it truly is the one trading resource I couldn't live without.
Okay, that's great. We'll put a link to that in the show notes.
Yep.
What's one book you believe is a must read for any trader just starting out?
Oh, man. I think Reminiscence of a Stock Operator is an interesting book. It doesn't have any relation to really options, but it's all about Jesse Livermore and how he cornered the markets back in the day. And just understand that book again, I think, kind of just shows you the mindset that most people are in, and how he was totally different. And I think that's how most people have to act now, right? Like everybody everybody and their mother thinks that you should trade one way or thinks you should do, stock trading one way, and they all never make money, right? So we have to be the complete, black sheep and think completely different. And so I think that book, Reminiscence of a Stock Operator, is a great story about that.
Okay, awesome. I've been meaning to read that one actually, so I must get onto that.
That's a quick read. Yeah, quick read.
Great. Knowing everything you do now, what would you have done differently come day one?
Man, I wouldn't have lost money the first week. If that was easy, I wouldn't have done that. Because maybe I would have had more money now. I think I would have taken myself out of the game emotionally with trades a lot earlier than I did. Because I think and people, we all get into this, right? It's like you make a bad trade, and like a long time ago, I made a bad trade in Chipotle. And I'm like, I'm never eating another burrito again, right? Like, like I hate the company. I hate the stock. I don't even want to look at it. And you got to take yourself out. So if I had to go back, I'd say, you know what? I'm going to take myself out of the game. I'm going to follow my rules. I'm just going to be consistent and persistent about this and do what I know is going to work.
All right, awesome, man. Kirk, so many good answers there. I think listeners will take a lot away from that. So before we leave, do you want to maybe let us know where listeners can connect with you and find out more about you and your services?
Yeah, so they can obviously find me on optionalpha.com. And what I was going to say is what I'll do today is there's a series of 4 videos that I publish that are not anywhere else on the website. And so what I'd like to do is that if anybody's listening to your show, they can go to optionalpha.com/chatwithtraders, and they can get those 4 videos that I don't publish anywhere else. They're about 30 minutes each, and they go through kind of the whole process in my framework for trading options. So it'll be just for your listeners. So again, they can just go to optionalpha.com/chatwithtraders.
Man, that's awesome. Thank you very much. I'm sure the listeners will definitely appreciate that one.
Yeah, man.
All right, Kirk. Well, we hope to have you on again. And until then, take care.
All right, buddy. Thanks, man.
You've come to the end of this episode of Chat with Traders, but don't worry, more great episodes are on the way. To stay updated with each great new episode, be sure to subscribe to the podcast in iTunes, and we'd love it if you leave us a rating and review. We'll see you next time on Chat with Traders.
Every decade, the market reinvents itself. Online brokers opened the doors. Mobile apps made trading seamless, and commission-free trading erased barriers. Now, a new era has begun. Meet Trade the Pool. Limited risk trading. From now on, your trading risk is capped and your trading opportunities are limitless. Trade the Pool funds home-based stock traders with up to $200,000 in buying power. That means you can trade large positions and scale your strategies without risking your own savings. It's time to trade with more capital, actually worth more of your time and effort. Ready to trade the pool? Click the link in the description and join Stock Trading Revolution today. Doesn't your portfolio deserve the best? Then join Tasty Trade, Investopedia's best platform for options trading 2026. Trade smarter with advanced charting tools, backtesting, a pre-built strategy selector, and more features. Join Tasty Trade today and earn a double commission rebate up to $3,000 total on your stock and ETF option trades for 30 days. Visit tastytrade.com/chat for more info. All applicable regulatory, exchange, and clearing fees still apply. Options involve involve risks and are not suitable for all investors. Learn more about Tasty Trade promo terms and conditions at tastytrade.com/double. Offer expires May 31st, 2026. Tasty Trade Incorporated is a registered broker-dealer and member of FINRA, NFA, and SIPC.
The biggest secret of the best traders in the world is that they're just like everyone else. However, they've worked hard to learn the markets and discover what works and what doesn't. But how can you hear about these journeys and get in on the strategies and tactics they use? You can do it by listening to Chat with Traders. Here's your host, Aaron Fifield.
Hey, what's going on, budding traders? Thanks so much for joining me on the third episode of Chat with Traders, the podcast that brings you in-depth interviews with consistently profitable traders week after week. Now, I'm excited to introduce today's guest, who has well and truly found his niche, dominating penny stocks. His name is Timothy Sykes, and it's no secret that he turned $12,000 into roughly $2 million within the space of just a few years, making him a millionaire by the age of 22. With that in mind, it's safe to say he could teach us all a thing or two about trading. So that's why I brought Tim on the show today to take us inside the world of penny stocks. Throughout this interview, you will learn how many of these stocks move, some of the things to watch out for, and also the key benefits that can come from trading penny stocks. Make sure you listen all the way through because Tim has a really cool offer exclusive to listeners of Chat with Traders. All right, let's get into it. I'm Aaron Fifield, this is Chat with Traders, and here is our guest, Timothy Sykes. Hey Tim, so great to have you here. I've really been looking forward to this, so thanks for coming on.
Thanks for having me.
It's great. So let's go back in time to how you got started. You started with a $12,000 account and turned it into a couple $1 million just within a few years, which is mighty impressive. But before you made a great success, what was it about the stock market that appealed to you?
I'm Jewish. I like playing with numbers. I was raised to believe in financial security. So the stock market was always kind of in my life, not for trading purposes, just to kind of know about how it works. And, I wanted to be a mutual fund manager when I was growing up. I thought that would be a nice way to, grow a portfolio, get paid year in, year out. It was a nice, steady job. And all you had to do was research stocks. So when I was a teenager, I began researching stocks and I began investing. For the first few months, the stocks didn't do anything. So I was like, this job sucks. So I got into penny stocks and they really were moving fast. In my account, senior year of high school, I grew from 12,000 into 120,000, which was a lot of money for me back then. So, it was just understanding that you need money in this world. You can be a hippie, you can just say, oh, all you need is love, but money makes your life better. It's good to have financial security. So that's what really got me into this.
Absolutely. No, that's great. So you were let loose into the markets. How did you know what you were doing? I mean, I believe your knowledge was pretty limited when you got started.
Yeah, it was all just trial and error. The educational business that I have now is my first thought every morning is to be the mentor to people that I never had because it was scary. I didn't know the rules. I didn't know what stocks to buy. I didn't know how much to use in a position. I didn't understand anything. So I really just learned trial by fire and growing the account. It sounds nice to turn 12,000 into 120,000 in a year, but I had no idea what I was doing. I had some basic pattern recognition abilities. I learned that, okay, this strategy works, other strategies don't. But I would have 20% drawdowns or 30% drawdowns and not understand. My parents thought I would lose everything. So I would say number one thing is that you have to start understanding how the market works. And if you can, get a mentor, somebody who's going to pass down their lessons over time so that you're not totally lost.
Absolutely. That's a good call you make. Going back, was there anything you really struggled with that stands out?
I was very fortunate to start right during 1999, 2000. So I had an easy market. I struggled with dealing with all the money that I made really so quickly. I was trying to extrapolate it. It's like I was comparing myself to NBA players. I'm like, okay, this freshman year in college, I made $700,000 in 4 months. And I'm like, if I can make 700 grand every 4 months, then I'm, making 2.1 million a year. Wait a minute, Scottie Pippen makes this. And like, I just didn't understand that where I was in the history of the world, in the world's biggest stock market bubble. And I had ridden it, and I had ridden it well. So I was really kind of screwed up in the head making so much money so quickly. And it's a miracle that I didn't lose it all at first or ever.
I mean, it's not a terrible problem to have. It could be much worse.
It could be much worse, but it's also like a lot of people, really enjoy success over the long term. They work hard to get it. Like, you make an equation in your head. You work hard, you get success. I didn't work that hard, and I had all this success, so the equation was all messed up in my head. I became a philosophy major. I needed therapy.
Yeah, right. So is that when you was there ever a point during that time when you knew for sure you were on track for great success in the markets? Like, it was a realization like that where it sort of clicked and you knew this is what you were meant to do?
Yeah. I mean, sometimes over time I've really refined this pattern that I specialize in. And every time it pops up, it's like, oh my God, it's happening again. Like, I know it. I know how this is going to play out time and time again. And that's kind of crazy because, the whole world is just basically guessing what the markets are going to do, and they don't know. And I have this pattern that has worked pretty much religiously for 15 years. Even now I teach thousands of people, and the pattern still exists. It's still, with these Ebola stocks right now. And just before that, you had the body-worn police cameras due to the Ferguson, Missouri shooting. So it's really beautiful when what happens again and again and again. And it's kind of like, I was meant to do this.
Yeah, no, that's awesome. So let's talk a little bit about your trading methods and your approach. Seen as penny stocks your weapon of choice, what would you say are some of the key benefits and maybe the disadvantages of trading penny stocks versus your more valuable stocks, say $5 and upwards?
Yeah, I mean, first of all, the whole world hates on penny stocks. They're scams, they're evil, they're unethical. So there's so much misinformation out there. Some of them are scams, yes, but you can pretty much spot those. I've exposed a lot of the scams over the course of my career. There are some good companies that you can buy, but the amount of bad and just misinformation out there is overwhelming. When I first got started teaching in late 2007, Investopedia said that what I did, namely short selling penny stocks, was illegal. So I had people emailing me every day, "You're a criminal." I'm like, it's not illegal to short sell penny stocks, but because brokers don't want to deal with penny stock people because there's not a lot of money, most of the people with penny stocks are investing like lotto tickets so they blow up. So brokers are just like, no, it's illegal. And they just shove them off. And people come to me and they say, the broker said it's illegal. You're lying. And I'm like, I'm not lying. Your broker just sucks. So finding a good broker, finding shares to short when I am short selling these scams and betting against them, that's annoying. But the upside is that it's so easy to spot a scam if you just do some very rudimentary research. And the cool thing about the companies that are not scams, they only have like one or two products. So when they do surge, it's very quick. It's very easy. I just wrote a blog post about one of my students. His name is Polis B. He invested $700 on last Friday, and he sold it overnight on Monday. The company, they make thermometers. All they do is make normal thermometers, but they got an order to supply thermometers for an airport to test for Ebola, which is hot right now. And he bought the stock $680 worth at about 8 cents a share. And because of the contract, which has already been announced, the stock was already up from 2 to 8 cents. But because of the momentum, because of the hype, because of the fear with Ebola right now, the stock went to 50 cents the next morning, and he made 7 times his money on $700. So he turned 700 into 5,000. And most of Wall Street will look down on that. They'll say, penny stocks, it's a few $1,000s. But I know so many people who would love to turn $700 into a $5,000 overnight. So I think there's tremendous potential, but it's about getting the good information out there as opposed to just misinformation.
Absolutely. No, that's an incredible win. So I guess just to sort of shorten that, one of the key benefits would be that they can move so quickly and the low price, they're easy to get into for people with smaller accounts.
Yeah. And definitely the fact that,
there's just not that much information. I can't underestimate or overestimate that enough, because people mock this world that I'm in. No real smart people or really rich people are in here. I'm not that smart, and I'm like somehow dominating this little field because it's such low-hanging fruit. Hedge funders don't care about making $5,000 in a day. So, I bring up the analogy, if you're going to play basketball, who do you want to play basketball against? Do you want to play basketball against a midget, or do you want to play basketball against Michael Jordan? And, I'm competing against midgets and I'm like dunking on them again and again, and it's so easy. And everyone else is like, oh, let's trade Forex. Let's trade all this stuff. Be a real man. And you're playing Michael Jordan and you're just losing time and again. So it's about finding easier competition, I think, is a big key to my success.
Okay, no, I like that. So just before we move on, what actually defines a penny stock? And where are these penny stocks typically listed at? Are they on your major exchanges, or is there something different there?
Yeah, I mean, a penny stock is any stock trading under $5 a share. That's the basic definition. Some people say under $1 a share. They're low-price speculative companies. They trade on every exchange: New York Stock Exchange, NASDAQ, OTC bulletin boards, and pink sheets in the U.S. I like NASDAQ and OTC bulletin boards. It all depends. It's just very low-price stocks. It's like if you go to a racetrack and you're like betting on like the 49-1 or 50-1 horse. These are long shots. So that's why they're priced so low. And I don't actually believe in any of their success. I'm not saying, oh, this is the next Microsoft. That's the mistake that most newbies make with penny stocks, and that's why they get crushed, because it's never the next Microsoft. But what I do is I play in and out of the volatility, and making 7 times in a day, that's a little extreme, but Ebola's hot right now. Normally, you can get a stock that's up 50 or 100 or 200% in a day. So there is extreme volatility.
Yeah, okay, awesome. So now you put a big focus on researching stocks. Yeah, I've sort of heard you speaking previously, and I quote, being meticulous. How do you go about researching stocks, and what is it that you're looking for?
Yeah, I mean, with penny stocks, it's either A or B. You're either a scam or you're not. If you're a scam, the reason why I'm interested in you is because scams are meant to be, spiked and manipulated higher. Knowing that gives you an advantage because you know that someone behind the scenes is manipulating the stock. If it's not a scam, then the question is, can, their story or their numbers really interest the public to get the stock up? I'm not interested in stocks that go down. I only want to play stocks that go up. And, when stocks go up, I can either buy them if I think the story has room to run, or I can short sell them after they're already been manipulated higher. And I think that the story or the manipulation is ending and it's going to come down. So I'm always looking for the hottest penny stocks in the world, and I'm just trying to judge, should I buy them or should I short them? It's pretty simple.
Okay, cool. I've heard you speak about doing research on a company's SEC filings to help you determine whether or not these companies could be running a scam. Can you elaborate a little more on how they might possibly be a scam?
Yeah, I mean, scam, I'm not a lawyer. I don't look to say, oh, what they're doing has violated this section of the law, legal code. But when I say scam or pump, it's a question of why do all these insiders or promoters have shares, millions of shares at like a half a penny a share or 2 cents a share, and then they're sending out mailers or tweets or voicemails sometimes or faxes or press releases, just trying to get the stock price higher. So in the SEC filings, you look and see who is it benefiting if the stock really spikes. And what you find is by looking at these SEC filings, you have all these sketchy characters, and it's kind of like the usual suspects. It's the same people again and again, and they hire promoters or investor relations, and they get the stock up so that they can basically dump it. It's a very simple game. It's pump and dump. So by looking at the SEC filings and just seeing who owns how many shares and at what price, and then you combine that with the knowledge if there's like a mailer out there or if 50 people are tweeting the ticker like new Ebola play, why are they hyping it up? Why is it in their interest to get the stock price higher? And sometimes it's not just insiders who want to sell. Sometimes the company wants to raise money at higher prices. So if your stock is trading at 5 cents a share, no one cares about you. The company might design a 2-week investor relations program where they'll have a press release every single day and they'll get their lowly 5 cent a stock that no one cares about, and they'll get it up to 50 cents or $1, and then do a financing at like 20 cents a share with some institutional investor. So that way, insiders can pay themselves a salary, and it's a lot less, less risk of investigation for a pump and dump. Even though the only reason they got the stock up was so that they could raise a financing at a discount price and then pay themselves in salaries. So it's a pretty evil, unethical game, but it's pretty easy to spot if you just look at who owns what and then combine that with, why are they pumping the stuff.
Okay, so let's say listeners have one of these companies on their radar and want to look into it further. How can they gain access to their SEC filings?
I mean, I just use otcmarkets.com. It's a free website, and you can just type in the ticker, and you can type in, you just go to financials and disclosures, and you see all the filings that the company has. And whether it's a quarterly report or, any other kind of report, they disclose who owns what. And, if the company has like zero cash, zero revenues, they have disclosures that their lawyer made them put in saying, oh, we don't have enough cash to exist for the next 3 months. So you have a going concern note. These are all like terrible, terrible companies. Like they have so little, like I have more in my wallet than most of these companies do in their bank accounts. And yet they're still valued at 20, 30, 50, $100 million thanks to manipulation. And because the people who are being pitched these stocks don't read the SEC filing. So half my job is just getting people to like even use the internet. The Wolf of Wall Street was so successful because he did it pre-internet. You would just get a phone call being pitched the penny stock, and you couldn't look on Google Street Maps. I see some of these companies on Google Street View, and they're based out of like one company was based out of a barn in Canada. Another one was like this little shack, and the CEO's phone number turned out to be like a cell phone. Another company, Sponge Tech, which I exposed, I think it was the CFO's fax number was the same phone number as the company's legal counsel. And when the company was eventually busted, they found out the legal counsel didn't even exist. They just had a made-up lawyer. So, like, it's crazy how sketchy and shady this stuff is. But if you connect the dots using the internet and just say in your mind, okay, this company has so little cash, so many millions or billions of shares out there, why is the stock going up? And you can kind of work your way back and say, okay, this is a pump and dump. And pump and dumps, are going to collapse.
Yeah, so pump and dump seems to be a strategy that you've mastered extremely well. So you're profiting. Which way are you trading that typically? Do you aim to trade it up as it's sort of been pumped up, or are you shorting it as the stock's been dumped?
I mean, early in my career, I used to buy pumps. When I first got started teaching, I liked messing with people's minds. Like I would write a blog post. I would be like, why I invested $50,000 in this scam? And people are like, why are you investing your money in a scam? And then that would open the door to me teaching how if it's a pump and dump, it's fine if it's a scam. You risk it being discovered. But back then, a few years ago, the SEC wasn't that hardworking. So you could ride the wave up for a little bit. Now, the SEC has cracked down on this a little bit. Good for them. And so now I predominantly just short sell or bet against the scams, and I try and be there the day of when it crashes 50, 75%. Okay,
sure. So now you typically day trade, so you're in and out the same day. Is that right?
Same day, sometimes 1 or 2 days. It all depends. Like with pump and dumps, it's tough to be there on the exact day. So you have to look for signs of when the pump is like kind of collapsing. So sometimes I give it like 1, 2, or 3 days. I've been early, I've been late. Sometimes I've been dead on. I have a blog post where I show 4 live trades specifically where I'm shorting the stock and it collapses 30%, one of them. Another one collapsed 20%, another one collapsed 50%, and another one collapsed 70%, all in one day. And I was short on every single one of them. So it was kind of awesome.
Yeah, nice one. I'm sure that was a good day for you.
I mean, there are various days, but it's nice to know that there's justice in the world.
Yeah. So, how do you define your exit point once you're in these trades? Is it sort of predefined before you get in, or are you waiting for a signal as it's moving?
I actually suck at exiting. I've been there on stocks like when they collapse 70% or when they spike 70% in a day. I usually I try and take the meat of the move. I try and make my 10, 20, sometimes 30%, and then I move on. I'm a far better teacher than I am trader. So that's why I think I have millionaire students. as opposed to me, you know, I'm up 800,000 in 2014 in trading profits, which is nice considering I spent so much time teaching. But a lot of my students are up, you know, $1 million and $1 million too in this year alone. So, and they have much smaller accounts than me. So I'm better at teaching.
Yeah, that's awesome. Just taking a step back to when you were talking about exposing scams, I've heard you also talk about exposing some celebrities who got behind these. What's the go there?
Yeah, I mean, celebrities, they don't know about penny stock pump and dumps. My message hasn't really reached the celebrities. So like people like Justin Bieber, Shaquille O'Neal, Carmen Electra, Michael Vick, you know, Rudy, the football player. I don't know if Rudy made it to Australia. Have you heard of that movie, Rudy?
Doesn't ring any bells, but that doesn't mean it didn't make it here.
He was an inspirational story for me until he became like a penny stock promoter. You know, they just don't know. They don't understand the game. The celebrities believe in the products that are being pitched to them. So Shaquille O'Neal, like he got pitched this like Splenda, you know, artificial sugar, basically competitor. And I'm sure Shaq tried it. He was like, this is good. They pay him a few million shares. He puts his face on the box. And this company, NXT Nutritionals, I mean, used his face everywhere and said, we're going to take over Splenda because we have this amazing spokesperson. And as it turned out, they would pay grocery stores to put their little artificial sugar on the shelves. So anytime a grocery store would sell their product, they would actually lose money because they have to produce the product and they're paying the grocery store just for promotion. And they would do that because they don't care about how many little packs of artificial sugar they sold. They cared about putting out a press release saying, look, we're in this grocery store, and that would raise the stock price. So Shaq got involved with that. I exposed him. He sent me a cease and desist letter, but you know his stupid lawyer didn't even spell the word egregious correctly. So I wasn't that scared. At first I was scared. Like I have like this, you know, big NBA player going after me. And then I was like, wait a minute, I'm in the right here. And so we replied, I'm like, I'm not taking it down. Same thing with Justin Bieber. You know, he pumped this company. It was a cool technology. It prevented you from text messaging while you're driving. And so I'm sure he was pitched the little product demonstration, like save teenagers' lives. And he was like, cool, I'll promote that. He used his Twitter. He went on YouTube. He promoted this technology. Unfortunately, nobody told Justin that this company didn't own the technology. They just licensed it. They had no cash in the bank. 7 other companies had licensed the exact same technology. They were better financed. And the stock went up when Justin Bieber announced he was a spokesperson, and then it crashed. And, you know, that company sent me a cease and desist letter when I exposed it. And I got hate messages like, you know, Tim Sykes, why do you want teenagers to die while they're texting and driving? And I'm like, I don't hate the product. I hate the company, like red flags. And I would list, there was a blog post, I list like 4 red flags. Like, this company has no fucking money. Like, what's wrong with you? So the celebrities don't know, and it'll happen again because I'm just not that popular. I'm kind of mean. You know, I talk about how like the party is over with these pump and dumps, and nobody likes that. Everyone's like, yeah, Justin Bieber, awesome technology. Don't worry about how the business actually works.
Yeah, that raises another point, which I've heard you speak about previously. So people think the product matters with these penny stocks, when in fact, with penny stocks, the product is actually the stock. Why is that?
Yeah, I mean, it's people get pitched, or suckers get pitched the product, you know, of the stock, and they think that they're investing in the story. This is just classic, like, misdirection. And I wish more people would understand that. And that's why I teach. I really hate seeing this misinformation. I hate seeing people with a few $1,000s to their name. This is why penny stocks are hated. Not because penny stocks are evil, but because the way that they're marketed is evil. And that lures in a lot of people. And, you know, those people hate penny stocks. They don't understand that they shouldn't be hating on penny stocks. Don't hate the game. Hate yourself for being so stupid. You know, if you were more informed, and this is what I told the SEC, like, I'm trying to get the SEC to do more investor education. I was like, by halting these penny stocks, sure, like, you stop this scam, another scam is just going to pop up. Why don't you do a whole educational program to investors and traders on how this stuff works? And that way, if they get marketed to, they're not going to fall for it. So you're going to stop the whole process rather than stopping one scam at a time, which, you know, it's never ending. But no one really listens to me. I'm just like the guy who's like, penny stocks are awesome.
The bearer of bad news.
I'm not a fun guy. I tell the party is over. I tell people they have to study. They have to read these fucking 70-page SEC filings. I understand what I teach is not fun. That's why I show pictures of my Lamborghini and my Miami mansion, and then, people are happy. So I have to show them the carrot at the end.
Yeah, the results. I mean, finance can be a pretty boring topic, I guess. So, got to put a bit of life into it.
Yeah, I mean, especially penny stocks.
Are you ready to get serious about options trading? Then join Tasty Trade, Investopedia's best platform for options trading 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including a $10 cap per leg on options trades, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, and more features to help you trade smarter. Manage your positions with speed and precision using Active Trader Mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Join Tasty Trade today and earn a double commission rebate up to $3,000 total on your stock and ETF option trades for 30 days. Visit tastytrade.com/chat for more info. All applicable regulatory exchange and clearing fees still apply. Options involves risk and are not suitable for all investors. Learn more about Tasty Trade promo terms and conditions at tastytrade.com/double. Offer expires May 31st, 2026. Tasty Trade Incorporated is a registered broker-dealer and member of FINRA, NFA, and SIPC. Ever watched a stock explode and thought, if only I had the capital, or sat on the sidelines because your account balance felt too small to matter? Good news. With Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, and even the newest IPOs, and short anything you like with zero locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. It's a game changer. Create your account and start trading real shares within minutes. No subscriptions, no minimum deposits, just a one-time evaluation fee starting at $47. That's it. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you ever pay a cent. Every decade, the market reinvents itself, from online brokers to commission-free trading. Now, the new era of limited risk trading has begun. Click the link in the description to start trading with Trade the Pool's capital.
So, sort of getting into a little bit more about your strategy, I mean, I think it's probably safe to say you wouldn't be where you are today without some sharp risk management. So, tell us, how do you manage your risk and, go about cutting losses?
I mean, you have to cut very quickly. It's not an option of cutting losses like just gradually, because with these penny stocks, they have, one, big loss and they're just crushed. Newbies can get crushed so quickly by believing in these companies. So I'm kind of like this lost Nazi. And that's what I have to do.
Yeah, right. Okay. So Tim, now that you're involved in the education side of things, where do you often see entry-level traders slipping up, and what would you say to them? Like, what's one of their biggest downfalls?
I mean, they don't cut losses quickly. I accept the fact that I'm wrong so much of the time. And if I'm wrong, I just get out. And newbies are scared of the stock market. They're scared to lose, but you shouldn't be scared if you're willing to just lose a little, Newbies don't think like that. They think like, I have to win every single time, and that's wrong. Cutting losses very quickly is good.
Yeah, so I mean, you sort of let your profits run when you have a good trade, and then when it's not going so good, you've got to cut your losses quickly and get out of there. What is it that you believe stops the majority of traders making a huge success in the markets? Like, there's the figure going around that sort of 90% of traders fail and that type of thing. Why do you think that is? I mean, are they deterred by the hard work and dedication it takes, and or are they just not cut out for it? I mean, what is it?
I think anybody's cut out for it. I think what it comes down to is, just discipline and going in with a game plan. Newbies and a lot of failed traders, they don't have game plans. And if they did, they didn't stick to it. If you are very, definitive in your plans, I'm no different than a driving instructor. If you're driving a car for the first time and you're not adhering to red lights or stop signs, driving is very scary. You'd just be driving 100 miles an hour in like a 20 mile an hour lane, and you're not even in the lane, and you're going to crash. But if you understand, okay, you need to stop here, you need to pause, you need to take smaller positions, you need to cut losses quickly. If you follow that, then, it's not scary at all.
Right. So those are the type of things that should be included in a trading plan?
Yeah. I mean, you need a plan. And that's why I say, learn from a mentor, because once you learn from a mentor, then you're good.
One of the areas I don't think we've covered just yet, and that is the emotional side of trading. Do you have any tips around this? And in addition, how to keep your confidence up, especially after a few losing trades?
I mean, if you cut losses quickly, you're never really in that position. But every now and then I get undisciplined too. I think that what you have to do is just take it one trade at a time. If you do get on a losing streak, then trade smaller, or paper trade, or don't trade. Don't try and get all your money back right away and be like, okay, I'm down, but let me go bigger now. Because your mindset is not there anymore. Like you kind of just had like a bad breakup.
Just setting yourself up for failure if you're sort of taking that approach. So anyway, Tim, that's great. You've given the listeners a lot to consider and heaps of great pointers. So that's great. Thank you. Which is bringing us towards near the end of the interview. But before that, let's go to the closing bell. So these are just a few short questions, then sharp answers. So let's do it.
Sure.
What's the best piece of advice you've ever received?
When I was 23 and I was trying to raise money for my hedge fund, and one guy was like, no, you have a great track record, you have a great strategy, but you're not scarred yet. And I was like, what are you talking about? I had never lost any big amount of money back then. And he was dead on right. And I, later made a mistake. I tried investing. I didn't follow my trading rules, and I lost roughly 35% of my hedge fund. And I went back to that moment, and I was like, now I'm scarred. Now I know to be conservative. So sometimes you can say you don't want to take a big loss, but once you have that big loss under your, in your belt, I mean, then you understand you don't want to be at that point anymore. And it makes you conservative, it makes you wiser, and it's better.
Yeah, so once you experience it, then you truly understand what they're talking about. What is the number one trading resource you couldn't live without today?
Twitter. Twitter has gotten very, good at breaking news and just sensing where all the traders are with tickers and everything.
Awesome. Tim, what's one book you believe is essential for any trader just starting out?
The Psychology of Trading by Dr. Brett Steenbarger. I think that's an incredible book. Newbie traders probably won't understand it, but it's very useful. They'll just buy it and you'll read it eventually. If you make it past newbie state, it'll help you understand, how to control emotions and risk reward and everything.
Awesome. We'll put that in the show notes. Knowing everything you do now, what would you have done differently come day one?
I would have gotten a mentor to start. I learned everything on my own, and I learned well, and I've done well, but I could have, really just learned and made a lot of money a lot quicker. So it's kind of bad. I wish I could go back, but I can't. Now I can just be the mentor to people that again, I never had. Yeah,
no, that's great advice. So, Tim, you've got a special offer for the listeners for this interview. So would you like to share a bit more info on that?
Yeah, if you go to profit.ly/guru, we have a bunch of different newsletters from multimillionaire traders, not people who are like hired. I hate these like websites that have journalists who pose as real traders. All of my people who are gurus on Profitly are verified millionaires. And so if you go to profitly/guru and you use the code TraderChat, then you'll get 10% off any of the annual newsletters. So I think it's a pretty cool deal, specifically for your listeners.
Yeah, no, that's an awesome offer. So make sure you head over to profit.ly/guru.
That's it.
All right, awesome, Tim. So again, thanks so much for coming on the show, and tell listeners where they can find out more about you, and then we'll call it a wrap.
Yeah, if you go to timothysykes.com, there's a whole bunch of stuff, and also Profitly is my website, but just Google me. You'll see some fun stuff. It's not just about my website and my trades. I show off my car. I show off my trips. I show off my mansion. that should get you guys inspired to see the rewards of many years of good trading.
Awesome. All right, Tim, thanks a lot.
Thanks a lot, man.
You've come to the end of this episode of Chat with Traders, but don't worry, more great episodes are on the way. To stay updated with each great new episode, be sure to subscribe to the podcast in iTunes, and we'd love it if you leave us a rating and review. We'll see you next time on Chat with Traders.
Every decade, the market reinvents itself. Online brokers opened the doors. Mobile apps made trading seamless, and commission-free trading erased barriers. Now, a new era has begun. Meet Trade the Pool. Limited risk trading. From now on, your trading risk is capped and your trading opportunities are limitless. Trade the Pool funds home-based stock traders with up to $200,000 in buying power. That means you can trade large positions and scale your strategies without risking your own savings. It's time to trade with more capital, actually worth more of your time and effort. Ready to trade the pool? Click the link in the description and join Stock Trading Revolution today. Doesn't your portfolio deserve the best? Then join Tasty Trade, Investopedia's best platform for options trading 2026. Trade smarter with advanced charting tools, backtesting, a pre-built strategy selector, and more features. Join Tasty Trade today and earn a double commission rebate up to $3,000 total on your stock and ETF option trades for 30 days. Visit tastytrade.com/chat for more info. All applicable regulatory, exchange, and clearing fees still apply. Options involve risks and are not suitable for all investors. Learn more about Tasty Trade promo terms and conditions at tastytrade.com/double. Offer expires May 31st, 2026. Tasty Trade Incorporated is a registered broker-dealer and member of FINRA, NFA, and SIPC.
The biggest secret of the best traders in the world is that they're just like everyone else. However, they've worked hard to learn the markets and discover what works and what doesn't. But how can you hear about these journeys and get in on the strategies and tactics they use? You can do it by listening to Chat with Traders. Here's your host, Aaron Fifield.
Hey, what's going on, traders? Thanks for listening to the 4th episode of Chat with Traders. I really hope you've enjoyed the first 3 episodes and ideally learned a few things from the guests that have been on so far. If you haven't, then I think that's all about to change. Today's guest has ridden many waves of the financial markets since placing his first trade in 1985. With almost 30 years of skin in the game, Nick Raj is here to share some of the crucial lessons that have allowed him to not only survive, but consistently profit along the way. In addition to 30 years of trading, Nick also runs a highly successful stock market advisory service, The Chartist. He's also been featured on Michael Coville's Trend Following podcast, appears on Sky Business Channel once a month, and is the author of not 1, not 2, but 3 books. One of the things I really enjoyed about this interview was how Nick went into great detail about many aspects of trading that are not often discussed. I feel as though there's something in this for traders of all levels. Now, before we roll into the interview, please remember to visit Chat with Traders on iTunes and leave a 5-star rating and review if you like what you hear. By doing this, you will help us to reach even more listeners, and the support is really encouraging. With that being said, I'm your host, Aaron Fifield. This is Chat with Traders, and here is today's guest from the Sunshine Coast, Nick Raj. Hey Nick, awesome to have you here. Thanks for coming on the show.
Thanks, Aaron.
So take us back to where it all started in 1985 for you. How did you first discover the markets, and what was it that really appealed to you?
Well, I was an average student in school. I didn't go to university. I really had no idea what I wanted to do when I left school. And a friend of a friend worked at a big stockbroking firm and offered me a job as a clerk there, just pushing paper. I had no interest in the stock market or anything like that at the time. But it was a job in the city, so I went along and quite enjoyed it. As I said, it was pushing paper. It wasn't anything to do with the markets. But I had a stroll through the private client desk or private client area of that stockbroking firm and came across a gentleman who had some chart paper and was drawing some red and blue lines on that chart paper, and it just kind of intrigued me. And I asked him what he was doing, and he showed me, and basically it was a 5 and 10 day moving average crossover strategy on the share price index futures. And I could just see the trends right there. He was saying when one crosses over, you buy, and when it crosses back, you sell. And, back in 1985, it was a pretty strong bull market, so there was some nice trends showing there. So by the end of the day, I kind of had gone down to the stationery shop and bought my own chart paper and red pen, blue pen, black pen. And from that point, I just started plotting it. And I don't know what it was, but something just clicked and it made sense. And then a few weeks later, I went into the old wily office manager and asked him if I could set up a trading account to trade futures, which was quite stupid in hindsight because back then the SPY was $100 a tick. And I was only earning about $12,000 a year. So he kind of frowned a little bit and said, okay, well, so long as I sign off on each ticket. And that's how I started trading.
Okay, excellent. So you were right into it. What were some of the early setbacks you encountered? So you were trading your personal account straight away. You weren't at the firm as a trader at any point, were you?
No, absolutely not. They didn't have any trade. Well, they did have some traders upstairs on the money market desk, and that's the paperwork I was pushing there, kind of trading activity. But on the floor that I was working on, it was just all brokers. So they had retail brokers and they had institutional brokers, and I never really had any inspiration to go that way. It was just all kind of happening around me, and it was just interesting.
Sure, okay. So once you did start trading with your own personal account, how did you go with that? Were you sort of a bit of beginner's luck, or was there, some early setbacks and expensive learning lessons in there, or how'd you go?
Yeah, well, back in 1985, it was very different to what we have today. I mean, obviously, we didn't have the internet back then. We didn't have the myriads of courses and seminars and books and trading magazines and data and software and all the stuff that you have today. Back then, I remember vividly, the only way you could get a real trading book was request a catalog from the US, which would take 3 weeks to get to you. Then, it was a little black and white catalog for books, and then you'd send one off, and 6 weeks later or 8 weeks later, a book would turn up in the mail, and that was predominantly it back then. So I had no idea what I was doing. I had no money management, nothing. All I had was a 5 and 10 day moving average crossover and a bull market, and that's where the luck came from. I guess my early setback was just when a little bit of greed set in. Back in those days, you had a 2-week settlement period. If you bought a share, you didn't have to give anybody any money for 2 weeks. And of course, the share market back then moved a long way in 2 weeks. So we found a little bit of a loophole, if you like, and started trading in and around this loophole where you didn't have to pay for your shares for 2 weeks. And after you make a little bit of money and you seem to be making this free money, then you just get bigger and bigger and bigger. And of course, then the 1987 stock market hit. So I learned a very, very expensive lesson very, very quickly. But young and stupid and not knowing what I was doing, that's what was to be expected at some stage. So after that, I didn't do any trading for quite a number of years.
Okay, sure. So what sort of led you back into it? After that, those few years, did you go out, get an education? How'd you sort of ease back into it?
Well, by that stage, I was actually working in the business. So I started off in the back office, as I said, but then went down to the trading floor of the Sydney Futures Exchange. And down there was different kinds of traders. You obviously had the scalpers and the day traders. And then you also had a lot of institutional traders, bank traders coming in, mainly putting hedges on and that kind of stuff. And then you also had the big funds. And back then, really, it was early days for the hedge fund industry, or the CTA industry, as it was back then. And we used to see their business come into the pit, and I was quite intrigued because they were 100% systematic in what they were doing, and I'd never been exposed to that before. And that really interested me because they were obviously running computer models, and that's where I started doing a lot more work and a lot more research. We had a gentleman, Gordon Manning, in our office who had a computer that you were able to backtest on. And I remember going in after work each day and sitting in this room and plugging stuff into this computer. And back then, you'd push the button and close the door and have to come back in the morning, sort out all the paper because it would just spit out paper, and then go through all the backtest results. So it was the combination of seeing these big systematic trend followers come into the market and what they were doing, and also having access in the office to a computer that you could do some back testing with. And that's how it really got started for me again.
Okay, so it sounds like a lot of it was sort of self-taught to a certain extent.
Absolutely, 100% self-taught. Yeah, I have no formal qualifications in any way, shape or form. As I said, I didn't go to university. I've never done any kind of technical analysis courses or any trading courses or anything like that. 100% self-taught. And it's all from being involved in the business, both personally and professionally, and with a passion. I think that's the key difference right there. I think you've got to have the passion, because if you have the passion for something, you will find a way to make it work.
Absolutely, yeah, no, I agree with that one. That's a really good point you make. So let's sort of talk a little bit about your trading style. You define yourself as a trend-following trader. So how do you describe that? And what are some of the benefits of it versus sort of the other sort of trading styles out there?
Sure. The easiest analogy I can come up with for trend following is like being a hitchhiker. And we're not predicting the market, we're not analysing shares, we're not using any fundamentals in any way, shape or form. At the end of the day, any kind of trading, whether you're a fundamental investor, value investor or whatever, the profit is made from price movement. Price has to move from A to B in order to generate a profit. That is the bottom line. It doesn't matter how it gets there, what drives it, but in order to turn a profit, price has to move from A to B. So as a trend follower, that's all we're actually interested in, following the trend from prices moving from A to B or B to C, wherever it may be. And if we use the analogy, I guess, of a hitchhiker, let's say you're in Brisbane and we need to hitchhike to Cairns, which is in the north. So the first thing we're going to do is stand on the northbound lanes of the Bruce Highway. For the simple reason that a car that is going to Cairns is more likely to be travelling in the northbound lane than in the southbound lane. So with the stock market, what we do is we position ourselves in the right direction of the price movement right there. The next thing with the hitchhiking analogy is that we don't know what car is going to stop, but if we stand on the side of the road for long enough, we do know a car will eventually stop. And same with the stock market. We don't know what stock is actually going to go up, but we do know somewhere, sometime, a stock will be going up. And then once we jump on board that ride, we don't know where it's going to stop. So for example, if we hop on a ride in Brisbane, we don't know if it's going to stop here in Noosa. We don't know if it's going to keep going to Rockhampton, Townsville, or maybe if we're lucky, it'll go all the way to Cairns. And same with the stock market. We don't know how far the share price is going to go, but we will stay on that ride so long as it keeps going in the right direction. And as soon as it turns around, we will hop off. The basic premise of how we make money, therefore, is that when we get on a ride that lasts a long time, we make a lot of money. And when we get on a ride that doesn't do well, we only lose a small amount of money. So, look, we may only get it right 50% of the time. And to the average person, that probably doesn't represent a great deal of success. But mathematically, we make a lot more money on those 50% that we're right. We might make, $3 on each one. And when we're wrong, we only lose $1. So mathematically, that's how we make money. And in my view, that's the easiest concept to understand. It's the easiest way to actually generate money in the markets. Psychologically, it's a little bit difficult because these rides don't come along every day. The stock market especially offers, quite high correlation. So you will have periods of time where lots of stocks are moving very, very well and you make a lot of money. But then there will also be periods of times when the stock market's kind of moving sideways and some of those rides aren't available. And that can be very, very frustrating. But you've got to take both sides of the equation. That's just the way the world works.
Absolutely. Yeah, you described that really well. I might just backtrack a little bit there. You mentioned when you trade, you only lose a small amount. How do you ensure that is only a small amount? Have you got your stop losses in order before you even enter the market? I mean, how do you determine that you're only going to lose that small amount?
Sure. Well, everything we do is planned in advance, and that planning comes in the format of some kind of a formula or mathematical equation. So we might say something very simple that we're going to buy this stock, let's call it stock XYZ. We will follow the ride so long as it moves up. But if it moves down against us by, let's call it 10%, then we will exit that position. So 10% loss sounds like a lot on an individual stock, but that's why we buy a portfolio of stocks. So in reality, each time we have a loss, it only represents 0.5% or maybe even 0.8 of 1% of loss of our trading capital. So all our losses are very, very small. But if that stock keeps moving higher, we might make 10%, 20, 30, 40, 50, 60. Sometimes, just recently we exited a trade in the Commonwealth Bank where we finished up with an 87% profit. So from the amount we win can sometimes be 4, 5, 10 times as much as the risk on the trade. And so long as we keep doing that over the longer term, we'll always be ahead.
Of course, yeah. It's all about winning more than you lose, so...
That's right. And the stop loss doesn't have to be anything complex. I think people like making things complex, but it doesn't have to be. The key trait here is, one, to remain invested when the market is going up and revert to cash when it's going down. That's a key component. And second of all, making sure your profits far outweigh your losses over the longer term. And that's the bottom line. It doesn't have to really be any more complex than that.
Yeah, I've heard you say that trading is really simple a few times in sort of different talks you've had and that kind of thing. Why do you think that people sometimes overcomplicate it?
Oh, definitely. I think people believe that, well, it's not necessarily that they overcomplicate it. I think that people don't understand that it's not a linear journey. It's not something that's going to make you money every day, every week, every month, every year. Nothing is like that in the world, It doesn't matter if you invest in property. It doesn't matter if you're a fundamental or value investor. I mean, Warren Buffett does not make money every day, every week, every month. In fact, Warren Buffett does have losing years, and sometimes he has significantly large losing years. It's a fact of life, but I think what happens with a lot of people is they have some kind of vision of a professional trader, makes money every day, every week, every month, and every year. And look, I'm sure there are people out there that do that. But by the same token, you can be very successful and you can make a lot of money and become very, very wealthy without that. It's just not necessary. The eighth wonder of the world is compounding. And that's how Warren Buffett has become so wealthy, not because he makes 100% returns every year. His annualized return, over the last 15 years has only been about 8 or 9% a year. And that's just not true. But they tend to be a lot more impatient and want things quicker. And they tend to be the ones that fail. And then you've got the, more mature, been around the block, middle-aged kind of people that realise that the secret to success is being there for the long term, not necessarily making a lot of money very, very quickly. So patience is very, very difficult for a lot of people to come to.
Right. Yeah. No, that makes a lot of sense. Something else I've heard you talk about a few times also is your way of viewing trades as quantitative versus qualitative.
Yeah.
Do you want to maybe shed a little bit of light on that? Because I thought it was really interesting and probably something that isn't talked about as much as maybe it probably should be.
Sure, absolutely. Look, I don't know too many people that talk about it at all. I presented this back in 2009 at a conference in Melbourne, and to me, it's a significant part of the whole equation. So we've got two sides to trading. The first side we can call quantitative, and these are hard and fast rules that you will read about in any book, in any seminar that you attend, or anything like that. And it probably represents 95% of all material on trading out there. So as an example, let's use something like don't risk more than 2% of your account, okay? It's a common rule, fixed fractional position sizing, it's technically known as. Everybody talks about it. It's in all the books. It's something that you can actually replicate. A moving average crossover, for example, would be another quantitative trait. It's something that you can replicate, you can physically see. Anybody can do it. Anybody has access to it. So anything you come across in a trading book that you can do would be called a quantitative trait. Okay, and most people believe that's all there is to trading. So if we, cut losses, let profits run, buy breakouts, trade a trend, well, I'll be successful. Well, that is the case from a quantitative perspective, yes. But then we have what's called the qualitative perspective, and this, I believe, is the difference between professional traders and amateur traders. Qualitative is, let's use the analogy of driving or teaching a teenager how to drive a car, okay, which is something that I've recently been through. So the quantitative sides of teaching a teenager how to drive a car would be put your foot on the brake to stop, put your foot on the accelerator to go forward, turn the wheel to the left to go left, turn the wheel to the right to go right. Things that your teenager can physically actually replicate and do. So that's the quantitative. With the qualitative, it's things like how do you teach a teenager to understand a dangerous situation on the road, okay? As we have experience, we can feel when a situation is dangerous. We can feel that the traffic is getting faster and closer and whatever. But how do you teach a teenager that when they don't have the experience, they don't have the feel? How do you teach a teenager that during wet conditions it's going to be very slippery, you've got to slow down, you can feel the car sliding, if you like, you can feel that situation getting out of control. These are qualitative things. And when we talk about trading, we're talking about how do you teach someone that you've got to have 10 losses in a row. You can tell someone you will have 10 losses in a row, but the feeling of having 10 losses in a row, then getting another signal and thinking, gee, do I take this signal or not because I'm not feeling very good about this strategy, is a very, very different thing, and you cannot teach that. So the qualitative traits are things that you can't really teach, and these represent the hurdles that most people get stuck on. So, for example, most people think trading is linear, i.e. they make money every week, every month, every year, but that's not the case in reality. So even if you have the most profitable trading system, you may still have a losing year. Now, it's very difficult to place trades every single day, every single week, every single month for a whole year and have a losing year because you haven't been paid for your effort. But this is what people need to understand will be the case. So the way I get over these kinds of things is that I research how the journey is traveled by many traders before me. So you can access the track records and performance reports of many great traders going back for 20, 30, 40 years. And you can have a look at them. There's a gentleman in the US, David Drews. He has been trading since 1981. He has an annualized return of in excess of, I think, 17% after performance fees have come out. Now, that is an exceptional track record, but you can go back and have a look at his monthly returns every single year through to 1981, and that gives you a good understanding of what he has had to go through in order to achieve that very good return. And I don't think that's what most people will not do. They don't accept that you can be one of the world's best traders and have a losing year. In fact, someone like David Drews, from memory, I think he's had 5 or 6 losing years in his career. But people don't view a losing year as a trait of a successful trader. So as soon as you come to understand that that is actually the reality of it all, then you're in a much better position to be able to deal with those hurdles when they come along. And they will come along. They come along for everybody. So I think people have the wrong view of the world. Obviously, many people have been fed incorrect information, but you can go and access the track records of these great traders. Even Warren Buffett, you can go back and take a look at his returns, see what he's been through. Let's have a think back to Warren Buffett, the great example in the late 90s when he rejected investing in tech stocks. Back then, everybody said that, he'd lost the plot. He's had his day in the sun. It's all over. But at the end of the day, it didn't matter. It didn't affect his long-term return. So I think the qualitative traits, things that you can't teach, having a losing streak is one thing. Having a losing period of time, placing 200 orders and not making any money, well, that happens,
We might try and find some of those track records and put them in the show notes because I think they're quite interesting. I was saying, like, when you actually sort of zoom into a certain section, as you mentioned, like 1 year, you can sort of see in the shorter term how it was a losing year, but in overall, as the years go by, it's, a nice up curve.
Sure.
So I think we'll put those in the show notes because they're really interesting.
Yeah, I mean, a good example recently I was looking at, and certainly added in there, Campbell & Co. is a big fund in the US, and they manage over $2 billion. So it's not small cheese. I mean, it's big money. Now, they have had a number of years of going sideways, but they've been in business since 1971. They don't change what they do. They just accept that that's part of the journey. And I guess if we look at that in real life, outside of trading, let's think of something like airlines. Let's think of something like Qantas. I mean, at the moment, I'm pretty sure you can walk down the street and most people would tell you the last thing they want to own is an airline stock. But we don't see Qantas getting into iron ore mining, or we don't see them getting into any kind of technology or into banking or anything different. They're an airline. That's what they do. But they understand that sometimes the airline business goes through good periods and bad periods. They don't change what they're doing. Jerry Harvey with Harvey Norman. Retailing goes through good periods and bad periods, but he doesn't change his business model just because of that. We can look back to the GFC, and the last thing you wanted to be was a bank. But they endured, they got through that, well, most of them did anyway, and now they're all still very, very successful companies. They didn't change their business model. So I think what happens when most people come to the trading arena with the qualitative trades, when things get a little bit tough, they change direction completely and they go for something else. And that roundabout, if you like, just going around and around in circles, looking for the Holy Grail, is what actually undoes them in the long term.
Yeah, they get stuck on what you've called the beginner's cycle.
Exactly right.
So there must be a point when, you talk about riding out these losing streaks. Some people say, if you take 3 or 4 losing trades, you need to stop, step back, reassess what you're doing, and, maybe back test for a while, paper trade, just whatever that might be. You're sort of saying that you just sort of got to push on through it, just keep pushing that button and executing as the opportunities come up. Is there a point when you sort of got to step back and say, this isn't working?
Yes, you've got to firstly and foremost, before you even start trading, is understand why your strategy will make money. Okay, that's the key right there. If you don't know why your strategy is making money, then you're going to find it very difficult to keep pushing forward when the time comes. So, for example, let's take a basic trend following strategy that trades long only in equities. Okay, so we know that our mathematical expectancy is creating by riding trends and cutting the losses short. So that's how we make money. But we can also intuitively know, that sometimes the stock market will go through periods where it's either going down and we may stay in cash, or it's trendless and goes sideways and we have a little bit of a whipsaw. Now, that's something that's happened in the small ordinaries here in Australia over the last couple of years. The small ordinaries is basically at the same level as it was 4 or 5 years ago. So it has been trading sideways. So there are small windows of time in there. I remember the last quarter of 2010 as an example, where in a 3-month period of time, the trend following model made about 24% return. And for the other 8-9 months of the year, it did absolutely nothing. So most people I've come across would be pretty happy for a 24% return, no doubt about that. But most people also come across are not happy sitting there for 8 months waiting for that great 3-month period to come along. So to get back to your question, you have to know why your strategy makes money. That's the key. If you're doing 10 different things and you have no idea why that is making money, then you've got to change that. You've got to understand why. And once you understand why your system will make money, then you can start to answer questions as to why it's not doing so well during those periods of time. So again, I know why a trend following model in the resource stocks wouldn't be doing particularly well at the moment, because the resource sector is underwater and going down. It doesn't mean the model is broken. It just means that it's out of sync with the market, and one day it will come back into sync. So what a lot of amateurs try and do is avoid those periods of time, whereas a professional doesn't avoid them. They accept that that's part of the journey. And rather than avoid those periods of time, what you should do is add a secondary or a third system or strategy to the mix, so you have different strategies doing different things that make money in different environments. I think a lot of people want to avoid the pain completely. I mean, I guess that's natural human tendency to avoid the pain. But rather than avoid the pain, what you should do is keep pushing through and add more strategies to the mix to diversify.
Okay, so when you say strategies, what do you mean by that? Like learning sort of extra buying signals, or looking for different patterns and setups? Do you want to just elaborate on that a little bit?
Sure. Yeah. So personally, for example, my core strategy in the Australian share market is the trend following model. Okay, that is my core exposure to the Australian market. It's a breakout model, which means we buy strength, sell weakness. It has an average holding period of 6 to 8 months, and we tend to trade small cap stocks outside of the ASX 100. So that's the basic premise of that model. Then in the US market, I also run a short-term mean reversion strategy. So very different in many aspects. One, it's trading the US market, specifically the S&P 500 stocks, so a completely different market. Second of all, it's trading a completely different style. Rather than buying breakouts, it's actually buying dips. So it's buying into weakness rather than breakouts. It is doing a lot more frequent trading. So we do 800 to 1,000 trades a year in that strategy, which gives us a little bit more consistency rather than the 25 odd trades in the trend following model. And lastly, the average hold time is only 3 days. So you're diversifying across different markets, different time frames, different styles, all sorts of different things. And you're getting a completely different return profile than you would with a trend following model. So rather than, and last year is a very good example. So last year, I think the trend following model that I use in Australia, I think had a minus 12% year, one of the first losing years we've had since the GFC. Now, a lot of people would say, well, that's not good enough, I'll go on to something else. Whereas that's part and parcel of the journey we're trading. But the US model, or our US models, made anywhere between 22 and 45% return last year. So one model in one market didn't do particularly well, but over the longer term it will be perfectly fine, whereas the other model did exceptionally well. And that's what I'm talking about. I haven't avoided the drawdown. I haven't said trend following doesn't work anymore, and I'm not going to do that. So it will always work. It has to work. Stocks have to trend. They can't not trend. But they can go through these periods of time where we go sideways. So rather than avoid that 12% negative year or take an opinion that the next year won't be any good, I stick with it, but I add other models to the mix that will help diversify.
Okay, cool.
Are you ready to get serious about options trading? Then join Tasty Trade, Investopedia's best platform for options trading 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including a $10 cap per leg on options trades, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, and more features to help you trade smarter. Manage your positions with speed and precision using Active Trader Mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Join Tasty Trade today and earn a double commission rebate up to $3,000 total on your stock and ETF option trades for 30 days. Visit tastytrade.com/chat for more info. All applicable regulatory, exchange, and clearing fees still apply. Options involves risk and are not suitable for all investors. Learn more about Tasty Trade promo terms and conditions at tastytrade.com/double. Offer expires May 31st, 2026. Tasty Trade Incorporated is a registered broker-dealer and member of FINRA, NFA, and SIPC. Ever watched a stock explode and thought, if only I had the capital, or sat on the sidelines because your account balance felt too small to matter? Good news. With Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, and even the newest IPOs, and short anything you like with zero locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. It's a game changer. Create your account and start trading real shares within minutes. No subscriptions, no minimum deposits, just a one-time evaluation fee starting at $47. That's it. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you ever pay a cent. Every decade, the market reinvents itself, from online brokers to commission-free trading. Now, the new era of limited risk trading has begun. Click the link in the description to start trading with Trade the Pool's capital.
I think we may have already covered this a little bit, but just so we're really clear, I mean, you're in the business of dealing with quite a few novice traders. Where would be one of the key areas you see them slipping up? And what would your advice be to overcome these setbacks?
Yeah, it's a great question. There's probably a few areas where people slip up on. Let me talk about two in particular that don't get spoken about a great deal. First of all, commission drag. I think that's a very key reason why a lot of people fail. A lot of people come into the stock market, even when they're well capitalized, they come into the stock market and say, well, I've never done it before. I'll just start with $3,000 or $4,000 and see how I go. Now, when you're paying a broker $20 to buy and $20 to sell, it doesn't actually take a huge amount of transactions to chew up your account or a significant amount of your account. I had a gentleman in the office recently, and he was the father of a friend of mine, and he wanted to buy this whiz-bang trading system that was being sold. And I showed him that he needs to make 22% per annum just to break even. And the simple reason for that was the quantity of trades that this strategy was doing, the broker that he had to use, and the commission drag that the strategy created. He had to make 22% per annum just to cover those costs. Now, I don't care how good you are, 22% per annum is a big, big ask. And if you've never traded before, it's an impossible task. So he had to go away and have a good think about whether he changed broker, which he really didn't have an option, or he included more capital into there so that drag went down. So I think a lot of people come into the business not understand that these peripheral costs can actually chew up the account significantly and make it almost impossible, mathematically impossible, to be successful. I think the other core trait that people fail at is they simply don't understand what the journey entails. And we've discussed this already to some degree. The journey of trading does entail losing trades. It does entail periods of time of losing, and it may entail having a losing year. It's very, very difficult for the average person to accept that they can place trades for a whole year and have a losing trade, or have a losing year. And until they accept that, they're going to find it very, very difficult to be successful in it. Yeah, sure, I would like a strategy that makes money every day, every week, every month, every year, as anybody would, but it doesn't exist. I'm a realist, I understand that. And as I said earlier on, there might be a few people out there that do have that, but I don't, and you don't need that to be successful. I think if people take a longer term view of applying the strategy, rather than micromanaging the strategy and trying to avoid those bad periods of time when they come along, they'll be a lot more successful.
Okay, that's great. This just made me think of something else. You were talking about commissions there. So some people might be paying $20 in, $20 out. That's a $40 round trip. If you take a step back, you were talking earlier also about maybe only risking 1% of your account. On a smaller account, say around $5,000, you can't really buy too big of a position with that. The market's got to move quite a way just to cover your $40 commission. Am I right in saying this?
That's correct. Absolutely correct. Yeah. If you're going to use correct risk management tools such as fixed fractional position sizing or the 1% or 2% rule, first of all, you're not going to be able to actually do too many trades. And second of all, your position size is going to be so small that, yes, the market has to move a phenomenal distance in order to just cover your costs. So I understand that there are certain people out there that say you can trade with $1,000 or you can be successful with $1,000. And look, I'm sure there's people out there that have been, but there's also people out there that win the lottery. But for the very vast majority, the chances of success are very, very low to nothing. So I'm just talking about probability of success. I'm not talking about impossibility. I'm talking about probability. So trading is difficult enough as it is. And there are certain aspects of successful trading that you can control. And one of those aspects is your commission rate. You can go and move from a high-price broker to a discount broker. You can do that yourself. It's common sense to make it as cheap as possible for your own bottom, The second thing is you can control the amount of capital, or you should take responsibility for the amount of capital that you want to put in. If mathematically you start with $5,000 and you want to be a short-term trader and you're going to have to make 40% return just to break even, well, that's your responsibility to remove that. You've either got to don't trade, wait till you've got more money, or put more money in if you can. So it comes down to the responsibility of the individual to make that happen. And a lot of people don't. They go, I'll just give it a go and see how I go. And of course they're going to fail. So it's important to make things easier for yourself, those things that you can control, and that way the probability of success will increase.
Okay, excellent. So just one other thing I wanted to ask you. How do you track your progress? Does it all come down to the value of your account, or do you sort of regularly set goals? Do you document every trade and then sort of reassess afterwards? Do you have any sort of method behind that?
I personally don't. At the end of the day, your account balance is going to tell you how you're going. That's the bottom line. I've been doing this for almost 29 years now, so I get a good understanding of what the market's doing and why my strategies may be underperforming. So long as I understand that, I'm not really concerned about what's going on. If I don't understand why a strategy is performing, then I will certainly look into it further and research that. And look, we have had those incidences in the past. I used to trade a strategy in the Australian market that just seemed to be going nowhere to backwards. And it just made no sense as to why that was happening. So we researched that and went through about 4 years worth of trades, and we found out the problem was the wanted price the price that we wanted to buy or sell at was actually considerably different to the price we actually got filled at in the market. And we calculated that on every single trade we made for that 4-year period, we paid an extra $45. So the bottom line was that slippage was costing us between 11 and 15% per annum. And that comes down to the Australian market just being illiquid. But that's why the strategy wasn't working, because the illiquidity was meaning we were paying away in slippage, but consistently. You know, having slippage on 1 or 2 trades is fine. Having slippage of $45 on every single trade you make, well, that adds to the bottom line considerably at the end of the year.
Absolutely, yeah. No, that definitely soon add up. So, yeah, back testing was very important there. All right, so this sort of moves us towards the end of the interview. So we'll go into the closing bell, which is a series of just sort of short, sharp questions that we ask everyone on the show. So what is the best piece of advice you've ever received?
Yeah, I think understanding why your strategy makes money, that's key. If you don't know why your strategy makes money, you're never going to make it work if things get a little bit difficult. So the more you can understand why your strategy makes money, the better you'll understand the market and why a strategy is not working well during that period of time, and that really helps the bottom line success. But I think a lot of people just throw good money after bad, just punting around, if you like. They don't really have any kind of rhyme or reason, or if they think they do, they don't really understand why it's making money. So I think that's the best piece of advice that I've ever got. Understand why your strategy makes money.
I think that's really important. Very, very, very good. So next one, what does a typical day in the life of Nick look like? What does your daily trading routine look like, if you have one?
I'm a little bit different, I guess, to what the model trader would be. I'm what's called an end-of-day trader, which means I download my data at the end of each day, I run my strategies, place my orders for the next day, and that's pretty well it. I don't sit there and watch prices through the day. I've got better things to do in my life than do that. So generally, first thing in the morning, we run our US strategies and I place those orders. That tends to be done by 8 a.m. in the morning, 8:30 a.m. in the morning. And once that's done, I'm done with the US market until the next day. And then after the ASX bell each evening, I would download the data, run our strategies, place those orders, then I'm done. So that's pretty well the routine. It doesn't take long. Some of our strategies only take 5 or 10 minutes. That seems a little bit difficult to understand for some people, I understand, but it's taken 29 years to get to that point. Everything we do is predominantly automated now. The computer does most things. We simply put our account balance in the computer. It tells us how many shares to buy, where to sell, and it can actually place the orders for us. So we've got that routine down pat.
Awesome. Good one. So what is the one trading resource you couldn't live without?
I would say the one trading resource that I couldn't live without would be the ability to backtest our strategies. I am the kind of person that needs to know what and why the strategy is, how it operates, how it's operated in the past, and that will give me a very good understanding of how it's expected to operate in the future. So the software we currently use is AmiBroker. So I think that's a core resource that I couldn't do without.
Very good. What is one book you believe is a must-read for any trader just starting out?
That's a good question. I think if you're an absolute beginner, Trading for a Living by Dr. Alexander Elder would be a very good start as a very basic introductory book. It's an oldie but a goodie. I think if you're looking to do any kind of basic trading, that would be a great place to start. If you're more specific in your needs, for example, that you want to manage your super fund, be an active investor, well, my book Unholy Grails would be a great place to start because it builds a strong foundation without going into all sorts of other areas. But yeah, those two books would probably be the best.
Okay, great. Knowing everything you do now, what would you have done differently come day one again?
Stick to the strategy. Look, I've fallen in the trap where I warn people today about the exact same thing. The beginner's cycle. It happens to everybody. It's happened to me. I've certainly had strategies and then doubted them and then gone off on a tangent and then come back and thought, gosh, why did I go off on that tangent? Why didn't I just do it? So, I think that you have to find a strategy that suits your personality, understand why that strategy works, and do not deviate from it. Just let it run and let it go. If you find that strategy has periods of time that make you feel uncomfortable, then rather than deviate from the strategy, add other strategies to it to diversify. So I think that's the big key, staying with the strategy over the longer term.
Awesome. All right, Nick, next level responses. Thanks so much for giving up your time to share so much value with myself and the listeners. Before you go, do you want to tell us the best way we can connect with you, and then we'll wrap things up?
That's great. Thanks, Aaron. Thanks for having me. Well, the best place to connect is through our website, thechartist.com.au. We're also on Facebook and on Twitter. thechartist.com.au or via our book, Unholy Grails.
All right. Thanks a lot, Nick. We'll put those links in the show notes below.
Great stuff. Thanks for having me, Aaron.
You're welcome.
You've come to the end of this episode of Chat with Traders, but don't worry, more great episodes are on the way. To stay updated with each great new episode, be sure to subscribe to the podcast in iTunes, and we'd love it if you leave us a rating and review. We'll see you next time on Chat with Traders.
Every decade, the market reinvents itself. Online brokers opened the doors. Mobile apps made trading seamless, and commission-free trading erased barriers. Now, a new era has begun. Meet Trade the Pool, limited risk trading. From now on, your trading risk is capped and your trading opportunities are limitless. Trade the Pool funds home-based stock traders with up to $200,000 in buying power. That means you can trade large positions and scale your strategies without risking your own savings. It's time to trade with more capital, actually worth more of your time and effort. Ready to trade the Pool? Click the link in the description and join Stock Trading Revolution today. Doesn't your portfolio deserve the best? Then join Tasty Trade, Investopedia's best platform for options trading 2026. Trade smarter with advanced charting tools, backtesting, a pre-built strategy selector, and more features. Join Tasty Trade today and earn a double commission rebate up to $3,000 total on your stock and ETF option trades for 30 days. Visit tastytrade.com/chat for more info. All applicable regulatory, exchange, and clearing fees still apply. Options involve risks and are not suitable for all investors. Learn more about Tasty Trade promo terms and conditions at tastytrade.com/double. Offer expires May 31st, 2026. Tasty Trade Incorporated is a registered broker-dealer and member of FINRA, NFA, and SIPC.
The biggest secret of the best traders in the world is that they're just like everyone else. However, they've worked hard to learn the markets and discover what works and what doesn't. But how can you hear about these journeys and get in on the strategies and tactics they use? You can do it by listening to Chat with Traders. Here's your host, Aaron Fifield.
What's up, guys? It's great to have you here listening to episode number 5 of Chat with Traders. Now, before we get into anything today, I just wanted to say a really big thank you to everyone who has emailed in, subscribed, shared with me some feedback, connected on Twitter, left a review on iTunes, all of that. It's been awesome. So thank you and keep it coming. The support is awesome. So if you haven't had a chance to leave an iTunes review just yet, please do it now. It's a great time to do it just while you're listening in. It doesn't have to be anything crazy. Just a single line is really helpful. So today's guest, I'm stoked to introduce to you. His name is Steve Burns. He is undoubtedly a successful trader. He runs an active blog, and on top of that, he has published several books, including the New Trader, Rich Trader series. So Steve is here today to talk about exactly that. What are the traits that separate new traders and rich traders? Tight risk management and a solid knowledge base seem to be two traits that get a regular mention. But over the next 30 minutes, we will uncover much more than just those two topics. So stick with me. All right, let's get into it. Here is today's guest, Steve Burns. Hey, Steve, thanks for coming on the show today. It's really good to have you here.
Hey, thanks for having me, Aaron.
No, you're more than welcome. So, Steve, how's your week been? You been keeping busy?
Yeah, it's been an interesting week in the markets, with getting toppy up here, and been really watching the intraday action to see what's going on. So it's been a very interesting week.
Okay, great. That's really cool. So I've got plenty of notes here and a lot of things I'd love to ask you about. So let's get right into it, eh? So Steve, give us a bit of an introduction and a bit of your background on where did it all start for you and how did you get into the stock market, and talk a little bit about what was the attraction for you?
Yeah, I've always been fascinated with numbers and the stock market itself, really the technical side of how prices move and what causes them to move. I mean, I remember looking at newspapers when I was a child, just looking at the stock tables and the arrows up and down and just being absolutely fascinated by it. I don't remember a time where I wasn't fascinated by the stock market and the daily pricing. So, as soon as I was old enough to have the opportunity to actually start putting money in the stock market, whether it be in individual stocks or in indexes or index mutual funds, I started when I was really 18, 19, as soon as I possibly could. And been growing capital and building capital since I was a teenager.
Okay, so when you got started, I mean, how did you know what you were doing? Where were you learning from?
Well, I started off as an investor, so I really looked at the fundamental side and looked at what companies that I liked and what companies I thought had potential to grow. A lot of time, whatever company I was working with at the time, I would study the price of the stock itself on a daily basis for the price action, and also looked at fundamental earnings growth and what would happen trend wise with the company itself, as if I was looking at like sort of like if you were in high school and you had all the people you went to high school with and you're trying to project which one of them would earn the most money and want to invest in them as a person. That's how I looked at companies. When I first started out, I was more of an investor sort of, but looking at a trend in a future individual stock.
Okay, right. So how did you go in your early days? Did you have, much success right away, or was it sort of a bit of a slow grind?
Yeah, I think I had the unfortunate success of being in the 90s, and I got really more aggressive towards the mid to late 90s with the capital, and I just it became too easy, and I got too lucky with the tech. I was mainly just in tech for the late 90s, so it was very little pullbacks and a lot of exponential growth, especially in the web-based companies. So I sort of got spoiled in the late 90s and then didn't react quick enough in the March 2000 and 2000s. I tried to adjust and kept trying to swing trade to the upside and found out very quickly that stocks don't always go up, and I'm not the genius I thought I was in the late 90s, and I had to really learn how to trade better to survive through 2001, 2002.
Okay, right. So you were sort of kept trying to go long as the market was definitely sort of on the fall. What were some of the other things you might have struggled with early on? Was there anything that stands out as being particularly difficult for you?
Yeah, it's trading too big and being too aggressive, taking too big of a position sizes, because it worked so well and I was so rewarded in the late 90s in tech, and I had to learn the components of position sizing where you don't want to you have enough losses in a row, you end up being 50% down in your account, which I learned the hard way by the end of 2002. So, I learned position size from that point on. I never traded so big again. I traded more controlled position sizing and was really focused on, from 2003 on, risk was my biggest focus, and not having a drawdown again like I had.
Okay, yeah, I did hear you talk about that 50% drawdown you had in your sort of earlier days. In another interview I was listening to with you, you promised yourself that you'd never get back into that situation. And so what do you think it was that led to that, and how did you end up in that position?
Yeah, it was, I didn't understand the dynamics of shorting or the, buying protected puts. I just thought, investing from what I saw from even looking at charts back when I was a child from the mid 80s all the way through to 2000, really from like 1982 to 2000, outside of a few, smaller bear markets. I mean, it was a pretty straight up trajectory. And if you bought and held even, you won in the long term. So I was so long biased, I couldn't believe that the NASDAQ could go from 5,000 back to, 2,000 or so. I couldn't even comprehend that. So I learned that it can go both directions, and that really made me understand the risk involved, that you can't just buy and hold. I mean, it can stay stagnant like it did from 2000 all the way through to 2011, 2010, where pretty much was a side of people that bought in 2000 were still even on buy and hold after a decade.
Okay, before we move on, I'd just like to dive into that a little bit. What gave you the confidence to continue trading after you'd essentially just lost half of your account? I mean, it could have been very easy for you to get discouraged, admit defeat, and move on. So why did you not walk away then?
Yeah, I mean, I learned from the time I was in my late 20s, I had enough of my largest capital trading account to pay off my house at 28, and that beats the heck out of a 30-year mortgage of fighting with it. So I knew the potential was there, given the right trends and the right trading methodology. So, I mean, I knew that I could get back to where I was, and then once I got back there again, I wasn't going to give it back, and I was going to use it to grow more capital and have more money to spend in other ways by just simply selling my time to an employer. So I knew the potential was there. I knew I did it before, and I knew I could do it again. And I knew many other people studying the legends of trading had done it. So if they can do it, I figured I could do it. I mean, what other game promises you such an upside potential?
Okay, great. No, I think that's really interesting that you could identify the potential, and it was just about learning how to actually take it, I guess you could say. If you could, tell us a little bit about your actual approach to trading. So how would you define your style?
Well, really, everything I do is based on trends, whether it be the longer-term trend of the stock market, a shorter-term trend, even a swing trading inside of the prevalent trend. Everything I do is based on how I can best capture a trend in a specific time frame. And there's many ways to do that, even going into options where you're betting on lack of a trend, or you're betting on the end of a trend. So everything I do is all through a filter of what is the trend at each time frame.
Okay. Now, I understand you tried several other methods of trading. You kind of mentioned that a little bit earlier on too. But I believe you also tried sort of things like day trading, value investing. So what is it that you like about this approach that has had you stick with it?
Yeah, I like the reactive technical analysis approach where I'm not trying to predict anything. I'm just reacting to what's going on in a particular time frame. I'm just trying to be with the market itself. I'm not trying to beat it. I'm trying to do what it's doing. And it's much easier than, being trading off fundamentals as a value investor, and you think there's untapped value there in earnings, and you're just holding it what could be a year or 2 years, never knowing, when it's going to move up. Or, being a day trader where you're sitting in front of a computer for anywhere from 8 to 10 hours a day, wasting all your time when the money I've made, all the big money I've ever made, has been in a trend where I've done nothing, where I've bought something, whether it be a stock or an index, and held it for sometimes up to a month, 2 months, or longer. And that's where the real money came from, not sitting at home every day trying to find a few nickels and pennies off underneath the steamroller. I just got on a rocket and let it fly.
I like it. Great answer. I believe your approach is also influenced by the Nicholas Darvis system. Could you shine some light on this and maybe explain what this is?
Yeah, it's a lot of it. I'm not as aggressive as I was when I was younger. As my accounts have gotten bigger, I've gotten much more conservative with my capital. But the Darvis system fascinated me because a dancer who became a multimillionaire in the 60s by simply finding the biggest, fastest moving stocks in the entire stock market based on nothing but the actual price action and people buying it, and bought them, never watched the market in the daytime, saved all the emotional trauma and stress of watching it, just simply bought in the fastest moving stocks. If they went down to a certain point under a support, he sold them. If they went up, he held them as they kept going up and trailed his stop, and made an absolute killing, which goes against all the accepted common sense of trading, even to this day. So I found it fascinating, a lot of the things he did, and I even find fascinating that he did a lot. Nicholas Darvis did the same thing in the 60s that a lot of modern-day wizards of trading do today, like Ed Seykota and William O'Neill and different traders that have found that his system worked, which really he was a trend follower of individual stocks. The most world-changing stocks. I think he was in stocks that, like created the first rocket fuel and the growth behind that, and the very first filtered cigarettes with Lorillard. And he was even in companies that were takeover candidates that kept going up. And his approach was so simplistic, and he was so ahead of his time. I always found that incredibly fascinating for his method and his psychology he used to capture his method. So it was very fascinating.
Okay, so how did you sort of discover that and learn about his system?
Well, I saw his book on Amazon, How I Made $2 Million in the Stock Market, which sounded like, I saw it so many times that it sounded ridiculous. But then I kept coming across it online where so many people talked about it and how amazing his story was. So I finally had to buy it and read it. And I found his simplicity of his approach and the power of his approach was amazing. And then to see all the similarities to the modern day trend followers and the modern day traders with, he was looking at support and resistance, but he called it Darvis boxes, and looking at the psychological approach to what the traders were doing. They were accumulating his stock. He was simply getting in stocks that were being accumulated heavily by traders, and he was trading with a psychology dynamic instead of a predicting, guessing, random dynamic or fundamental dynamic. So I think he really was way ahead of his time.
Okay, that sounds really interesting. It sounds like your trades are mostly based off technicals. Do things like fundamentals and news have any impact on your decision making?
Not anymore. I mean, they did early on, but I never made a lot of money with the fundamentals. All my money came from identifying and capturing long-term trends. So I really, over the last several years, have abandoned fundamentals completely, probably since about 2008. I went strictly to a technical side, trading off charts themselves.
Okay, so you're just 100% technical analysis now. That's it. No more fundamentals and news.
No more fundamentals, no more news. It's purely a chart trading. I mean, I might use some psychological dynamics if the market rallies on bad news is an additional indicator, or if the market sells off on good news, but mainly it's chart patterns and just price action. Everything's based on quantitative charts.
Okay, cool. So what does a good setup look like to you? What sort of things are you looking for to get into a trade?
Well, there's the trend trades and there's swing trades. I mean, I'll also, if the stock indexes are in a long-term uptrend, over the 200-day and the 100-day and the 50-day moving averages, I'll also use an RSI oscillator as a filter for swing trades, where on a daily chart, around the 30 to 35 RSI will give me a swing low bottom, and then a 65 to 70 RSI high will give me a place to exit and locking in profits, or even selling bearish credit spreads at a high level. I'll also use moving averages, like if it's in a price range for a long period of time, then suddenly it breaks out of the price range to new all-time highs, I'll buy it, and I'll trail it with a 5-day exponential moving average or a 10-day simple moving average, and simply let it run.
Okay, so once you're in, can you tell us how do you typically manage that trade as far as placing stops? Do you have profit targets? Are you monitoring this just at the close of day? How do you typically manage a trade?
Once I purchase, I'll have a stop loss. Like say the S&P 500 broke over the 200-day moving average, I'll buy at the end of day, and then I'll place a stop, right underneath the 200-day, a close below the 200-day moving average. So it can still fluctuate under during the daytime, but at the end of the day, if it closes underneath the 200-day, then that would be my initial stop loss, which will be relatively close to my first entry. But if it continues to trend, then I'll move my stop to a 10-day simple moving average. If it trends up, it starts going up faster, I might trail all the way to a 10-day, to a 5-day exponential moving average as my end-of-day stop. But I'll trade small enough where I can use end-of-day stops where I don't have a physical stop in during the day. But wherever my stop is, I'll attempt to never lose more than 1% of my total trading capital. So if I'm trading with a $200,000 account, I'll set my stop, end-of-day stop, where I won't lose more than $2,000 in the trade if that's 1% of my total trading capital. And I have to use my position size and be based on the volatility of the underlying equity. If what I'm trading may move $2 a day, then I'll probably only trade 500 shares of it. So if it does move the full range, it won't cost me 1% of my trading capital. So there's an initial stop loss to prevent the loss of too much trading capital. There's a trailing stop. If it's a winner, I trail behind it to get as much of the trend as I possibly can. Are two of the dynamics that go into it.
Okay, that's really good. So you're trailing stops to sort of lock in profits as the market moves in your favor. I know you really push the topic of risk management. What would you suggest are some solid risk management rules that could potentially save a trader from blowing up their account?
Yeah, this is something that so many don't understand, where Larry Hyde and several other market wizards talk about never lose more than 1% of your trading capital per trade. And so many new traders and even experienced traders think, that's too small. I'm not going to trade with more than 1% of my capital. And it's not saying trade with 1% of your capital. It's saying don't lose 1% of your capital in any trade. So, you can trade relatively large with even stock indexes. You just can't lose more than 1%. You could put 25% of your account in, like, say, the S&P 500 index, and 50%, if it's 50% in, it can drop, it'd have to drop 2% for you to lose 1% of your trading account. So that's one way to have a large position size and not lose more than 1%. And if you have multiple positions on, I don't want to expose myself to more than 3% total risk. If I have 3 stocks and all 3 caused me to lose 1%. That's a 3% drawdown at one time. That's the most I want to, on any bad day when I lose, is 3% of my total trading account. A lot of times I'll just do one trade at a time. I mean, I'm very conservative. I don't ever want to be in a situation where I can have 4, 5, 6 trades go against me and be down double digits in a single day.
Okay, so that 1% rule, that's something you still stick to this day?
Oh yeah, I've become more believing in it more than I ever have, because if you can have a couple of 1% returns on your capital in a month, you can have great annual returns and still never expose yourself to too much risk. The danger comes in the drawdowns where a lot of people don't understand. You get down 10%, it takes an 11% return to get back to even. You get down 50% in your trading account, you have to have a 100% return just to get back to even. And I don't know very many traders that have a 100% return in even a year. So it's important never to have those drawdowns, to just slowly chip away and keep increasing your account.
Yeah. One of the a question I have about that would be, if you're risking 1% of your account, for a lot of new traders who have a reasonably smaller account, so they're risking 1%, the market's going to have to move quite a way before they actually even cover their commission. Am I right in saying that?
Yeah, a lot of times that's a biggest mistake new traders make, is they start with too little capital and then they blow themselves up. Because if they've only got a few thousand, then they're, like you said, they're shooting just to cover commissions. They have to make so much percentage return, so they go too big and they risk their whole account on even individual stocks, and they blow up so many times because the probabilities are, if you're risking several even 5-10% per trade, you only need a few in a row losses and you're blown up. So a lot of it, they just need to wait and build up enough capital to trade with effectively, because the math goes against them sharply when they're risking too much money at one time, because you're going to have a losing streak every time the market changes its character and dynamics, where trend followers can make money for a while, but then suddenly it gets volatile, or a reversal happens, and you don't want to be trading big when that happens. So it's important you have enough money to get you through.
Okay, so what would you suggest would be a good amount of equity to, I should have said capital, to start with as a new trader?
If you want to do long-term trend following, and you're only going to make a trade or two a month, and trade really long-term time frame, then it's possible to start with a 5,000-10,000 if you want to. But you can't be an active trader. You have to get on trends and ride them, and not cut yourself to pieces with commissions and bid-ask spreads. But to seriously get into some serious active trading, you need a minimum of $25,000 to $30,000, in my opinion, if you really want to actively trade.
Okay, and is that a good idea for someone who's probably not traded before, to take 30 grand and put it into a trading account with no knowledge of trading before?
No, I think they get themselves messed up. They start trading first, then they lose, then they educate themselves. So I think you have to educate yourself first, then trade. Now, if they spent a year or two, or even a year reading all the top trading books, going on social media, learning, Googling, researching, there's so many free resources out there. If they educate themselves first, they start really small, chihuahua trades, and they don't get their emotions engaged in it because they're trading, maybe risking $50, $100 per trade at the very beginning, then it is possible. But they should never trade a dollar until they have a complete trading plan, a trading system, a methodology, and they've done their homework first. That can save a lot of money.
Yeah, which actually brings me to another point. I heard you quote something before in another interview again, and that was the first thing a trader needs to do is not to trade for at least a year and do nothing but homework. Why is this? A year is a really long time.
Yeah, trading is it's a profession, just like a doctor, a lawyer, a professional athlete, and I don't know any lawyers that would try to bust in a courtroom and start practicing law without first going to law school or studying. So, a year for trading to come out and beat, 90% of other traders to be the 10% profitable is still a very lofty goal. And the only thing that's going to give them that edge over other traders is to really understand what they're doing, understand risk management, understand how their own emotions are going to affect their trading, understand how the market itself's emotions are going to make irrational things happen, and to understand historical price patterns and how they play out. And if they don't, they're not going to be in the 10% of profitable traders. They're going to be the 90% of frustrated traders that are losing their money and don't even understand why they're losing their money. So it is no other field can you walk into and participate without first earning the right to. Trading is one of the few places you can get an account and get going. They won't let you go to the NBA and play one-on-one with an NBA player. You have to earn that right.
Of course, yeah. Which brings us to another point, and that's getting educated. So, I'd like to ask you, how should those new to trading seek out an education to be able to get those rules and everything you sort of mentioned just before? I mean, it's very easy to purchase a high ticket workshop or something similar to that, but that's probably not always the answer. I mean, what would you say there?
I think there's so many free resources nowadays. The problem with new traders is they don't even know what the right questions are to ask. First, you have to know the right questions before you can even find the answers. A lot of what I do with my my blog, New Trader U, and my books and my book New Trader Rich Trader is I try to give them the right questions to even ask. And once they know the right questions, then they can move on to reading more advanced books. They can study historical charts and patterns. They can learn to do some simple back testing on some simple software, even web-based software. They can listen to read books like Market Wizards that all these other successful traders give out their wisdom and the principles behind what they do. And it's just crucial that they educate themselves first in many ways.
Are you ready to get serious about options trading? Then join Tasty Trade, Investopedia's best platform for options trading 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including a $10 cap per leg on options trades, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, and more features to help you trade smarter. Manage your positions with speed and precision using Active Trader Mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Join Tasty Trade today and earn a double commission rebate up to $3,000 total on your stock and ETF option trades for 30 days. Visit tastytrade.com/chat for more info. All applicable regulatory exchange and clearing fees still apply. Options involves risk and are not suitable for all investors. Learn more about Tasty Trade promo terms and com/double. Offer expires May 31st, 2026. Tasty Trade Incorporated is a registered broker-dealer and member of FINRA, NFA, and SIPC. Ever watched a stock explode and thought, if only I had the capital, or sat on the sidelines because your account balance felt too small to matter? Good news. With Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, and even the newest IPOs. And short anything you like with zero locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. It's a game changer. Create your account and start trading real shares within minutes. No subscriptions, no minimum deposits, just a one-time evaluation fee starting at $47. That's it. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you ever pay a cent. Every decade, the market reinvents itself, from online brokers to commission-free trading. Now, the new era of limited risk trading has begun. Click the link in the description to start trading with Trade the Pool's capital.
Okay, so by reading so many books and having all that information there, you must absorb a lot of mixed messages. How do you filter the noise from all that information and use it to your benefit?
I think that's the key, is people have to find the methodology that fits their personality. Some guys actually like sitting in front of the computer and scalping all day long. Other people, want to look at the long-term trends. Some are discretionary that like to find ways to beat the markets with their own decisions. Others like to have a purely mechanical system that they're simply taking entries and exits. But the key is they got to find what is going to work for them personally and write the trading plan geared to their own personality. And they have to have their own entries, exits, position sizing, risk per trade, maximum portfolio heat. They need their own trading plan. They don't need to go get tips or ask people what they're trading. They need to have their own methodology and system. And really, it all starts with a trading system and a trading plan. And that's what they're really after.
Okay, so would you say it's sort of taking bits of information from different places, the bits of information that like and sort of stand out to you as something you'd like to try, and then sort of putting it all together?
Yeah, it's like a buffet where you're finding the trading rules that will work for you and what your own risk tolerance is and what your what your personality can handle with risk and following trades. So some traders are very comfortable with a high winning percentage system where they might win 85% of the time with short-term trades, and then other people, are trend followers and make all their money from just a few huge trades through the year with a very long-term trading plan, where they stay in and they let it fluctuate a lot more. But you have to, if you can't follow your own trading plan, then nothing will work. So you have to find what fits your own personality and is profitable.
Okay, right. So where is one area you see people reasonably new to trading continually getting it wrong? And what would you like to say to them?
Yeah, I see even people that's followed me for years, they're just obsessed with predictions. They want to know, what do you think is good? What's your trade? Where do you think this is going? Everyone wants to predict when, the future does not exist. The future is not going to exist until we move day by day into it. So there's no way anybody can look at all the dynamics of all the buyers and all the sellers and all the variables that can go into any market. There's no way to predict the future. All you can do is trade each day based on what is actually happening, based on resistance, support, trend, moving averages, volatility. You have to trade what the market's giving you that day. You can't predict anything. It's impossible. Anybody who says they can is lying.
Okay. I think that's really interesting, yeah. I've been asking this question a lot lately, and it's kind of similar to that last one, but a little bit different. I'm really interested to know, what do you believe is the difference between traders who make it and go on to have huge success and those who don't make it anywhere? I'm thinking you could probably do an entire episode on this subject alone, seeing as that is essentially what your book, New Trader, Rich Trader, is all about, right?
Yeah, it's actually, I'm trying to refine all the winning principles that I've seen that are common amongst all traders. Like you said, they're different, but they all have some common principles.
So what is it that you believe separates the ones who have huge success and the ones who, never take off?
I think there's the universal principles. There's risk, the survivor bias, where you see the ones that made it. The one thing people don't look at, the ones that did make it and made it for a very long time, are the ones that manage risk. If you don't manage risk and you put your entire account at risk enough times, you will blow up. As Victor Niederhofer found out, he was an amazing trader, had some of the best returns ever, and then blew up several times. If it's too costly to be wrong once and you blow up, then you will eventually blow up. Also, the discipline to follow a plan, whatever the trading plan is, without the discipline to follow it, it doesn't matter. So no matter how good someone is, if they don't have discipline to keep the position sizing right and keep taking their entries and their exits, they're not going to make it. So we got risk management and we've got discipline, and then we've got the other reacting. So many legends, they were reacting to what was happening, all the way back to Jesse Livermore, Nicholas Darvis. It's the predictors that believe they can't be wrong, also the ones that blow up. So, reactive technical analysis, discipline, risk management. There's also perseverance. If somebody decides they're going to be a winning trader and they're not going to stop until they are, then generally only time separates them from success. Yeah. So then they got to find out how they're going to do it. So it's just a matter of time.
Yeah, I think you put that really well, Steve. What advice do you have for any traders who maybe struggle with the emotional side of trading?
The only thing that's going to get them through is they've got to develop faith in themselves and faith in their system. They have to know that they're going to do the right thing and when the real money's at stake, and they got to know that their trading system is a winner in the long term, and their risk management will keep them in the game. So they've got to have a faith in themselves and a faith in their system, and also they have to not trade so large that they activate all their emotions. And once you start getting emotional in your trading, you're dead. You have to stay unemotional, and it just be numbers, and it just be you're just executing a plan, and not have your ego, your greed, or your fear, or your stress engaged in the trade itself. It has to be a business transaction.
Okay, I think that's really great. Well, Steve, that kind of brings us towards the end of the interview. So thanks so much for coming on and sharing those answers. But before we let you go, we'll go to the closing bell, which is just a round of short, sharp questions. So the first one would be, what's the best piece of advice you've ever received?
I think it was Larry Hyde. I think he said, as long as you manage your risk and go with the trend, this just has to work.
I like it. What is the number one trading resource you couldn't live without today?
I think the book Market Wizards was a real game changer.
Okay, so I guess that would kind of answer my next question here, and that is, name one book you believe is a must-read for any trader just starting out, and feel free to mention your own book.
Well, I'll throw in Alexander Elder's Trading for a Living, and he has a new edition that really goes into the managing your mind method and your money, mind, and method. That was the three things you have to manage. I thought that was a great point in that book.
Okay, and as always, we'll put a link to that in the show notes. Knowing everything you do now, what would you have done differently come day one?
I think I would have done all my research and study first and then traded, and not traded first and then did all the study and research and learning.
Okay, awesome. Really good. Again, Steve, thanks so much for coming on the show. Before we leave, do you want to share with listeners where they can find out more about you and connect?
Yeah, I'm very active on Twitter at @SJosephBurns on Twitter, and I blog at newtraderu.com. And I also have one of my best-selling books is New Trader, Rich Trader, which has been a huge success.
Okay, awesome. Now, all those links will be in the show notes. And thanks a lot, Steve. We will speak to you soon.
Thank you, Aaron.
You've come to the end of this episode of Chat with Traders, but don't worry, more great episodes are on the way. To stay updated with each great new episode, be sure to subscribe to the podcast in iTunes, and we'd love it if you leave us a rating and review. We'll see you next time on Chat with Traders.
Every decade, the market reinvents itself. Online brokers opened the doors. Mobile apps made trading seamless, and commission-free trading erased barriers. Now, a new era has begun. Meet Trade the Pool. Limited risk trading. From now on, your trading risk is capped and your trading opportunities are limitless. Trade the Pool funds home-based stock traders with up to $200,000 in buying power. That means you can trade large positions and scale your strategies without risking your own savings. It's time to trade with more capital, actually worth more of your time and effort. Ready to trade the pool? Click the link in the description and join Stock Trading Revolution today. Doesn't your portfolio deserve the best? Then join Tasty Trade, Investopedia's best platform for options trading 2026. Trade smarter with advanced charting tools, backtesting, a pre-built strategy selector, and more features. Join Tasty Trade today and earn a double commission rebate up to $3,000 total on your stock and ETF option trades for 30 days. Visit tastytrade.com/chat for more info. All applicable regulatory, exchange, and clearing fees still apply. Options involve involve risks and are not suitable for all investors. Learn more about Tasty Trade promo terms and conditions at tastytrade.com/double. Offer expires May 31st, 2026. Tasty Trade Incorporated is a registered broker-dealer and member of FINRA, NFA, and SIPC.
The biggest secret of the best traders in the world is that they're just like everyone else. However, they've worked hard to learn the markets and discover what works and what doesn't. But how can you hear about these journeys and get in on the strategies and tactics they use? You can do it by listening to Chat with Traders. Here's your host, Aaron Fifield.
Traders, what is up? Thanks for joining me on the 6th episode of Chat with Traders, the podcast for those that understand there are many lessons we can absorb from the successes and failures of profitable traders amongst us. Now, the interview you're about to hear today is actually the very first interview I ever recorded, and just quietly, I think it probably shows. But that's not important. Today's guest is an immensely successful trader and a wizard on the topic of WD GAM. His name is Tim Walker, and his answers you do not want to miss. I was really excited to land this interview with Tim. He's a trader who I have a lot of respect for and have had the opportunity to speak with in the past. So I know what he's about and the logical perspective he places on trading. This interview goes right into many topics, ranging from the importance of looking at the bigger picture to understanding why the majority are fooled by fundamentals and news releases, which is really interesting. We also talk about how the methods of WD GAN have influenced his trading, and in particular, the 50% rule. This is one rule that I encourage you to check out for yourself. Even though it was discovered by Gann, who was around in the early 1900s, it still holds weight in today's market. So for complete show notes and a recap of today's episode, head on over to chatwithtraders.com. It's all there. And as always, if you like what you hear, please leave a rating and review in iTunes. I will be incredibly grateful. Here is today's guest for a lesson in technical analysis, Tim Walker. Hey Tim, thanks so much for coming on the show. I'm stoked to have you here.
My pleasure to be here. Thanks, Aaron.
Awesome. Now, we've been chatting for the last couple of minutes or so, and I'm really excited about the different topics we're going to touch on. So we're going to dive deep into your journey. We're going to discuss some of your trading strategies and methods, as well as some of your best advice for entry-level traders who are just dipping their toes in the market. So before we get to that, we like to start off the show with one of your favourite quotes, one that's helped you to push on through challenges and that type of thing. So take it away.
Well, I had to think hard about this one because I usually find a new favourite quote every week, but after giving it some thought, I decided the one I liked the best was one from one of W.D. Gann's books, where he said, "You've heard it said that 99 out of every 100 people who go into trading lose money." And he says, well, that means that 1 out of every 100 must make a fortune. And so therefore you can be that one. And I thought that was just brilliant because I like to be positive, and that always just brings me back to the positive side of things because, you know, trading is a challenging profession and there'll always be something unexpected happening. But if you remember that, then every reversal then becomes a stepping stone to another success.
Yeah, too right. No, that's excellent. Brilliant quote there. All right, Tim, so let's get right into it. Day one, take us there. Tell us a little bit about how you got into trading.
Well, it was quite funny, really, because as has happened to me more than once in my life, it appeared to be by accident. And I met someone at a dinner who, in the course of social conversation, was telling me about her work. And she worked with a company called Safety in the Market, which I'd never heard of. And they taught methods of a chap called W.D. Gann, who I'd also never heard of, about something called the stock market, which I sort of knew that it existed, but that was about the extent of my knowledge. And so I did some research after that and bought a course and got started. And when I opened the book, the first page that I read of it, I just fell in love. And I thought, this is what I'm going to do next for my career. And you know, it's funny. I'm sure many people who listen to this have had the same experience. But I just knew that it was the right thing for me. Didn't mean that it was always going to be easy, but I just had that knowledge. In fact, I've met a lot of traders in the course of the last several years who when they were looking for a change in their life came across trading. And it just seems to be one of those things that attracts people. And that was certainly my experience. And so I got into my book. I think I studied for about 6 months before I started trading. And then I had the early months of trading with the usual ups and downs, rather more downs than ups, I think, at first, from memory, that everyone experiences. And then, you know, gradually I just got better at it and got on top of it. And after about a year, I had the opportunity to move on from the job I was in at the time. And I pretty much decided to make trading my career after that. And that was in 2006. And so for the nearly 8 years since then, that's what I've done.
Yeah, no, excellent. So before that, what were you doing beforehand? Were you involved?
Well, I used to work with a company that trained people in communication skills. So I used to both attend classes myself and also was involved in the preparation and administration and so on of many of those and in training people. And I'd been doing that for quite some time, and I got a tremendous amount out of that. It helped me a lot. And, you know, I just happened to be at that time where I felt, well, I'm ready for the next thing, whatever the next thing might be. And
time for a change of scenery.
Yeah.
Yeah, no, awesome. Okay, so do you happen to remember your first trade by any chance?
I remember my first trade very well. In fact, my first 2 trades are quite memorable. The funny thing was my first trade, which later appeared in a trading course as an example of doing exactly the opposite of what I did, was a trade in BHP, and I took a short trade in it, which fulfilled all the rules in the beginner's book, and promptly lost money. And I remember at the time, while of course I would have liked it to make money, I wasn't too disappointed by it because I felt, oh, well, it's my first trade. You don't expect to be the world's best trader there. And so I didn't really think very much of it until a couple of years later when, as I say, I saw that very trade, or that period of the market anyway, appear in a trading course with an example of a signal to buy. I was short. I sold it. And what that trade taught me was that there was a lot more to trading than what's in the beginner's book.
Yeah, absolutely.
And I realised from there that there was more that I had to do.
Yeah, no, that's brilliant. Okay. So what was some of your early setbacks? Like, what were you really failing at and sort of struggling with to get your head around when you were first sort of dipping your toes in the markets?
I can answer that pretty clearly because it became apparent to me probably about 2 or 3 months into it that what I had absolutely no idea of was the bigger context of what the market was doing at the time. So I'd learned how to look at a very small segment on a short-term daily time frame, and I didn't really even know whether we were in a bull market or a bear market. And so when I look back over my earlier trades, I found that there were an equal number of long trades and short trades. Whereas, of course, in a bull market, you should be taking mostly long trades, and in a bear market, you should be taking mostly short trades. And I was just all over the place. I lacked that bigger view.
Okay, so you're just looking at sort of the too small of a picture. You weren't sort of zooming out and looking at, you know, a couple years back and sort of, you know, as you said, the big picture of things. So how did you overcome these sort of setbacks? Obviously, you just sort of learned to... You do need to zoom out and look at the bigger picture and see what really is going on.
Well, I realised I needed more knowledge. So after I'd taken about half a dozen early trades, I just took a break for about a month and just focused on doing more study and learning a bit more. And that's where I started to fill in those missing bits. And as it happened, it was a period where the market was doing nothing. It was just going up and down in a sideways manner. And I was better not trading at the time because they're hard periods to make money in. And during that period, I got a much better view of what the market was doing overall. And so I was able to get a much clearer perspective by not trading, because sometimes when you're in the middle of the market, there's a lot more confusion there, or you're worried about what's happening in the trade. And by taking that step back, I was able to clear my head. And then I came back with, much greater skill.
Yeah, I mean, because when you're in the market, of course, you're a bit biased and you obviously want it to travel the way that you're trading, don't you?
And it's very easy to ignore what the market is trying to tell you if you have a view on it.
Yeah, no, exactly. So what was, now that we've sort of got your bad trade out of the way and, some of your earlier ones, what's one trade that you'll never forget? I mean, it almost feels as though you sort of wrote the trade before it even happened.
Well, my favourite trade, it's not the best trade I've ever done by a long shot, but my favourite one to remember was actually the first one I took after that period when I came back to the market. And I found a setup on a stock which isn't around anymore called Coles-Myer. And it was a fairly simple setup. It was just a double bottom trade, but it fitted the new things that I'd been studying during the previous month. And when I came back and took that trade, it was a good trade and I traded it well, but I just happened to be lucky enough that while I was in the trade, a takeover rumour came out. And when the takeover rumour came out, I think in one morning, the price jumped from something like $10.50 to $13 a share. And so I made a terrific, great profit on the trade, which, was luck as much as anything, but it was just great because I'd taken a good trade. It was a strong setup and I was trading it well. And because of that, the good luck, it's funny how good luck comes when you're doing the right things. And why that's my favourite trade is that one changed my thinking, because then I realised, yes, I can be successful at this. I was confused after the early trades because I was still learning, but that one just showed me that if I studied my rules and applied them properly, then I could be successful at it. And I think it was the change in thinking that was more important than the actual outcome of the trade.
Yeah, so you just sort of proved it to yourself that, you can do this.
But so much of it is about belief. I've had many times where, I might be looking at the markets and think what a wonderful period of trading it is. And then someone comes up to me and says, oh, gee, it's been so hard to find a good trading setup in the last 3 months. And after I've picked myself up off the floor, I then open a chart and show them about half a dozen really good trades and say, what do you think about these ones? And because their thinking has been negative, they only see the lack of opportunity. And when mine is positive, I see the good opportunity. So I think how you feel within yourself is about 95% of it, really.
Yeah. I mean, emotions are certainly a massive part in trading, aren't they?
Huge. Yeah, definitely. Very
so, just before we carry on, I'd just like to take it back a step. You mentioned sort of you went back and you sort of did a lot more training and built your knowledge up a bit. What sort of things were you doing to build your knowledge up? What were you, were you reading books? Were you taking courses? What sort of things were you doing?
I'm a voracious reader, so I love reading and I love books, and I just read everything, whether it's on the market or anything else that I can get my hands on. And so, yes, I did a lot of reading. I was in a study program, safety in the market study program, which was called the Platinum program, which was just simply a structured course over a period of 12 months. And what I did was to basically have one topic every week that I focused on. And I used to just go over that material again and again, as many days as I could during that week, until I really got a handle on it and then move on to the next. So I was trying in as systematic manner as I could to just build up my knowledge base.
So when you say a topic, you're sort of meaning as though like a certain pattern or a certain one rule, you're really trying to drum it in that week?
Yeah, it could be various things. It could be one topic like analysing price ranges in a market, or it might be one like volume and volume analysis, or like just different areas so that I could. Well, there's two things. One is to focus on one thing at a time, and the other was also to get repetition in it. And the impetus for that actually came from a book, quite a popular book. It's called The Tipping Point by Malcolm Gladwell. And they were analysing all sorts of things, but one of the examples in it was a children's TV program, which they tested by showing the same episodes of the kids 5 days in a week, Monday to Friday. Instead of showing 5 different episodes, they showed the same episodes 5 times. And because it was an educational program, and I think it was called Blue's Clues. So the idea was that the show had various clues and the kids were supposed to guess the answers as it went on. And, of course, by the 5th episode, they knew all the answers in advance. And it just occurred to me, oh, gee, this is a really good way to study. that we generally don't understand the topic the first time we read through it. You actually have to read 2, 3, 4 times before it makes sense. So I made a rule of trying to do 3 to 5 times every week on the same material. And I would find by about the third or the fourth time, it was really starting to make sense to me. Plus, I was starting to draw connections between that topic and maybe the one I'd studied the last week or something like that. So I saw the interrelation of different things.
Okay, that's a really good point you make there, Tim. That's excellent. So, when you were starting out and you were picking up, on your trading and that sort of thing, were you doing paper trading or anything like that to start with?
I did initially. I did a little bit of paper trading for about a month. But the vast majority of my trading has been practice in the actual market. And I think this is a thing that varies from person to person. I mean, it's always wise to do a little bit on paper first so that you at least know what you were doing. But once I knew what I was doing, I just wanted to get in there and try it out. Because the big problem with paper trading is that it leaves out probably the most important element, as we were discussing before, which is the emotional state. And it's very easy to take the 5th loss in a row in a paper trade because you just go, well, there you go. But when it's for real, it's quite a different thing. And then you find yourself second guessing and thinking, oh, well, will I take the next trade? Or perhaps I'll close this one out early and just take this little bit of profit I have and so on. And it gets much harder to stick with the discipline.
Yeah, no, I couldn't agree with you more on that point. It cuts the motion out of it altogether, which, as you said, is a huge point in it. So let's talk a little bit about your trading methods and your strategies. Obviously, we don't have a huge amount of time to go into great detail, but just sort of in a summary, how do you sort of approach the markets?
Okay, well, my basic starting point really is WD Gann's work. And so that's the sort of perspective that I come from, which for a start is technically based. And my focus is really on looking for strong turning points in the market to start a series of trades. So that might be something like a double or a triple bottom, for example, or say a yearly top or a bottom if it comes on price and time relationships, without sort of trying to go in and defining those. But basically to try and look for an important turning point in the market that is a reasonable degree of certainty that the market's going to change from that point. And not necessarily to trade it right away, but as soon as it's confirmed, to start trading and then to try and hold a trade for as long as possible in the next move. Now, for my style, because I trade on a daily chart, my time frame from a trade tends to be about a week to 2 weeks, mostly. Occasionally, if there's a longer move, I might have one where, I trade off a swing chart. If a swing chart keeps moving in the same direction without interrupting for a period of time, then I'll have one that lasts a bit longer. But I try to then also alternate between holding on for a move as well as locking in profit as I go, because one of the things I found is that whatever you think is going to happen in the market, 9 times out of 10 it does something different. And so it's always better to, the old saying, a bird in the hand is worth 2 in the bush. Well, a dollar in the account is generally worth $2 on paper. And so it's always good to keep locking in profits as they go.
Yeah, so you often just sort of trail your stops up as the market sort of progresses. I try
to split my position in 2 where I can and take profits on half the position at a high probability point that the market should get to. And then the other half I'll try and hold on for a longer move. Because I've had so many times when what I thought was going to be a longer move lasted 3 days. And then I've had other times when what I thought would be a short move went on for 3 months. So I find splitting in 2 like that just gives me the opportunity to have something either way, and also gets me out of the way of trying to be right. I gave up quite a long time ago trying to be right in the market and just focused on trying to keep up with what the market was doing.
Just trade what's in front of you, yeah.
Yeah, absolutely.
So just to elaborate on that a little bit, as the market's going up in your position, you mentioned that you sort of closing out half your position and moving your stops up to protect a little bit. Do you ever find yourself in a situation where you're adding to your position as the market goes up?
Yes. Now there's a couple of ways of doing it. My way of doing it is, because I'm closing positions out and taking profits as I go, then when I get a new trade signal, then I take an additional trade there. So I'm sort of building it as I go. There are other ways that I've studied of doing it, and I've tested some of those, but that's the way that sort of fits my style and personality best, because I might take, say, 2 contracts, take profits on one, so I've got one left. Then another signal comes in, I take another 2 contracts, which means I've got a total of 3, and so on, and then I can just build it up that way.
Right, okay. No, that's excellent. So, this is very sort of technical based, your trading methods. Do you take into account fundamentals and sort of news releases and that sort of thing? Do they affect your idea on?
With one exception, no. The exception, I'll give you the exception first, which is with news releases. If I notice them, I tend to do the opposite of what they indicate, because having studied it for some time, it's not that I think fundamentals and news are not important. They are important, but there's 2 limitations on them. One is, unless you work for a large bank or institution that has the research staff able to do the research into the fundamentals, the average member of the public cannot get his head around what those figures are. I was teaching a seminar once where we had a lady in the group who was an accountant, and we were talking about this, and she put up a hand and she said, I'm an accountant and I've prepared company annual reports and balance sheets and so on. And she said, I know what lies you can tell using figures and still be doing, what's within the letter of the law. So even if you're skilled enough, which I'm not, to read those things, you're highly unlikely to get the accurate information. Plus, it's always out of date by the time it reaches the market. But the other factor is that fundamentals are not the only thing that drives the price of a stock or a commodity, because there are 2 other factors. One is people's emotions in general, and the other is just the overall up and down cycles of the market. And classic example of this is the GFC we had in 2008. Now, many stocks in that period fell 50, 75, even 90% in value. Some went out of business altogether. And you can't say that all those companies fell that much in value. It was just that as time went on and prices were falling, people started to panic, and then they just wanted to sell everything, and that drove prices down further. And because all the market was falling, it was a cyclic period where the market was going down. In 2009, it turned around and the market started going up again, and by and large, it's been going up ever since. And markets move like this. They go up and down in cycles, and fundamentals won't tell you what the cycles are going to do. It's a bit like trying to use today's weather to forecast tomorrow's. You've got to look at other factors, which might be the storm that's beneath the horizon that you can't see. And so for all those reasons, I don't try to study fundamentals. I try to study the price chart, because all of those factors combined will appear in the price chart. And so I am still taking account of fundamentals in a way. The other reason I try to avoid is that, far be it from me to suggest that people try to manipulate markets, but it is a fact that good positive news announcements for companies very frequently come out at the high point of their price move. And all I can suggest there is that some news releases are being given to the public to induce them to buy, and often those releases come from people within the industry who presumably are wanting to sell because they think the price is as high as it's going to go. And that's why sometimes if I hear a news release, I'll be looking to do the opposite. Classic example of that, I was on a holiday back in 2012 in September. And when I landed back in Australia, I landed in Perth. And as I was catching a taxi from the airport to where I was staying, I heard an announcement over the news that the Federal Minister for Resources had just announced that the mining boom was over. And then they proceeded to go on and say that the price of iron had fallen from $320 to $160 a tonne or something, and they gave a couple of other prices that were like that. Now, one of the things I know from my technical analysis is that when a price falls in half, that's often a good point where it's going to start to move up again. And then I did rather wonder why he was making this announcement at this point in time. I would have thought if the price had fallen from 320 to 160, it would not have taken that long to work out that the boom was over. I would have thought you might have been thinking that at about 280. So as soon as I heard that, I thought, it must be about the time to buy mining stocks. And sure enough, that was about the time where many of them have bottomed and risen from that point. So often if I hear news, I don't go chasing news. Sometimes people send it to me, but frequently I look for the market to do the opposite of what the news would tend to indicate that it will do.
Okay. So if you've got identified a potential trade, do you check any news reports that have come out recently, or do you just go with your instincts? You don't let that affect you?
I just go with what the chart's telling me. I've had so many times when I would look at a setup on my chart and it would tell me I should be buying, and there'd be some negative news, and so I was scared to buy and then didn't, and then the price did exactly what the chart was going to tell me, that I thought, well, I'm just going to forget the news. And see, the thing is, you can't be right all the time in the markets. Nobody's that smart. And trading is not about being right. Trading is about seeing a setup that works 7, 8, 9 times out of 10, taking the trade that's indicated by that setup, managing the trade effectively, that's very important, managing the risk and then managing the exit point from the trade to get the best possible result out of it, and then also knowing when not to take a trade. And probably my greatest weakness was that last matter of knowing when not to, is always wanting to take trades. But really there are some times when you're better off just sitting there for a month, not doing anything.
Yeah, right. No, that makes a lot of sense, Tim. So you mentioned the sort of the price, the 50% level. Do you want to just elaborate on that a little bit?
Well, the rule as I originally got it was from some of Gann's books, where he basically said that when a price falls in half, either, let's say you've got a stock that tops at $35, if the price hits $17.50, it's generally a good place to buy. Then he also said that you can measure the price range between a high and a low. So if it had a low of 20 and a high of 40 and the price fell to 30, then that's often a good buying point. Now, I don't buy on those points alone, but they're the sort of setups that I look. In fact, Gann said in one of his books that you can make a fortune in the market just on that 50% rule if you understand how to use it. Now, after several years, I'm still learning new things about it. So it's not necessarily more complicated than what I've just said. It's just about learning to recognize it when it happens and then having the right signals to act on that sign when it comes. Okay, it's fallen to 50%. Now what do I do? What sort of turn do I look for in order to give me a signal that I'll trade it at that point?
Yeah, so you're looking for a little bit of extra confirmation before you just sort of jump in at that point.
Absolutely. I would never do it just on that one thing. But if, for example, there was a double bottom also at that level, or it was on one of the timing rules that I have, or there were volume indications behind it or whatever, if I had, say, 3 or 4 of those, then I might have enough there, and then maybe my swing chart would give me a signal after that, at which point I would take a trade.
Okay, sure.
So there's sort of 2 steps in it, really. One is analysing a market that's in a position for a trade, and then the next thing is waiting for the actual signal. And there are times when I see a market in a position for a trade, but it gives no signal, so I don't trade it. Sometimes, for example, the risk is just too great. The entry point just makes it impossible to take. So I just have to let it go and then wait for another time.
Yeah, sure. No, that makes sense. No, good one. So what else we got here? So those are some of your favourite patterns to trade, is the 50% levels, and then especially when they fall at like a double bottom or triple bottom price point.
Yeah.
Those are the ones you like to get on.
That's my absolute favourite.
Yeah, okay.
Because they're extremely high probability trades. And they do 2 things. One is they work most of the time, and the other is they either have a really good move when they do, or if they fail, they present a trade in the other direction. So there's sort of points where the market's at a decision point where it has to go one way or the other. And I like those because you end up with about a 90% chance of making some money, even if you're wrong at the beginning, if you know how to trade them.
Yeah, exactly. Okay. So just on a side note there, why is it that you do see these double and triple bottom patterns? Are you able to answer that one?
Yeah, you can do it quite logically, actually. If you're talking, say, about a double bottom, let's say we're looking at a stock. Now, every stock will be traded by large concerns who know a lot about the industry. In a mining stock, we'll have people trading it who've worked in the mining industry all their lives. They deal in those minerals. They know the industry back to front. So if we see a company like, say, BHP, and 4 times it finds support at $20 a share, or even one time it finds support at $20 a share, and then it comes back at that price again, then there's a good chance that the people who bought it last time at $20, obviously they bought it because they considered it was good value. Obviously, if it had a good move up from there, then a lot of them bought it. So there's a good chance they'll do so again. And it's interesting, actually, we've got a few markets right now sitting at points like that. The US dollar index, which I'm not a currency trader, but I was looking at the chart just the other day, and the index of the US dollar, the futures index, has come back to the level of 79 about, 6 or more times over the last 2 years. And if anyone cares to check it, it's actually on a 50% level. And from the 2011 low to the 2013 high, you can measure it. It's sitting slap right bang on there. Every time it comes back to that price, somebody has been buying it. So obviously somebody who knows a lot knows that it's good value at that price. And sure enough, it hit there on about Thursday last week and just rocketed up for 2 days. Now, conversely, if you have a price like that and the price falls through, that means that those people who were buying it several times before now no longer are willing to buy it at that level. And that's why you have a pretty good chance of success if you go short on the break of those support levels, because it means that the people who were buying aren't anymore. So for some reason, they perceive there's been a fundamental change in the value of that market. Now, similarly, you'll get the thing at a double top where, okay, market's come up, it's made a top. Okay, why has it made a top? Let's say it's a price it's never traded at before. Let's say a stock trades at $50 a share. It's never traded that high before, but it makes a top at that price. Then it falls to $40 a share and it comes back to $50 again. Now, 2 things will have happened there. One is people who, again, insiders in that industry, will have been selling it at $50 the first time. Now, they must have a reason for selling it at $50. If they thought it was going to go to $60, they'd hold it for longer. So they must consider on all the evidence in front of them that $50 is as much money as they're going to get for those shares. Because when they're trading in millions of shares, as those big funds do, they want to hold on for as long as possible, because getting out $5 too early is the waste of a hell of a lot of profit when you've got positions that big. So, they know their stuff, those people. And I don't know the stuff, but I can see what they're doing by looking at the chart. So I see they've been selling at that price. Then the price comes up there again, and I watch to see what it does. Is there selling taking place when it gets there a second time? Now, if there is and it starts to go down, again, I've got a good chance of getting a trade, because it was worth as much as it's going to be worth the first time. They obviously consider it was worth that much the second time. Now, there's another factor that comes in at tops, is that, okay, while some people were selling at the first top, some poor unfortunate people were also buying at the first top. And so there's all these people in there who bought this share at $50 a share. Now it's fallen to 40, and they're sitting there going, I've lost so much money. Please just get back to 50 again so I can get out at break even. So it gets back to 50 and they say, thank you, God, or whatever deity they worship. And then they take their money and run. And so you've got all those people, for both those reasons, selling when it gets back to the old price. And that's as good a reason as any that I found why markets will turn at previous price levels, whether they're tops or bottoms.
Okay, cool. No, thanks for elaborating on that. That's excellent.
Are you ready to get serious about options trading? Then join Tasty Trade, Investopedia's best platform for options trading 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including a $10 cap per leg on options trades, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, and more features to help you trade smarter. Manage your positions with speed and precision using Active Trader Mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Join Tasty Trade today and earn a double commission rebate up to $3,000 total on your stock and ETF option trades for 30 days. Visit tastytrade.com/chat for more info. All applicable regulatory exchange and clearing fees still apply. Options involves risk and are not suitable for all investors. Learn more about Tasty Trade promo terms and conditions at tastytrade.com/double. Offer expires May 31st, 2026. Tasty Trade Incorporated is a registered broker-dealer and member of FINRA, NFA, and SIPC. Ever watched a stock explode and thought, if only I had the capital, or sat on the sidelines because your account balance felt too small to matter? Good news. With Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, and even the newest IPOs. And short anything you like with zero locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. It's a game changer. Create your account and start trading real shares within minutes. No subscriptions, no minimum deposits, just a one-time evaluation fee starting at $47. That's it. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you ever pay a cent. Every decade, the market reinvents itself, from online brokers to commission-free trading. Now, the new era of limited risk trading has begun. Click the link in the description to start trading with Trade the Pool's capital.
So let's just dive into a little bit about where you often see entry-level traders slipping up. Like, what sort of mistakes do you see really common amongst traders who are just starting out in the markets?
The biggest problem I have encountered with people starting to learn is that they don't realize the value of being able to do what we call form reading, which is to take the patterns on a chart and draw information out of them. And for a technical trader, every day you have 5 pieces of information. You have the open and the close of the day, you have the high and the low of the day, and you have the number of shares or futures contracts or whatever traded in that day, which is the volume. So open, high, low, close, and volume. And the combination of those things, either on one individual bar or on a group of bars taken together, maybe 2, 3, 5, a dozen, whatever, they form patterns and they are packed with information. So, for example, you might have one day where a stock makes a $10 range from high to low, and 500,000 shares are traded. And then the next day, it makes a $5 range. It goes higher, but the range is only $5 instead of 10. So it's got half the range, but it's got the same volume. Now, that's telling you something, because whereas there were lots of buyers compared to sellers on the first day, because the range was $10, if that range is halved but the volume is the same the next day, then it means a lot more sellers have come into the market. These things, of course, an entry-level trader doesn't know, but unfortunately not many books talk about it. And so they don't pick up on these things. They don't know the difference between a market that's trending or actually moving somewhere and a market that's just chopping sideways. So they'll take trades in markets which they're better off not even touching, and instead of waiting for the ones that are making strong moves. You know, markets spend... Well, I've never actually done the dates to tell, but I reckon markets probably spend about half their time moving somewhere and the other half preparing to move. Some say it's 80 preparing and 20% actually moving, but it just depends from market to market. But every market will have periods where it sits getting ready for the next move. And the moves can sometimes be very short. They might last 3 weeks after it's spent 2 months preparing. And you've got to be ready for those. And they're the times when you can make money quickly. I mean, there are strategies, say option strategies, which I don't trade, but there are strategies for making money in sideways markets. But by and large, it's much easier to make money in a market where the price is going somewhere. And it's very hard to make make money in a market that's choppy. And most entry-level traders are not even aware of that distinction. And I think that's, in my experience, that's what causes the most trouble for beginners.
So not identifying a certain trend that's playing out. They're just trying to jump into a sideways market and, trade the short movements.
They see trading signal. Let's say they've learned a signal. It could be anything. It might be moving average crossovers, which is a popular one. Not one I use, but many people will recognize it. Now, so they'll just enter a trade on that without actually looking at what the market's doing. Now, if a market's had a good rise, let's say you've had a strong bull run happening, and then you get a crossover of moving averages and it starts going down, that could be a good signal to enter. But if you've got a market that's going sideways, those moving averages are going to cross over back and forth half a dozen times. And if you take trades every time, you'll just get your money eaten for breakfast. And so people don't see that distinction. And these are visual things. We see much more in a picture. I mean, there's the old saying, a picture tells 1,000 words. And it's very true. If you can see a picture, there's so much more in it than, say, just looking at numbers. And I have to see a picture of things. And I look at charts and I'm still learning. I get more things all the time, more information. Every month I learn something different. I don't think you ever run out of things to learn when it comes to trading. But I can pretty much tell largely what's going on in the chart just by looking at it, even before I get in and start applying more tools to it. And if the market's not going anywhere, I'm certainly not interested in doing any further work on it.
Yeah, you just got to sit tight and just wait for a good signal to come about.
Yeah, absolutely.
Okay, cool. So just moving on a little bit, I've heard people say quite often that you've got to treat trading like a business. So, I mean, I think a lot of people probably trade. They take a trade, it either wins or loses. They accept it, move on, take another trade. Is there something missing there? Is it a good idea to be physically recording each one of your trades, putting notes with it about why it was good, why it was bad, what you did wrong, what you did right, and just documenting all your trades? Is that something that you do or used to when you were starting out?
I think it's something that everybody has to do for as long as they keep trading, because your trades give you, that's your way of feedback. If let's say you want to become a professional tennis player, okay, you go and get a coach. And when you get your coach, you go to a training session, you hit the ball and your coach gives you feedback. He says you're holding the racket the wrong way or your elbow's bent or whatever it is, and gives you correction and gives you the feedback from the things that you can't see yourself. Now, in trading, your coach is the market. And the market gives you feedback, but the feedback the market gives you is it gives you money or it takes your money. And it's completely impartial. Some people think the market's against them, but it's not. The market's like nature. Nature is completely impartial. If you're in the way of a cyclone, you get blown over. If you stand on the beach and watch the tsunami coming in, you'll get washed away. If you don't know it's coming in, you still get washed away. If you're a bad person or a nice person, you still get washed away. And the markets are like that. It's no good saying that I've spent 5 years of my life doing this, I deserve a good trade. If you break the rules, the market will take your money. But it's actually giving you feedback all the time. It's basically telling you you're trading the wrong way. And the only way you can see that feedback is to go back and look at what you did. And I vividly remember doing this one time some years ago now, where I got out a chart. I printed out a chart covering, I forget how many months it was, maybe about 3 or 4 months worth of the market. And with a pen, I drew on in arrows, buy, sell, buy, sell, buy, sell. And I stood and looked at the chart. And I had to go and have a chat with the guy in the bathroom mirror and say, tell me, Tim, why did you take that short trade in that screaming uptrend? And then why did you close this trade out when the market was keeping going up and gave you absolutely no sell signal? And things like that. And it was only when I did that I saw what I was doing. Now, I was actually making money at that time, but what I was doing was making money, giving it back, making money, giving it back, making money, giving it back. And when I actually looked at it, I thought, I'm not following my rules. If I was following my rules, I would have had a couple of trades that lost money, but I would have held on to all the ones that did. And I just thought I'm shooting myself in the foot. Now, I could only see that by going back and reviewing what I'd done. And I write a newsletter every week, and I was writing about some of this to my subscribers recently, and one sent me an email afterwards and said, I'm just blown away. He said, I went through my trades for the last year, and I found that all of my profits came from about 3 very simple setups and on about 3 markets. He said, all my losses came from trading other markets and trading different signals. And so by doing that review, in one swipe of his pen, he has just sent his profitability through the roof by simply cutting out a whole lot of trades. He doesn't actually need to learn a single new thing about the markets. All he has to do is stop taking all the trades that either aren't in those few markets or aren't that particular signal. And that's the sort of thing that you find out. And that's just one example, but I've got several. I could tell you more of mine and I could tell you more of other people's, but it sort of gives the flavour of it. You only get that feedback by looking back, because we have amazing ability as humans to deceive ourselves about what's going on. And we just don't see the cause and effect of our actions. So we think, okay, I'm not making money in the market at the moment. It's because the markets are really hard to trade. It's because the Fed's manipulating interest rates in the United States. It's because oil production is low, high, whatever. It's because there's war scares in the Ukraine. It's not because of anything. It's because of what I'm doing or not doing. And I can only find that out by going back and having a look at my past trades.
Yeah, no, excellent point there. So, yeah, really important to document everything. And then at least you've got it there and you can always sort of go back and review it and, go from there and correct yourself. So one thing that you touched on there, which I just wanted to sort of ask another question on, and that was instead of trying to trade all markets, really just specialising on, a certain amount and not, diving into other markets outside of your set few that you actually follow. Is that something you still stick to these days, is just narrowing down on a couple?
Yes, I've stuck to it more as the years have gone by and I've got more experience. And I can give you a couple of reasons for it. For example, I don't trade currencies. I think I've tried trading currencies once or twice very early in my career, and currencies just don't work for me. And I think it was the famous trader Jesse Livermore who said stocks are like people. They have personalities. And it sort of makes sense in a way if you think about it, because the sort of people who trade gold stocks are the sort of people who work in the mining industry by and large, because most trading is done by professionals in the industries. The sort of people who trade wheat are going to be farmers. The people who trade coffee are going to be coffee manufacturers, coffee growers, whatever, people involved in the industry. And just as different people's personalities lead them into different occupations, so the activities of those traders is going to produce different patterns on the chart. And everybody will find that they relate to certain ones. So I remember when I was learning, one of my friends had worked in the steel industry for years. And so he traded steel stocks. I think it was Blue Scope Steel he was trading. And he made a pack of money just by that, because he was experienced in that industry. Therefore, he was already, it was one that worked for him. He enjoyed it. And so he traded it well. And I just found you can often tell it fairly quickly, because you look at a chart and it's just hard to make any sense of it. And I've always been like that with currency charts. I sort of look at them and think, it looks messy. And it's funny because a very good friend of mine who trades and teaches traders about trading currencies, was talking about, we were talking about markets one day, and I trade soybeans, for example, is one of the markets I trade. And he said, I could never get into soybeans because I just can't make any sense out of the chart. And I laughed and said, that's really funny because that's how I feel about currencies. And so, both of us felt the same thing about the others' markets, and yet we could both make money in the ones that we traded. And so I think the more you stick with a few markets, the more you start to nut out what the characteristics of that market is. You might get one market that tends to make spike tops where it runs straight up into a top and then falls straight out of them again. Whereas you'll get another one that will go up to a high price and then it will sit there for a week before it starts heading down and so on. And you don't see those at first when you look at the chart. You've sort of got to look at the chart for a while before they become apparent to you. It's a bit like, I don't know if you remember them. I don't know if they have them anymore, but I remember about 20 years ago, they used to make these books of 3D pictures, and they were computer-generated 3D pictures. And you look at them and it just looked like a whole lot of dots on a page. And if you stared at it long enough and in the right way, your eyes would go funny, and then you'd be able to see a 3D picture.
Yeah, no, I remember those ones, yeah.
Yeah, and price charts are a little bit like that. You've got to stare at them long enough before you actually start to see what's really there. And if you keep flitting from chart to chart to chart, you never stare long enough at the one chart. Whereas if you keep, trading a market's always a good way, because when you trade it, you take a hell of a lot more notice of what's going on. And if you stick with the same one for a period of time, you start to get it, and you look at something and you think, I've seen that before. I reckon this market's going to do so-and-so. And then sure enough, a few times it does. And then gradually you start to get a feeling for what's going on next. So, you get a lot more confidence. Whereas if you split yourself over several markets, they'll do different things. So you start doing the thing that works in market A, but you start doing that with market B, and it would have made money for you in market A, but it loses money in market B. So you confuse yourself. So yeah, I generally won't trade more than about 2 or 3 markets that I'll be trading at one time. And I don't even like being in more than 2 trades concurrently because I just find it's too hard to keep my attention on.
Okay. Yeah, no, that makes sense. You just got to sort of familiarise yourself with your set few, and then, certain patterns and things just start popping out at you that,
Yeah, and they might change from time to time. For example, I traded cotton during the big bull market and the big bear market in 2010 and 2011. But I haven't traded cotton since because, it had its big run, and, it'll be several years before it has another one. And so sometimes I'll have a market like that where I'll trade it for a period of time. But in that time, I've really got to concentrate on it and not spend too much time looking at other ones.
Yeah, no, that's awesome, Tim. All right, well, before we let you run away, we'll dive into the closing bell, which is just the name that we give this sort of set round of questions. Sure. We ask it to all the guests. So what was the best piece of advice you ever received?
Well, this is a good one, actually. It relates to some of the things we've been talking about. A mentor of mine many years ago, probably 20 or more years ago, said this to me. He said, there's no room for amateurs in the game of life. And what he meant is that whatever you're doing, you've got to treat it as something, you've got to have a professional attitude towards it. He said, if you're amateur in anything, it doesn't matter whether it's your health and fitness, whether it's your marriage and family, friendships, trading, business, whatever, be a professional, because the professionals are the ones who win and the amateurs never win, and it doesn't matter what it is. And I think that's the best thing anybody's ever said to me.
Yeah, that's awesome. I like that. I can definitely see the logic in that one. Okay, so now another important point, routine. So what does a typical day in the life of Tim look like?
Where I live currently in Bangkok in Thailand, at the time I get up in the morning, which is generally around 6 o'clock because I'm an early riser, is just when the markets have finished trading for the day in the US and just before the markets in Australia open. And since they're the 2 markets that I follow, first thing I'll do is switch my computer on, and then over breakfast I'll check what all the markets have done overnight. And then I will have the Australian market on during the day, but I might check it couple of times during the day if I'm in a trade, just to make sure that nothing untoward is happening that's not expected. And then I really don't do anything market related really for much of the daytime. At the moment, I'm learning to speak Thai, so I go out and have some Thai lessons in the morning, and then I'll come back, I'll have lunch, I'll relax for a while, play the piano, do some reading and so on, and then I'll do a bit of market study in the afternoon after the Aussie markets have shut. And the US day session opens about 8:30 p.m. my time. And so, I'll have all my orders in before that. I'll usually have a look at what's happened in the US on the open, and then I go to bed. So, my actual trading time per day on average is probably about 10 minutes.
Okay.
Sometimes on a weekend I'll pull a market apart and spend some more time on it. But really, if I know what's going on, I don't have to keep reinventing the wheel and doing hours of work every day. I'm not an intraday trader. I can't see the point in giving up my full-time job, which I had before, to have another full-time job sitting in front of a computer. That seems like just exchanging one set of chains for another one. So my aim in trading is just to free up my time so I can do other fun things that I like doing, like going away on holidays for a week as I did last week.
Yeah, excellent, Tim. No, love it. Okay, so one trading resource you couldn't live without, what would that be?
Well, I suppose a good piece of charting software really is what every trader needs nowadays, because it's such an advantage over the old days when people had to keep records by hand. I mean, keeping records by hand is good for training, but with software, you have access to the data, you can check what's going on, and you can apply tools to identify setups easily. Obviously every trader needs education, but exactly what education they need will vary from person to person, because everyone's got to find the style that's right for them. And but I think you're making it very hard for yourself for somebody who doesn't have a good piece of charting software.
Yeah, absolutely. Okay, now one book you believe every entry-level trader must read.
I had to think about this one a little, because my favourite book for beginner traders is Gann's first book, which was called The Truth of the Stock Tape. But it's not necessarily one that I'd recommend to every entry-level trader. If for anyone interested in learning Gann's style, I would recommend it to. I think to an entry-level trader, probably something like a good biography of a famous trader. Now, probably the most famous trader that people come across is Jesse Livermore. And there's two good books on him. There's one sort of semi-fictional one that was written that's called Reminiscences of a Stock Operator, but there's actually a very good biography called Jesse Livermore, World's Greatest Stock Trader, which was written by a guy called Richard Smitten in about 2000. And it's just an excellent book because it just talks about a man who saw the highs and the lows during his lifetime, who made millions and lost them, and who never tired of the challenge of trading the markets from day to day, and really was a consummate professional in many ways. He had his weaknesses, but there's just so much to be learned about, one, what's possible with trading. I mean, Livermore made $100 million during the great crash of 1929, which is in about an 8-week period. And 100 million is a tidy sum of money today, but it was a hell of a lot more in 1929. And so it just shows you what's possible for somebody who can think big. Plus it's a jolly good reading about his life. And I think that's a great place for people to start, get an idea of the Hollywood fantasy of it all before you get into the hard study.
Yeah, cool. No, I'd definitely like to read that one myself, actually. I'll have to check it out. Knowing everything you do now, what would you have done differently come day one again? Something that, would have cut your learning time, maybe not in half, but drastically reduced it. What would something that you could give away be?
Two things. I would study the bigger picture of the market. So I'd learn to look at weekly and monthly charts and look at what the major moves that were happening were, rather than just focusing on a daily chart, which is what I actually did. And so, I'd learn to determine what the major moves were and then to narrow down and look to trade them. And the other thing I would do is study volume a lot more.
Okay, excellent. All right, Tim, we'll let you go. It's been awesome having you on the show. Listeners,
it's been my pleasure, Aaron.
Yeah.
Thank you very much.
Brilliant. I'm sure the listeners will take away huge amounts of value from this, and definitely some good actionable points there too, which they can pick up on and, put into place right away. So, yeah. All right, Tim. Now, before you run away, where can our listeners find out more about you? And more importantly, you recently published a book. So where can we find out more about that?
Well, I have a website. It's www.timwalker, as in my name, timwalker.net.au. And I talk about my book on there. And it also mentions a newsletter that I write. The book actually has recently been published in the United States by the Institute of Sacred Science, and it's for sale on their website.
Oh, awesome. All right, good one. So anyone who wants to find out more can just head there, and the link will be in the show notes as well. So, all right, Tim, thanks a lot for your time, and we'll speak to you later.
Fantastic. Thanks very much, Aaron.
You've come to the end of this episode of Chat with Traders, but don't worry, more great episodes are on the way. To stay updated with each great new episode, be sure to subscribe to the podcast in iTunes, and we'd love it if you leave us a rating and review. We'll see you next time on Chat with Traders.
Every decade, the market reinvents itself. Online brokers opened the doors. Mobile apps made trading seamless, and commission-free trading erased barriers. Now, a new era has begun. Meet Trade the Pool. Limited risk trading. From now on, your trading risk is capped and your trading opportunities are limitless. Trade the Pool funds home-based stock traders with up to $200,000 in buying power. That means you can trade large positions and scale your strategies without risking your own savings. It's time to trade with more capital, actually worth more of your time and effort. Ready to trade the pool? Click the link in the description and join Stock Trading Revolution today. Doesn't your portfolio deserve the best? Then join Tasty Trade, Investopedia's best platform for options trading 2026. Trade smarter with advanced charting tools, backtesting, a pre-built strategy selector, and more features. Join Tasty Trade today and earn a double commission rebate up to $3,000 total on your stock and ETF option trades for 30 days. Visit tastytrade.com/chat for more info. All applicable regulatory, exchange, and clearing fees still apply. Options involve risks and are not suitable for all investors. Learn more about Tasty Trade promo terms and conditions at tastytrade.com/double. Offer expires May 31st, 2026. Tasty Trade Incorporated is a registered broker-dealer and member of FINRA, NFA, and SIPC.
The biggest secret of the best traders in the world is that they're just like everyone else. However, they've worked hard to learn the markets and discover what works and what doesn't. But how can you hear about these journeys and get in on the strategies and tactics they use? You can do it by listening to Chat with Traders. Here's your host, Aaron Fifield.
What's up, guys? Welcome to episode number 8 of Chat with Traders. As always, it's great to have you here, and thanks so much for tuning in. Now, I'm going to try to keep this intro short because we have a lot to get through in this episode. So let me give you a quick rundown on today's guest. Back in 2006, he stumbled through the doors of a prop firm with absolutely no trading knowledge. He mashed keys for a few years until the firm later shut shop during the GFC. From there, he was pretty much out on his own. And that's when he really started to grow as a trader. After gathering around about $50,000, he traded it for 2 years and rapidly compounded it to the tune of $2.4 million. But in perspective, this was really just the warm-up. His name is Anand Sanghvi, aka Lucci, and he's now best known as the head trader at sanglucci.com. Throughout this interview, we go into much more detail about his journey, about some of the hard lessons he's learned along the way. And Lucci also talks a lot about the psychology of trading, so make sure you pay extra close attention to this. It's pure gold, trust me. But before we roll into this week's interview, there's something I'm really excited to share with you. Actually, I'm excited for you guys. After recording this interview, I was able to sweet talk the lads at XAUUSD, and they've agreed to give away their most comprehensive trading course to date, which is called the Lucci Method. In fact, it doesn't even feel right to call it a course because it's just so much more. Here is what's included. Firstly, you get an online course with unlimited access to over 75 training modules with videos, written material, charts, and more. This takes you right through from the basics of options to the finest details on how to trade the same method as Lucci himself. Also included is 2 months access to the XAUUSD chat room, which has an incredible sense of community and everyone gets the same respect regardless of your trading level. Plus, Lucci is in there with you throughout the day, talking through his trades and things he's watching. As part of the chat room, you also get the market regime report 2 times a week. On top of this, you also have 2 months access to the weekend sessions. This is 2 hours each weekend when Lucci reviews his trades from the prior week and goes over any interesting tape movements he's picked up from that week on a live webinar. And just when you thought there couldn't be any more, the guys are also going to throw in a 1-hour coaching session with Zach Hurwitz. This guy is a beast when it comes to VWAP. I'm actually going to have him on the show in a couple weeks' time, so keep an ear out for that one. Now, this package is available and can be bought from the XAUUSD site for $2,699. Now, that's no made-up value. That's actually what it's selling for right now. But we have one to give away, and it's super easy to enter. Just go to chatwithtraders.com/giveaway. You'll need to answer one very, very simple question. You won't get it wrong. And then enter your email address. This will give you 1 entry to the giveaway. When you do this, you will be given a unique URL. Take that URL and share it on Twitter, Facebook, just anywhere you can imagine. Because for every person you get to enter, you score another 10 entries. So let's say you get 10 people to enter through your URL. Then your chance of winning is actually 100 times greater. So get busy, guys, and don't muck around. This competition will close at 7 p.m. on the 8th of March, Eastern Standard Time. And again, in case you missed that, go to chatwithtraders.com/giveaway to enter. Now clear your head because the next 60 minutes are loaded with genuine insights that I'm certain will help you on your own trading journey. Here is this week's monster interview with Lucci. Lucci, what's going on, man?
What's up, man?
Not too much. It's just sort of early morning here. How about you? How's your day been?
Good. Good day, man. Good day trading. Could have been better. Always could have been better.
Yeah, fair call.
Did you go to the Brisbane? Are you a tennis fan?
I'm not. I know you are, though.
No Australian Open for you, bro.
No, but I believe, yeah, it's all happening in Brisbane, yeah. But no, didn't attend. So are you off to a good start in 2015?
I mean, okay, I guess. I mean, I'm up 50 grand. I mean, I would say good start for me is like, you know, if I'm up at least like a $500,000 kind of thing, you know. So, I mean, I'm making money.
Nice. Well, that's always a good start.
Yeah. I'm making money.
Awesome. All right. Well, man, I've got like a bunch of notes to run through, so I'm pretty pumped about this interview actually. So, what I'm thinking is we'll probably just break it down into 3 factors, or sectors would be a better word. So let's talk a little bit about how you got started, and just sort of run through your journey from when you got started to like now. And then we'll talk a little bit about how you're actually sort of trading the markets, and your sort of approach to them.
Sure.
And I also want to pick your brain about sort of the emotions and psychology side of things, because I know you're pretty big on that. So
Yeah, definitely.
all right, sweet. Well, let's just kick things off by telling us a little bit about your background. Just give us a brief overview on your trading, and then we'll zoom in and start getting into the details.
Yeah, dude. I mean, that's kind of a broad thing. I have no idea. Honestly, it seems so long ago. How did I get started trading, man? I mean, I hated my job as a financial analyst. I absolutely hated it. I was doing what was I doing? I was doing accounting, journal entries, creating pro forma financial statements, end of the month kind of thing, balance sheet adjustments, stuff like that. So I did that for like 9 months, and then I just couldn't take it. I couldn't take it. It was why I walked in the same, this dry cubicle, looking at the same spreadsheet every single day, and I just couldn't take it. And I remember at the same time, I had a funny story about that. There was like a weekend, PlayStation 3s just came out, right? And or was it? Yeah, it was PlayStation 3. And I paid a bunch of kids to camp out in front of the Best Buys, to make sure that, because everyone had like a certain allotment. So like Target would get like 6, Best Buy would get like 8, Walmart would get like 2. So I paid a bunch of college kids to I gave them a tent, and I just made sure they were there, had food and everything. I paid them $300 to get me a system, because you could pre-sell them online for like $2,500. And this was all over the weekend, and I remember this was like the third Monday I was late, and I told my boss, like, dude, I was making money selling PlayStations, and he didn't believe me. He was like, dude, are you kidding me? You got to be joking, blah blah blah. He gave me all this shit, and I was like, that's it. I'm out. I didn't take it. I hate, I have a thing with authority, and to me, I was doing all my work on time and everything. I was like, dude, what does it matter if I'm 10 to 15 minutes late? He was like, you're irresponsible, this and that. I was like, all right, that's it. I'm out of here, And prior to that, I was always like the side job kind of guy. I always had something going on the side. So I wasn't really worried about it, and again, it was a piddly salary, 45, 50 grand a year. And I was selling tickets. I just stopped like selling tickets, running sort of a brokerage service for tickets for like Red Sox and things like that. So that's what I just came off of. So I always had cash sitting around. So I was just perusing like Craigslist at that point, just looking for jobs, and I was looking for something exciting, I'm 22 at this point. Just had a child, she was 1 year old. I'm at home with her all day. I think I was 23, and I saw this job for an equities trader, and it was like commissions only, and then I walked in. It was somewhere in New Hampshire, and I don't know if you know Massachusetts or New Hampshire, but New Hampshire is like the slogan for New Hampshire is "Live free or die," and it's a very I don't know, it's a very weird town. Everybody's very liberal there in New Hampshire. And I walk into the office, and it's a bunch of like 25-year-old kids that look like you, honestly. They all look like you. And they're just sitting in front of their computer, just banging away at the keyboard and just yelling obscenities the whole day. And I'm looking around. I remember one kid made like 15 grand that day and bought everybody pizza. And I was like, all right, this seems like where I belong right here, and that's kind of how it started.
Nice, man. So you walked into this prop firm, and it was around about 2006, right?
Yeah, 2006, beginning of 2006. Yeah, beginning of 2006, walked into this place, and then started trading every single day, and the start is very difficult. Like the start of it is probably one of the most difficult parts. I wouldn't say mentally, but just figuring out what you're doing, and like it's a very daunting investment management and things like that. They have a little bit of a better understanding, but most finance degrees or business degrees or whatever, it doesn't prepare you for a damn thing, especially the mental aspect of it. That part of it, there's no preparation for that.
Yeah, they missed out the good bits. So
Indeed.
Yeah, so you walked into the prop firm, right? I mean, you had like zero knowledge of how the market even operates. Like, how did you know what to do, and where did you even start?
Yeah, it's a good one. It's a good one. And you know what everybody always does, especially if you're young or however old you are and you're starting out in the markets, what you do is you go out and buy books, right? So you go to your Barnes and Nobles, right? And you go to your self-help section or whatever the hell it is, and you look at all the investment books, and you go to these beginner day trading online and all this nonsense here, and you start reading through this, and you start understanding what technicals are and what candlesticks are and how to look at a chart and possible entries and exits and things like that. And then you start testing this stuff out. So there has to be a long period in time where you're testing out all this nonsense here, and you really don't know what you're doing. You don't know what you're doing. You don't understand what you're doing. The firm, when you join a prop firm, they're supposed to give you some education. My firm, they didn't give us much. It was all about the tape. It was all about bid and ask. But at that time, prop firms had a distinct advantage with technology and certain use of tools that you couldn't get. And then once 2007 and a lot of regulations changed in the market, everybody became sophisticated. It was a level playing field, and most prop firms shut down. So if you look out there right now, there's not that many prop firms out there. There's a couple big shops, and that's it. All the little mom and pop shops, the place that I started at, all of them closed. Those people ain't making money anymore. So to answer your question, like, the daunting task of understanding how it was, for me, it was bid and ask. It was the tape, so it was just looking at where buyers and sellers were. It was going over tape after the market closed. So looking at entries and exits from all the top traders in there, I would look at, okay, what did they see that made them want to get into this? What did they see that made them want to get out of that? And, I did this for like 6 months for 4 hours a night. And finally, you start creating a strategy for yourself. But that's what it was about. It was about creating a strategy for yourself, not taking somebody else's stuff and trying to duplicate it, because it was too hard to do. Those personalities were too different, And again, the psychological aspect of it changes a lot.
Yeah. So once you actually did start sort of trading some money, what were the sort of things you sort of struggled with the most? And then how did you overcome those issues?
Yeah, so I struggled the most with, and you know what? Everybody has a personality disorder, I would say, when it comes to trading. So it's like you might do something great, but there's something that just holds you back all the time, and it just keeps coming back and keeps coming back. So for me, it was, I figured out how to make money, but I always had an issue doing, making dumb trades, making trades that I shouldn't be in, taking losses that I shouldn't be taking. So I always ran into the issue of, pulling out a $40,000 month, and then the next month I was down 20 grand, or, and then the month after that I was up 35 grand. The next month after that I was down 15 grand, So I was always very volatile. And one of the best things that I did, and the best things to date, was start swing trading and focusing just on one or two names versus the hustle and bustle day trade every single day, every single second of every single day, trying to make more trades to account for bad trades, whatever it was, and just the real hustling every single second. Like, that can get you into a lot of trouble. It can get you into over trading, a lot of kinds of things, that making decisions that you don't want to make. So that was one thing. In 2009, I stepped away completely, and I was like, you know what? If moves happen in all these stocks, like, I don't care. If I catch my one move that I've been looking for 2 months, I'm good. I'm gonna make 500,000. I'm gonna make $1 million. It doesn't matter, So it was like the dumping of the ego thing. And it's always up and down with me. Sometimes I have the ego, and sometimes I'm able to, push that ego back and make smart decisions, and then it just comes back. It comes back. It's like, it's like these psychological issues that you always deal with, not even outside of trading, whether it's not being motivated to go to the gym. You might be there for 3-4 months, and you got gains and everything, and then all of a sudden you get lazy, and then all of a sudden the motivation comes back. So it's the same kind of thing.
Yeah, no, those are some really good points you make there. Really, really valid, I think. So, how long did it take you to develop some sort of system or method that you were reasonably consistent with in terms of being able to pull out a profit from the market?
Yeah, it took me 1.5 years, bro. It took me 1.5 years of not making like any money whatsoever, and that hurts. That hurts for a lot of people. For a lot of people that hurts, and a lot of people can't do that. Let's face it. Everybody's got family. Everybody has bills. You got this, you got that. So I always had my thing on the side that I was trying to make money on. So whether I was selling tickets or flipping PlayStations or whatever the hell it was, I always had my thing on the side where, I was okay. I could make ends meet while I hustled and studied and everything with the market, because the market is crazy, because you can see the money every single day. And that was the thing for the first 1.5 years. Like, I saw the money every single day. You see it being made every single day. But when you look at your account, like you're still broke as shit. Like you can't figure it out. There's some disconnect between all that money that you see and your account. It's like, why isn't that here? You know what I mean? Like, what am I not doing? What are the decisions that I'm not making? And most people can't get past that because it's a psychological thing. You know, it's more you against yourself versus your particular strategy. You know, most strategies out there can work. They just have to be done and employed at the right time. Which most people, you know, they don't get. Why? Because they're motivated by making money every single month, you know, and they're rightly so, because you got rent, you got this, you got that, you got all kinds of things to pay for. So most people are motivated to make a trade for the wrong reason. And that's why most of that cash doesn't pile up. So it took me a year and a half, dude. It took me a year and a half of not making a single dollar. You know, which hurt, man. Which hurt. It was depressing at times, dude. I wanted to quit so many times, man. You know, so finally after a year and a half, the epiphany I came to was like, it's not about the money. And that's the worst. That's the hardest part. You know, I was too fixated on the money, making $100,000 a month, making, you know, whatever it was, 10 grand a month, 20 grand a month, 30 grand a month. I was so fixated on the dollar amounts every single day, every single trade. And that's all bullshit. It's just about the trade. It's all about the trade. It's all about what the action is, you know, and then making the right decisions based on the action that you see. But you get so motivated by the money because, again, it's money, you know, it's real money. So that was the epiphany that I kind of had after a year and a half. Most people don't even get to there until, you know, 4 years, 5 years down the line after they've blown out so many different accounts.
Of course, yeah. So, I mean, that side hustle sort of helped you get through the struggle period while you were sort of learning your feet.
Definitely.
Yeah. So following a stint at the prop firm, what was your next move from there?
Yeah. So funny thing, man, with the prop firm was that was at the time where the markets were crashing in 2008. That was at the subprime blow up, the subprime meltdown. And in 2008, you know, markets went from skyrocketing to absolute shit. And what happened was that prop firms back in the day, like there was no regulation on proprietary trading firms back in the day. So as long as there was, let's say, an account with a few $1,000,000 in it, you know, there was a relationship with a brokerage that would allow you a significant leverage on that money, but it all worked on pooled accounting. So basically all that leverage was doled out to however many traders that was in the prop firm. The problem is that if one trader took like a bad hit or a bad beat or something, it would affect everybody else. So the head traders were buying banks on the way down. You know, they were buying Bear Stearns on the way down. Bear Stearns opened one day at $60, and then the next day it opened up at $10. These guys were long at $60, you know, so they got crushed. They didn't tell anybody about it, and I had to figure this out years later. You know, they didn't tell anybody about it, and then all of a sudden I came in one day. Expecting to, you know, crank it out, make some crazy money, and I'm cut down to 100 share lot. Okay, so prop firms, your head trader has you down to restrictions as far as lot sizes that you can trade. You know, I was nobody gave a damn about me because I was making money at the time, so I could trade whatever the hell I wanted to, and then all of a sudden I come in and I'm only allowed to trade 100 shares. You know, 200 shares. That means like my max P&L could be like $200. And I was like, dude, what the fuck is this? What did you do to me? What happened? What's going on? And then everybody was like, oh, you know, the head traders were like, no, we're not shutting down. We're not shutting down. 2 days later, we come into work, doors locked, and nobody's there. Doors locked and nobody's there. And then, you know, the whole thing shut down. The whole parade shut down. Every single trader out there filed out, and, you know, most of them weren't making money at that point anyway. You know, so it was only me and this one other guy that were making ridiculous money on the way down, just shorting everything. And then I was like, all right, screw this. I'm going to go swing trade. You know, I'm going to take this money that I have, which was about, I don't know, like 70 grand in cash maybe. And I combined it with my pops' money. And I was like, all right, that's it. I'm going to start swing trading. At that point, I didn't even know anything about options. So I was just buying low price stocks and flipping them, you know, buying 50,000 shares, 100,000 shares and flipping them a couple of weeks later for double, triple the money. It was a great time to swing equities at that time. So this was like beginning 2009.
Okay. And I believe you sort of compounded that pretty quickly within the next 2 years.
Yeah, man. 2009 was unbelievable. I mean, it was a place where Las Vegas Sands was like $2. You know, it was like $1. Citigroup hit $1. You know, all these names just washed out to nothing. So you could trade equities and double your money in an equity in a big, large cap stock in like a day or like a week. So it was nuts, man. I would rack up 50,000 shares, 100,000 shares of these things and just collect. I remember one month, you know, I had a $500,000 month, and then, and then I started trading options. Then I started trading options aggressively, trying to figure out options. And it took me a while. It took me a good portion of the beginning in 2009 to figure out what the hell an option was and how to use it. And then finally, summer 2009, I amassed a huge position in some bank options and crushed it. You know, made a good couple million in a few months.
Nice, very nice.
Yeah, man. Yeah.
Are you ready to get serious about options trading? Then join Tasty Trade, Investopedia's best platform for options trading 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including a $10 cap per leg on options trades, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, and more features to help you trade smarter. Manage your positions with speed and precision using Active Trader Mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Join Tasty Trade today and earn a double commission rebate up to $3,000 total on your stock and ETF option trades for 30 days. Visit tastytrade.com/chat for more info. All applicable regulatory exchange and clearing fees still apply. Options involves risk and are not suitable for all investors. Learn more about Tasty Trade promo terms and conditions at tastytrade.com/double. Offer expires May 31st, 2026. Tasty Trade Incorporated is a registered broker-dealer and member of FINRA, NFA, and SIPC. Ever watched a stock explode and thought, if only I had the capital, or sat on the sidelines because your account balance felt too small to matter? Good news. With Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, and even the newest IPOs. And short anything you like with zero locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. It's a game changer. Create your account and start trading real shares within minutes. No subscriptions, no minimum deposits, just a one-time evaluation fee starting at $47. That's it. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you ever pay a cent. Every decade, the market reinvents itself, from online brokers to commission-free trading. Now, the new era of limited risk trading has begun. Click the link in the description to start trading with Trade the Pool's capital.
So these days, you're probably best known as the head trader at XAUUSD. So tell us a little bit about what you're doing over there. Like, where did the idea come from, and how did it all get started?
Yeah, man. I mean, so I would say after 2009, you know, you're on a high. Remember, I was only 26, right? And I made a boatload of money, so you couldn't tell me anything. My ego was like at an all-time high, you know what I mean? So at that point, like, I think I took a big loss. I took a big loss. It was like $400,000, and this was like the worst loss that I've ever taken, you know. And I'm just sitting there, like, looking at my computer screen. I'm looking at my P&L down 400,000. I'm like, dude, you are the biggest piece of shit, you know, on the planet. There's no reason that you should even be alive right now. So, you know, I kind of just buckled, and I just gave it up for a little bit. I was like, you know what? I made a bunch of money. You know, that's it. My father retired. Basically, he didn't have to work anymore, and that was it, man. So, dude, I just had a bunch of money and traveled and enjoyed myself and everything. And I invested in all these stupid businesses and made all kinds of stupid decisions with my money. And you know, needless to say, I came to an epiphany again after looking at my bank account and looking at my lifestyle and being like, all right, how are you gonna do this for the rest of your life? You need more money. So then I was like, all right, that's it. I got to go back to work. So I created XAUUSD.com. And I always enjoyed writing, dude. I mean, one thing that I always enjoyed was writing, and I always had a knack for it. And I always had a sort of, mine was always humor. It was always like sarcastic humor kind of thing. That was always my thing. And I would look at all the financial news, and you remember this is like back in 2011. Or 2010 even. And, most people used Yahoo Finance and, maybe MarketWatch or Minionville or places like this. And most of the articles that you read it was just horrible to read anything that was going on in finance. And then I always felt there was so much manipulation from what was being put out there and what was actually happening in the markets. So I was like, all right, this is ridiculous. I got to make some comments here. I gotta show finance the way that I see it and the way that I see it in the trading world every day. So that's what I did. I just started writing, and people enjoyed it. And, but building a website and marketing and all that kind of stuff, I was picking that up on a fly. I remember sitting in the library just reading like HTML books and CSS books and figuring out how to put a website together, So the first versions of SangLucci.com were absolutely miserable. Nowadays, like, you can't even have a bullshit website. Like, you can't even have a whack website. If you have a whack website now, like, people just click right off of it. 2010, 2008, like, you could still get away with having a blog spot, of a website, or just some blogger type website that looked like shit. People would still go to it. Now, like, you can't have websites like that. If it's not glitz and glam, or it's not functional, and it's not so quick, then people don't even want to be on it. And if it's not mobile friendly, like, nobody's even going to spend any time on it. So anyways, that's how it started. I just started writing randomly and, built a good following, and then realized that I could basically, just like the side hustle that I was doing, back in 2008, I could do the same thing with the website. Keep some cash flow coming in, as far as chat rooms, as far as education, as far as things like that, while I try to go hit it again, in the markets, hit it big again in the market. So I started back with $100,000. It was really tough, man. That first year coming back trading was tough. Was so tough because, dude, when you take a break from trading and you come back, you already expect yourself to be winning just like you were before, and it doesn't happen like that. Like, you gotta understand the markets again. You gotta understand how to move again. You gotta understand the emotions again. So it takes a while to get back in the game, man. So that's basically how it happened. That's how SangLucci.com started, and that was just me. So now. It's evolved to so much more. I have partners. We were out in New York. We moved out to New York, and I'm sure we'll get into that story soon enough.
Yeah. Well, let's dive into it now, man, because, you've partnered with Haim Bodek, who is pretty much like the authority figure on high-frequency trading and automation.
Yeah.
So tell us about how that came about. Like, what are you guys working on?
Yeah. So, fast forward here, I had a website, was doing pretty well. I went through a couple of different business partners because, having business partners is difficult too. Finally linked up with these two guys that I met at a Tim Sykes trading conference. And this was like back in 2011, maybe. Or maybe to end of 2010 or something like that. And there was a guy named there, his name was Peter Zhang. He worked with the Bulls on Wall Street crew. And, we're just taking sake bombs and nonsense. I have this dope room at the Venetian, so I'm balling out over there in Vegas, just doing dumb shit. And, we're sitting there, we're having sake bombs, and Peter's like, yo, we should start a hedge fund. I'm like, yeah, all right, whatever, buddy. And so he linked me up with a friend of his, Charlie, who lived out in LA with him. And, we got on the phone, and these two were really sharp individuals. And I was like, listen, if you can put this together and you can put this in front of enough people here with this track record that we have, let's do it. Screw it. I'll do it with you. And they did it. They put in the back end work on, the legal work on setting up the hedge fund and all that kind of stuff. They showed a lot of promise as far as what they could offer for the website, and all that kind of stuff. So we decided to move to New York because to set up in New York, there wasn't as many hedge fund sort of restrictions, that you find in Boston or a lot of other cities across the nation. So New York was like the best place for us to go. So we were like, screw it. That's it. We all packed up, left where we were, and rented out this dope loft downtown Manhattan. which cost like $9,000, $10,000 a month kind of thing. We all just split it up. And it was a really dope place. We threw a ton of crazy parties. We'll get into that. And then we just started trading there. I was just trading there. We started running the site together, writing articles together, bringing new people into the loft from New York, from the New York trading scene and everything. And then Haim came around because we had just finished reading that book, Dark Pools. And I don't know if any of you guys have read it, but this is a book called Dark Pools by Scott Patterson, and it's all about the move and the shift towards electronic markets. But even deeper than that, it's how the creation of all these ATS systems came about. All these dark pools, all these ECNs, and it just kind of really showed the back end of the trading world, which nobody ever talks about. And these were all the answers that so many traders were looking for, myself included. And there was this guy in there. It was about a lion's portion of the book was about Haim Bodek. And I'm like, dude, this guy is awesome. This guy is great, man. Charlie was the one who read it. And all of us were like, dude, let's hit him up. And we found him on Twitter. Peter started emailing him, calling him. We said, hey, listen, just come by the house, come by the crib. And he came by and he just talked our ears off. And eventually, he was at that time where he was looking for something, and we were also looking to partner up with him as well. So that's how it started, man. Just from Twitter, man.
Yeah, that's awesome, man. I first discovered Haim Bodek in that documentary, The Wall Street Code.
Wall Street Code, yeah.
And that's actually
that came after. And we had, and Charlie had the deals and everything to make that happen, for Haim. That was a huge documentary that went down, really explained a lot to a lot of people about the markets, about high frequency trading, about how it worked, about the deceptive practices and all that kind of stuff. So Haim came in and really just blew our whole world up and showed us the other side of the market, which we've been wanting to know about and understand for the longest time.
Yeah, that's an incredible documentary. I'll put a link to that in the show notes, actually.
Definitely.
Yeah. I mean, that's actually how I first sort of heard about yourself and what you guys are doing over there at Sang Lucci. In that documentary, because you featured in it for 5-10 minutes at one point.
Yeah, we're in there. We're in the mix, and we're like the other side. We're the other side of the game. We're the side of the game that knows that it's there. We understand that high frequency trading is using our order flow to create opportunities and arbitrage opportunities for fractions of pennies, and I see them doing it to me all the time with a lot of the orders that I send out. So this is like us now finally understanding, and this is now the sophistication of people like myself, of other traders, of even retail guys who don't necessarily know or have that much experience in the markets. Everybody is slowly becoming more sophisticated because the access to this information is huge now with dark pools and with the Wall Street Code. Michael Lewis, the Flash Boys book that he just came out with. So all this is going on right now. Everybody now is in tune with the actual structure of the markets, which nobody ever was, and still you find a lot of retail guys that are clueless completely, but now everybody is getting more sophisticated in their knowledge of how the market works, which is great that we're here.
Yeah, it's crazy stuff. I've watched that documentary a couple times, and I'll probably watch it a few more yet. I'm still trying to get my head around it.
Yeah, definitely.
But it's really interesting. So now's probably a good point to sort of zoom in a little bit on your actual approach to trading. So how would you define your style as far as trading the markets? Like you mentioned earlier, you sort of were leaning towards swing trading. Is that still the case today?
No, man. But again, I always try to go back there. I'm always trying to get back there. And it's weird in trading. You go through these different evolutionary patterns within yourself, within your abilities, within your mindset. It's just trading is it's very connected towards your lifestyle as well, how you're living at that current time. Like me out in New York was pumped up with ego, man. Pumped up with ego, we had this giant loft. Everybody was coming to us for information. Everybody was coming to us on Twitter. Everybody was coming to us just to be a part of the movement. So I was driven purely on ego. Dude, I was going out every single night, coming home at like 4:30, 5 o'clock in the morning, and waking up 2 fucking hours later to trade. You know what I mean? And it didn't faze me. It didn't faze me at all. It was just what you did. So that was me in New York City, As far as me trading, what happened was in 2010, they came up with weekly options. And this really changed a lot for me, especially, and for, price movements on actual equities. It opened the door for a lot more manipulation as far as sentiment and perception manipulation on options, where to buy it, where to sell it. So there was a lot of games that were being played that I wasn't used to as soon as the weekly options came out. And then they provided this sort of lure of crazy money within very short time frames. So I went back to day trading, and needless to say, I wouldn't say it was the best decision here, because swing trading, and when I'm looking at just 1 or 2 or 3 names, and I'm sitting there just waiting for that big picture move to happen, it might be a couple of months, it might be 2 months, 3 months, whatever. That's when I'm at my best, I would say. But as far as trading and my style, it's all tape. Everything is tape. It has nothing to do with charts. It has nothing to do with fundamentals. It has a little bit to do with price levels and things like that, where a lot of people are trying to buy a stock or sell a stock or whatever. But everything is about the tape. And what I mean with the tape is what is the interaction between the buyers and sellers currently within this stock? And then how long can it last? So, for example, like if I see a lot of buying taking place on a particular name, it's assessing how much demand there is and how long that's going to last, and then also combining it with what's going on in the market, what's going on as far as the economy, global economy, all that kind of nonsense. You combine that all together to give yourself sort of a time frame on how long you want to hold something. So everything to me is buyers and sellers. It's all simple supply and demand for me. I don't use anything snazzy, no moving averages, no technical indicators, none of that mumbo jumbo, because now, like I said before, the sophistication of the players that own this market, meaning the market makers, smart money hedge funds, all these guys that literally run the markets, these guys are using all those things that the retail mindset goes to trade, like candlesticks, technical indicators, all that kind of stuff. So they use all that stuff against you now. They're that sophisticated. They are that sophisticated. Their programs are that sophisticated. To literally crush the retail investor who doesn't know what he's doing. So that's the game that's being played now. So that's why I always come back to what's true, and what's true is price, is tape, is bid and ask. That's it.
So are those sort of indicators and those sort of other different, things you mentioned there, are they things you previously used to use and now you've just sort of cut it right down to the tape? Is that what you? To be honest, I never actually used them. But I did look at a lot of charts and things like that, but I never actually used them. I was always against them. I never could understand like the crowd mentality. It was always to me the herd mentality. But there was a great period in time where it worked. That worked. Back in the 80s and back in the 90s, technical analysis worked. That stuff worked, because everybody was behind it, and there wasn't that much manipulation. There wasn't that many computers, algorithms in the game at that time. Now, most of the time that you're trading with a computer. You're not trading somebody else. You're trading with a computer, whether it's a computerized market making system, a smart money hedge fund, or whoever it is. That's who you're trading against. You're not trading against some other freaking human. You are trading against a sophisticated system. It's taking the other side of your trade. And you got to think about that. So 2007, that's when regulation NMS came in, and all of the whole structure of the markets changed completely, and that's when the computers took over. It was like overnight, man. The computers took over, and you could see it in the tape, man. Everything changed. Yeah, that's nuts. So, what's the sort of info that you're actually pulling from the tape that's actually influencing your decision on to place a trade?
Yeah, this one's a tough one. This one's something that you have to see. You know what I mean? You have to see it being done. It's like that same thing. With tape, everybody says tape is like a lost science or a lost art, simply because like there's no information about it. There's no books out there that you can really sit there and read about the tape. It's more of a feel thing. It's more about understanding buyers and sellers, how they interact with one another. And when you have a large player that is accumulating, let's say, blocks of shares or 1 million shares or 2 million shares, they have footprints. They have footprints. They have a distinct way that they're going about buying those shares, and that's kind of what I'm watching for. I'm watching for the bigger players building into a position, and then finally they went ahead, they let it go, and that's when you see the stock either going to the moon or going down to the depths. It's where these big breakouts and big breakdowns can happen, where really sharp price movements can happen within a short period of time. I'm looking for those spots. That's what I'm looking for, and I'm trying to assess buyers and sellers, and again, who's involved, who's manipulating that tape, and trying to figure out, okay, who's behind it, why are they behind it, and what are they doing? That's basically it.
Okay, cool. So what sort of influence does things like news releases and rumors have on your trading, if any, or do you just sort of stay focused on reading the tape, like it's all factored into the tape already?
Yeah, it's a little different now. Like before, 10 years ago, like you could trade a news release, you really could. There was enough time for you to be able to do it. Now, anytime there's a news release, like the news algorithms pick it up so quickly and make these moves happen within fractions of a second that anytime you try to get involved in this, you're the last one to the party. You're the last one to the party, and there's no way you're making any money here. So I always trade after the news release. I'll always trade after the news release. I will never try to anticipate some kind of a news release being in my favor or whatever, because you never know how it's going to affect the markets. You could look at a simple earnings call. You could take out most earnings calls that came out. Like you take Alcoa, which kicked off earnings season this year. It was positive earnings, great earnings, and the stock absolutely tanked. It opened up a little bit higher and then tanked 2 points over the next 2 days just because of the timing of where the market was. So oftentimes news releases and things like that, they don't matter. They're used more as a place to manipulate people into believing a certain direction, So I'll trade that after, once I understand what they're doing with that particular news release, So I'll try to stay away from it and trade after.
Yeah, you got to be careful what you listen to. So by following the tape, you're pretty much getting as close as you possibly can to the current price action.
That is the closest. That's the closest that you can get. And that's why I always come back to it. Most people are using all these other indicators. These things are lagging indicators by God knows how long. When you understand the tape and you understand buyers and sellers, that's when you understand how the market works from a fundamental level, how buyers and sellers have to interact with each other to get an order filled, and to get a significant amount of orders filled. There's certain actions that need to be taken. And when you can see that happen, that's when you're really in tune with the markets. You're not looking at some nice looking picture here on a chart formation and saying, okay, this is what's going to happen. That stuff is nonsense. The real information is in being able to read the buyers and sellers.
Okay, cool. So just so we're clear, the tape is the same as level 2?
Yes. So tape is level 2 and time and sales. So level 2 being your bid and ask, and time and sales being your the actual transactions and orders that take place. Tape can also refer to options as well. So oftentimes you'll see action in the options, big buyers and sellers of the options that end up moving the markets too. So it's vice versa. So tape includes all of that price action as well.
Okay, awesome. So once you're actually into a trade, how you determine your exit point / risk, and if things go sour, and on the other hand, how you deciding where you take profits?
Yeah, Yeah, this is always the tough one. And one of the things that I'm great at is my entries. One of the things that I'm subpar at is my exits. You want to know why? Because exits often get a little emotional, right? Because let's say I'm up in a trade, up 100 grand or something like that. I'm looking at my P&L up 100,000 and I'm saying to myself, maybe I can scratch another 10,000. Maybe I can scratch another 20,000. Maybe I can scratch another 50,000. And your mind all of a sudden gets glued or fixated on making the 150,000, on looking at your P&L at 150,000. And all the while you're looking at your tape and it's telling you to get the hell out and you're not doing anything because you're still fixated on your P&L being a certain way. So exits can really get botched when emotions come into the picture or you add your own soundtrack to the trade, which you can't. Because the trade doesn't give a shit about what you think. The trade doesn't give a damn about, how much money you want to make out of it. The trade is just the trade. So exits, I'm at my best when I'm slowly limiting out into strength. And then by the time it's the top of the move, I'm pretty much out of the option completely. If I wait until that last moment to sell my options, that's when the bad things happen. Because if you wait until the last moment, you're fixated on that P&L staying the same. There's no way it's going to stay that same. And if you wait until the last moment, whatever price on your option that you're trying to get, you're not going to be able to get that with the full size that you have. I never do. And that price disappears real quickly when everybody else is running for the exit too. So they'll push the price of that option down like crazy and have you looking at a P&L that you didn't want to look at, So the way that you have to do it best is to sell out into the strength, So whether if you're on the short side, slowly sell your options as it's working in your favor, so that by the time the stock is moved to its final low or high or whatever it is, you're out of most of your position. This is a difficult thing to do because, again, emotions are there the whole way. How do you not know it's going to keep going? How do you not know that the thing's going to pull back? So there's so many different things that you have to account for and be dynamic and act dynamically as a result, which most people, again, they can't do.
Yeah, man, exactly. Valid points. So having the skill set of being able to effectively read the tape, is that what you would say gives you an edge in the market?
Yeah, absolutely.
Yeah,
absolutely. 100%. 100%. That is my edge. And dude, it's funny that you say that. Is that U.S. equity markets are so mature. They're so mature in the sense that there's anybody who says I have an edge, chances are they might have an edge for a couple of months where they're making some money and that's it. There's no real arbitrage or that edge left in the markets unless you're looking at it from the computer perspective. So if you're just a regular human, you're a retail guy, there's no true edge left in a mature market like this. There is on the computer side because the computers, again, they're not swayed by the emotions. They can pick a certain type of situation, account for all these other conditions, and make sure that they're only doing that. Make sure that they're only doing that. Whereas retail guys, we are swayed by our emotions, which make whatever edge that you might have discernible. It might make that edge completely disappear. Whereas the tape reader, I feel like still has that edge. The retail guy who is still who understands how to read the tape, he still has that edge because he can still find where that money is going to be and how to get it just simply by reading the tape. So I still think, that's where the true edge, as far as just a human manual trader is, still left in this market. Everything else is accounted for. Every other strategy you can possibly think of, whether it's options, equities, or whatever the hell it is, that shit is accounted for. It's documented. Somebody has computerized that strategy. Any edge whatsoever has been taken and it's spoken for.
Okay, cool. So just sort of going back to your trading more specifically. So you're trading pretty much every day, sort of day in, day out. Are there ever days when you feel like you should not be in the markets because nothing's really lining up or looking like a good opportunity? Like, how do you avoid forcing trades?
Right. Every other day this happens. And again, this is the human aspect. This is the human failure when it comes to trading. When you know in your head, like, hey, listen, there's no opportunity here. There's nothing for me to do. But you are motivated. And remember, where this goes back to us saying the motivation for making a trade is most of the time, the at fault of the human. And because what are those motivations? What are those motivations? Those motivations are, I need to make my rent money. Those motivations are, I have losses to make back. Those motivations are, I want to buy a house next year, so I need some money for a down payment. Those motivations are, I want to get a better apartment. Those motivations are all kinds of dumb things that the market doesn't care about. It doesn't care about. But we add that soundtrack to the market, which causes us to force trades. And this is one of the biggest flaws of any human trading, any human trading. And again, you have to hit that root, the root of why you're making the trade in the first place. And most traders need to fail before they can see the light. You know what I'm saying? They need to fail several times before they can realize, like, oh my God, if I just cut out these bad days or these days where there's no money to make, I'm sitting on millions here, But it's so difficult to do that in the heat of the moment. And this is one of the big flaws of human trading, which computers have solved that. Computers have essentially solved that situation.
Yeah, that's great. I like the way you sort of summed that up. So
yeah, so as far as me being able to do it, like, dude, sometimes I'm good at it, sometimes I'm not. So sometimes I can look at the market and say, dude, I ain't going to make shit. And I can step away and I can go do other stuff. But other times when, let's say I got, a month of losses to make back, I'm there plugging away at the keys. And then all of a sudden I look at the end of the day, I'm like, dude, why did I do that? So it's still back and forth for me as well. That's still something that I'm struggling with too. I'm not ashamed of admitting that.
Yeah, cool. So we sort of touched on this a little bit before, but I just sort of want to expand on it a little bit. And that's sort of like, I've heard you talk about the need to adapt to the new market and the importance of remaining flexible. So yep. I'm keen to hear more about this, as in, what do you mean by the new market? And if possible, could you give us an example of how you've had to change your own day-to-day trading to be able to adapt?
No doubt. I have so many different examples for this. I'll do the one where the weekly options came out. When weekly options came out, price moves and the same breakouts that I looked for before, they happen so much more quickly. Everything is happening so much more faster. And again, there's another reason for that too. And it's a little bit sophisticated here in theory, and it's tough for people to kind of understand it. But let's just say that in 2009, when I was trading my one stock, two stocks, I had weeks to develop a big position in a stock, before I'd get my move. I had so much time on my hands to be able to do that. Once the weekly options came out, I had maybe a day. It cut me down to a day where I needed to get this position. Because there was so much more manipulation. There was so much more manipulation of price action. There was so much more fake outs. There was so much more false activity, false breakouts, false breakdowns. And I had literally a fraction of the time to amass the size of positions that I wanted to get. So me building $250,000 in an option is so much more difficult now than it was in 2009 and 2008. I could do that in 2009, 2008. Now, when I try to put that size out there in an option, market makers know me. They can see me coming a mile away. They know exactly what I'm doing. And then the games start. Then it's me against these guys who have more money and more time available to them to shake me out of my position and to literally give them the contracts for 50%, 60%, 70% discount. And then all of a sudden, my move happens that I've been waiting for. I'm not in it anymore. They own my contracts. And they literally waving at me. They're literally waving goodbye to me, while all this money is on the table. So there's so much more that goes into what I do as far as fighting against, smarter players, people that have more money, people that have more time on their hand. There's so much more to it now from the changes in the market than before. So you have to grow. You have to become more sophisticated. You have to start playing the games with them. You have to get sophisticated as far as how you execute your orders, where you send your orders to, how you send your orders. So that's a great example right there.
Yeah, no, I like that. That's a really good example. So, I mean, I couldn't have you on without digging into the psychology of trading, the emotional roller coaster many of us ride, and the mental side of things. So, let's dig into a little bit more on that side of things. So, what are some of your best tips to sort of keep a handle on your emotions? Do you have any sort of advice on the subject that you wish someone shared with you when you're starting out?
Yeah, and that's the thing. Like, you go through so many different emotional stages of your life, you know. So you got to remember, like, whatever environment that you have around you, that's what's going to influence your decisions, and that's what's going to influence your emotions. So, for example, when I was 23, 24, you know, I just had a baby. You know, my thing was all about, you know, how do I make sure I got rent and all that kind of stuff covered every single day. You know, so when I went about trading, it was all about, okay, how do I make $4,000 a month? How do I make $4,000 a month? How do I make, how do I make this kind of money a month? And I wasn't looking at the big picture. I was never looking at the big picture, simply because, like, what my environment decided how I was going to live, how I was going to make decisions. So whatever you're going through at the time, you always have to be bigger than that. You know, you always have to take a step outside and look at what you're going through and realize that in trading, none of that shit matters. None of it matters. And it's so difficult to do this. To step away from having to make money, to step away from, living a certain lifestyle or requiring a certain lifestyle. It's so difficult to step away from all this stuff. And I would say the one most important thing that I wish somebody told me was that to not think about the money when I'm trading, you know? And again, you know, this is not something that you learn overnight, but it's something that if you have it in the back of your head when you're starting, you know, you're closer to the bigger picture than I was, you know, so it took me years to figure that out, you know, and it was always about your lifestyle. Like, trading can consume you and does consume a lot of people to the point where they don't leave their houses, you know, they don't go out, they don't talk to people. You know, they become very secluded and lonely and loners, you know, simply because, like, they're slaves to their P&L every single freaking day, you know, and that's all it's about. And that's not what it's about, you know. So living a healthy lifestyle and you know, enjoying time with friends, whether you're down on your account or down on the year or you're up or whatever, you know, having a life is so important to being on an even keel. When you're sitting there in front of the computer, in front of the trading screen, you know, so always thinking about that big picture, which again, most people stop thinking about it the second they have problems trading or the second they have problems in their environment that they have to deal with. And then subsequently, those problems affect their trading decisions. And that's all it is. You know, most of the bad decisions that you make are a direct result of your environment, or you projecting the problems that you're having in your environment or in your life onto the market, onto a market which doesn't give a shit about it. We're just talking pure probabilities. Market doesn't care if you got issues. You know, it doesn't give a damn. But you're going to project that onto the market simply because that's what's going on in your life. That's what you're thinking about. You know, you're thinking about rent. You're thinking about this. You're thinking about, you know, how shitty your life is maybe at that time or how great your life is at that time. You know, you're thinking about all those things and you're projecting this onto a probability mechanism, a market which doesn't give a shit. You know, so that's the biggest thing I could say. You know, keep thinking about the big picture. Don't fall into the day-to-day, you know, hustle and bustle of the market all the time. Realize that the market's not going anywhere. There's going to be money to make tomorrow, the next day, the day after that. You know, so don't get too wrapped up in every tick of the markets. You know.
Yeah, man. Top advice. So still tying in with that emotions and psychology sort of thing, how do you keep the confidence up to push on and pull the trigger after a run of losing trades?
This one's tough. Man. It's tough. It's like taking a bad beat. It's always like taking a bad beat. It takes time. Everything is about time. You know, so let's say you get a run of bad cards, or you get a couple shitty months where you take a bunch of losses. You know, it just takes time. It takes time for you to step back and realize what happened. And then it takes time for you to stop being depressed. Like, humans have this innate sort of ability to what is the word I'm thinking of, self-doubt, or to beat themselves up, after something bad happens. Like, humans always go through a period of time where they beat themselves up about it. They're like, dude, I shouldn't have done this, I shouldn't have done this, I shouldn't have done this, right? They kick themselves in their ass too hard, and it takes a while to work out of that process and to start feeling more confident about yourself, to start feeling, like you actually can do this. You know what I mean? I mean, during a period of bad losers, there's nothing in the world that feels as bad. I mean, again, obviously there's worse situations everywhere, but it's a horrible feeling in the pit of your stomach. You're just like, dude, can I even do this anymore? And it takes time. It always takes time to come back out of that scenario. And that's, again, why it's so important to stay on that even keel, to continue to live your life and enjoy your life, and to continue to have other things around you that you're motivated by as well. It can't just be about the markets all the time, So that will help those, those periods of self-doubt and, you're beating yourself up, depression and all that kind of stuff. That will help making those periods a lot smaller. So you can, automatically bounce back and jump back into the game. For me, it's like 2 months or 3 months where I sort of like size down. I'm like quiet, and then finally, once I get a couple of winners, I'm ready to get back in there.
Awesome. So let's just jump right to the other end of the spectrum right now. And that's, I've heard you in the past sort of talk about when you did start to make it as a trader, the people around you began to change a little bit. So, they weren't necessarily supporting you when you were coming up. And sort of going through that struggle zone, like they'd sort of be like, what are you doing? Why are you trading? Waste of time, get a job, like that sort of mentality. So, how did you deal with that sort of scenario? And I mean, sort of what happened with you?
Yeah, man. I mean, that's a great thing that you asked that. And I'm sure you probably asked that to, a lot of other successful traders as well. And I'm sure like everybody has a different way of answering this, but there are some people that are more self-confident, self-aware than others, right? And you take a trader that has some success, right? Sitting on a few $1 million or sitting on however much money. And all of a sudden, like everybody around them changes. Everybody around them starts looking at them differently. And you can see it in their eyes, the way they look at you and the way they talk to you. They talk to you with this respect that, you never saw before. And you start getting used to that. You start feeling more powerful. You start feeling more important. You start feeling, all these things that you never really felt before. And to some people who, let's say, are easily swayed or might have sort of an addictive personality, that ends up taking them over. And you start to realize like they change as well. They start to only have these people around them that want something from them or say yes all the time to them. Or let's face it, at the end of the day, they're not real. They're not real. They're just there because you're the power guy. You're in the power position. They're just there. Women especially. Women that won't talk to you before, and all of a sudden you got a little money in your pocket. These women now want to know your name and they want to hang out with you and all that. It's bullshit, at the end of the day. But a man or a woman who is not, let's say, that self-aware and knows, that this is a bad road to go down, they get sucked into that life real quick. And we see it on the news every day. We see a new person on the news every day that goes down that road. And then all of a sudden, 6 months later, they lose all that money because they're motivated by all this crap, women, drugs, blah, 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 all this nonsense. And all of a sudden, like, you never hear from them anymore, So what I'll say to that is that I ate into it at some point, especially when I was in New York. When I was in New York, we were living a crazy lifestyle. I am telling you, man, the people that you'd see at this loft on a daily basis, it was absurd, absolutely absurd. The things that happened at this place were absurd. But it was a great experience. It was all great experience, but it really does teach you a lot about yourself when presented in that situation, because most people don't have to deal with that. And it's so easy for other people to look at you and say, oh, you should have done this, you should have done that. It's like, dude, you never had that. You never been in that position to be making any kind of statements about what you would or wouldn't do. And I always said it in one of my posts too. It's like, people are hypocrites. It's so easy for a poor person to look at a level of somebody who was rich, who was sitting on a couple $1 million or $10 million or whatever, and say, oh, he's doing this and oh, he's doing that. It's like, dude, if I put that kind of money in your pocket right now, you would turn into an even worse person, but you don't know that, because most people haven't been in that situation. So, dude, I would say I gave into it for a little bit. But dude, I realized pretty quickly that, it's all bogus. It's all bogus, and it's more about what you want to do with your life. How do you want to spend your life? What makes you happy? And if it's all that nonsense, going to the club and spending money and, being in this sort of public eye and all that kind of stuff, yeah, that's great. But that shit is not going to last that long, and it's not going to feel that great when, 5 years from now, 6 years from now.
Yeah, it's funny, like you hear of this sort of thing happening sort of all the time, like you mentioned, but you sort of never really think it will happen to you. I mean, I can't speak from experience where I'm at right now, but, did you sort of get that, like you never sort of pictured that would happen to you as you were coming up?
Oh yeah. Oh, absolutely. Absolutely, dude. Like I never knew that was going to happen to me. I never accounted for it. I never understood it, and I always boldly stated like, dude, I'm not going to be like that. I remember always telling myself like, I'm never going to be like that. And then all of a sudden when it's there, it's in your hands and you have that power and people looking at you like that. It's like a drug. It's almost like a drug. And you can see how people are easily addicted to feeling that way. And if you give into it, like that is always, I would say, 99 times out of 100, it always ends up in a shitty situation somehow, some way. It always does. It always does. And I can say that from firsthand experience too.
All right, man. This has been awesome. So let's we're sort of getting towards the end of the interview, but I've just sort of got one more question and then we'll take it to the closing bell. So why do you believe the majority of traders never see the huge success we set out to achieve in the first place?
Yeah. And I will say purely, and trying to come up with the root of that. Like, dude, I've been thinking about that a lot. Like, there's so many different ways to attack that question, So some people might say ego, some people might say this, some people might say that. And I think it's people never truly know what they want out of life, right? And if you're going to be a trader and you want this success, right? Most people just say, "Hey, I want $1 million," or "Hey, I want $2 million." And I can say firsthand that, making $1 million, it didn't give me any purpose in life. It didn't achieve it. I didn't make it and all of a sudden been like, yes, I'm good now. I've achieved this and I'm fine. Like, it had nothing. There was nothing there. I felt nothing. I felt absolutely nothing. In fact, I felt pissed off because I didn't make the 4 million on the trade and I made the fucking 1 million. You know what I mean? This was bullshit. It's complete bullshit when you have these dollar amounts that you want to get to. Because when you get there, it's not about that. So people, everybody has a different evolutionary cycle in the sense of how mature they are and where they hit that certain point where they really know what they want out of life. So if you, for example, want a freedom from having to work, that's something that, okay, now you can go ahead and break down what it's going to take to achieve that. So maybe it's, okay, making $1 million and then stashing that $1 million, living a sort of a very easy lifestyle, 50 grand a year type thing, making small investments, and then you never have to work. That's something that you can pull off. But if it's something where you just want to make money, remember, it goes back to the motivation for making the trade. And that's what I will always come back to. What is your motivation for making that trade? And if that motivation is not defined and it's not true in its purpose, then it doesn't matter what you do. It doesn't matter how much money you make. You're going to end up fucking losing it. You're going to end up losing it, or you're going to end up doing something else stupid. Simply because like you don't know truly what you're after. You don't know what you're going for. So most traders are just like, dude, I just want to make money. I want to make money. I want to make money. And that is a debilitating way to go about trading. Because if all you're motivated by is fucking money, then guess what you're going to do? You're going to make horrible decisions in the market all the time because you're motivated by, oh, I got to play this earnings call, which is horrible, which is a gamble at the end of the day. Oh, I got to make money today, even though there's nothing going on. So you're just going to rack up all these losses. All of a sudden, you got 2 blown accounts. Now you got to go back to work. And what are you going to do? You're going to stash money here for a trading account on the side because you want to get out of work? What makes you think that you're going to make better decisions because now you're under the gun and you got a fucking job and now you want to get out of your job? You know what I mean? People don't make good decisions when they're strapped down and they don't understand what their purpose is. And that's what I found out through so many years of up and down trading and through so many years of wanting different things, you know? So ego got me pretty far. But there's no way ego is going to make me $10 million or $20 million. There's no fucking way ego is going to make me that much. You know, the maturity now and the understanding of what kind of life I want to live, that's what's going to get me there. That's what's going to get me there and stop making, rash decisions in the market. Again, making decisions playing stocks from bad motivations. You know, so that's what I would end out with.
Yeah, man, that's awesome. So much good advice through this interview. I really appreciate you coming on again. So let's just take it to the closing bell, which is just about 4 questions, and we just sort of ask them to all the guests. So first one, what's the best piece of advice you've ever received?
Man, this is I hate questions like this too, man. Best advice I'd ever received, man. Man, I would say relax, be patient. Actually, yeah, that's the best advice I've ever received. Be patient in all forms, in all walks in whatever you do. Be patient. If you sit there and just bang on the desk keys, whatever it is in life that you're trying to do, if you force any situation or you go after it too aggressively, it has unintended consequences. So be patient, man. You know, it's going to come to you no matter what if you're true in nature and purpose.
I like it. Awesome. So what is the number one trading resource you rely on each and every day that you probably, would struggle without?
As far as like news, as far as what? As far as like a platform or something like that?
Yeah, anything. I mean, something that you rely on the most. So, maybe a trading platform, sort of.
Yeah.
Maybe the tape in your case.
Yeah, tape for me. That would be it. That's what I rely on every single day. I wake up in the morning and I look at tape. I go to bed at night and I look at fucking tape. So that's it. If I didn't have a time and sales in my life, I wouldn't be able to make money.
Fair call. So, what is one book you believe would be a good read for sort of an entry-level trader? Maybe something around the topic of understanding market structure better?
I would say Dark Pools. Dark Pools is it's such an awesome story. It has suspense, it has characters, and it is so cool. It is such a cool book. Now, for the newbies, there might be there might be some stuff that goes over their head, but again, it's written so well that it's just right on, man. It's perfect.
Awesome. That's definitely what I'm going to check out for myself, actually. I'm keen to read that.
Absolutely.
So knowing everything you do now, what would you have done differently come day one again?
Man, I would have been more patient, bro. This goes back to number one. I would have been more patient. And again, when you're young, like being young is rooted in ego. It's rooted in, is thinking that you know more than you actually do. And you know this as a younger fellow. And my daughter is almost 10, and I look at her and her ego is fucking ridiculous, man. It is ridiculous. It's blind. It's so blinding. So when you're 20, 21, 22, 23, all that kind of stuff, you don't know anything, and you think you know so much, and you literally have to get beaten down, and then you finally come into who you should be. Well, when you get beaten down, that's when you finally come into who you should be. So I would say, the person who gets beaten down earliest, meaning, if that happens at 19 or 20 or whatever, those are the guys that are really going to make something happen. And so that happened to me too. So,
Awesome. All right. Again, Lucci, man, thanks so much for coming on. Before we go, do you just want to share with listeners where they can find out more about you, more about Sang Lucci, and where they can connect?
Yeah, of course. I mean, we're at Sang Lucci everything. You know what I mean? So you find us on Twitter. You can find us on Facebook. Everything is at Sang Lucci. The website is also sanglucci.com. But honestly, the Twitter feed is the best place to just get an idea of who we are, what we talk about, and the culture. Because we're a lot more about lifestyle. We're not just about trading, and that's one of the things that we diversify ourselves as far as everybody else out there. We're so much more than just traders, and that's one thing that we're trying to bring to fruition in 2015 and going forward. More of the lifestyle thing, like who we are as people, and who you need to be as a trader. You can't just sit behind your desk anymore and just flop around. There's a community out there, and there's a lifestyle behind it. So that's kind of what we portray. So yeah, at Sang Lucci everything, man.
Awesome, man. Well, all those links will be in the show notes anyway at chatwithtraders.com,
Cool.
So you'll be able to find everything there. All right, thanks again, Lucci. We'll keep in touch and speak soon.
All right, Aaron. Sounds good, man.
All right, guys. I hope you all enjoyed that interview. Lucci gave a ton away, as I'm sure you heard. Very, very smart dude. Now, I just wanted to do a quick recap on the giveaway we're running at the moment. So it has actually kicked off, and what we're giving away is the Lucci method. So one person is going to win this. Now, what this includes is unlimited access to over 75 training modules in an online course. In each module, there is videos, there is written material, there is charts, and there's more as well. This takes you right through from the basics of learning options to the finer details on how Lucci actually trades in the markets today. Also included is 2 months access to the Sang Lucci chat room. This is an incredible community. Everyone gets the same respect, regardless of your level of trading. Lucci is in there throughout the day, talking through his trades and things he's watching. And also, as part of the chat room, you also get the market regime report, and that's a video you get 2 times a week. On top of this, you also have 2 months access to the weekend sessions, which are really cool. This is 2 hours each weekend with Lucci, when he reviews his trades and goes over any interesting tape movements that have come up in the past week. And it's all done on a live webinar, so you can ask questions at any point, and he'll explain it in greater detail if you don't understand anything, or there's something you're getting stuck on and want to know more about. And then finally, the guys are also going to throw in a 1-hour coaching session with Zach Hurwitz. And I mentioned at the start, like, this guy is just crazy when it comes to trading VWAP. And that's volume weighted average price. I'm going to have him on the show in a couple of weeks' time, and he'll run right through that. Very, very smart guy. So keep your ears out for that one. Now, also, the package is for sale on their website right now for $2,699. But we've got one to give away. So to enter, just go to chatwithtraders.com/giveaway. There'll be one question there. You've got to answer it. It's very simple. You won't get it wrong. Trust me. Enter your email address following that. And once you do this, you'll instantly be entered. This will give you 1 entry to the giveaway. It'll also give you a unique URL. And the idea is you need to share this like mad. And I'm going to tell you why. The more you share this URL and the more people you can get to enter from clicking your URL, the more entries you get. So for every 1 person you get to enter through your unique URL, you get 10 entries. So let's say you get 10 people to enter. Then your chance of winning is actually 100 times greater. Pretty cool, right? All right, now the competition will end at 7 p.m. on the 8th of March, Eastern Standard Time. So get busy, guys, and don't wait on it. Awesome prize. And again, in case you missed it, go to chatwithtraders.com/giveaway to enter. All right, awesome. Thanks a lot, guys, for tuning in, and I look forward to speaking to some of you in the meantime, and again next week. Peace.
You've come to the end of this episode of Chat with Traders, but don't worry.